News when you want it with Bloomberg News Now. I'm Jack Sidders.
And I'm Caroline Hepker.
The US has joined Russia in voting against a European-backed resolution at the UN that calls out Moscow's full-scale invasion of Ukraine exactly 3 years ago. The two sides later aligned for the first time since the war started to approve a US resolution calling for a swift end to the conflict without assigning blame. This comes as French President Emmanuel Macron visited Trump at the White House. And speaking alongside the US president, Macron sought to make the case for deeper European involvement in any peace deal. His words are spoken by a translator.
I've spoken with some 30 European leaders and allies in recent days. We want to bring together these allies and share the same.
Hello everyone, good evening, good afternoon to all of you. 25th of February 2025 once again. Welcome to this live analysis. देख लेते हैं मार्केट को एक बार फटाफट से. क्रूड ऑयल को देखोगे एक गैप अप ओपन हुआ था कल. यहाँ पर एक रेजिस्टेंस था, याद होगा आप लोगों को. एक सेलिंग का ट्रेड ही बनाया था. क्लोजिंग होते होते फिर वहीं पर मार्केट क्लोज हो गया था. आज अर्ली मॉर्निंग एक गैप अप ओपन हुआ था एंड वहीं से मार्केट ने रीटेस्ट लिया, ट्राई किया रीटेस्ट लेने का. यहाँ पर देख सकते हो वापस आता है तो वो एक रीटेस्ट जोन है. फिर से देखते हैं वहाँ पर एक बाइंग अगर बनती है तो लोअर एंड के आसपास. बाकी ऊपर फिर एक रेजिस्टेंस हमारे पास फिर नेक्स्ट ये रहेगा ऊपर 6230 से 250 के बीच में. गैस को देखोगे कल एक बाइंग का ट्रेड था, ठीक ठाक चला गया था. फिर एक रेजिस्टेंस एरिया था, रीटेस्ट जोन याद होगा. वहां पर काफी देर बाद आया था हमारा मार्केट, ऑलमोस्ट क्लोज होने वाला था तब मार्केट वहां पर आया था 11-15 के आसपास. वहां से थोड़ी बहुत सेलिंग आई थी. उसी लेवल पे मार्केट आज भी ओपन हुआ और वहीं से थोड़ी बहुत रीटेस्ट कर रहा है. देखो अगर आ जाता है ठीक है, नहीं क्योंकि कल रीटेस्ट कर चुका है ये. नहीं आता है तो फिर ये ऊपर निकलेगा, कोई इसमें कोई ब्रेकआउट नहीं होगा क्योंकि ऑलरेडी वो एक सपोर्ट था, ब्रेकडाउन हो गया तो रीटेस्ट कर रहा है. फिर नेक्स्ट रेजिस्टेंस हमारे पास वही 370 वाला रहेगा बीच में. फिर यहाँ पर 365 के आसपास एक एफईजी है, ये भी रेजिस्टेंस की तरह काम करेगा इन दैट केस. नीचे आता है तो ऑलरेडी कल का लेवल टेस्ट हो चुका है, उसके नीचे एक और सपोर्ट है, फिर वहां देखते हैं. थोड़ा सा नेचुरल गैस अगर और ऊपर आके रेजिस्टेंस लेता वो भी ठीक था, बट यहाँ पर भी ठीक है. इस नेचुरल गैस का जो चार्ट है वो आपका मार्च मार्च मंथ का है, ठीक है। नेचुरल गैस का चार्ट मार्च मंथ का। बाकी निफ्टी बैंक निफ्टी को देखोगे तो मॉर्निंग पे नीचे हमारे पास सपोर्ट था बैंक निफ्टी फ्यूचर में 15 मिनट टाइम फ्रेम पे, वहां से थोड़ा बहुत रिवर्स किया है मार्केट ने। वापस अगर नीचे आता है बैंक निफ्टी 48,110 के आसपास, 48,100 के आसपास, वहाँ फिर से बाई हो सकता है। कि अगर अपर लेवल की ओर आता है तो ऊपर रेजिस्टेंस है, वापस सेल कर सकते हैं 48,736 के अप्रॉक्सीमेटली। ऊपर भी 15 मिनट में वापस रेजिस्टेंस जोन ही है 48,730 टू 720 इन 15 मिनट। बाकी व्यू देखोगे तो ओवरऑल बैंक निफ्टी का तो बेरिश ही चल रहा है, नीचे सपोर्ट अच्छा है। लेट्स सी फिर से कोई डब्ल्यू पैटर्न बनाने की कोशिश करता है, जैसे लास्ट टाइम ट्राई किया था। कल क्रूड ऑयल में भी देखोगे डाउन साइड पे। अच्छा, यहाँ पर भी एक सपोर्ट है क्या इसका? एक सेकेंड, क्रूड ऑयल में करंट लेवल पे भी एक रीटेस्ट जोन है, इसको भी प्ले आउट कर सकते हैं, बाइंग का प्लान कर सकते हैं यहाँ पर एक क्रूड ऑयल में। ये लेवल हो गया मिस। एक क्रूड ऑयल में यहाँ पर भी एक रिटेस्ट जोन ही है, यहाँ से भी बाइंग है। लाइक भी करते रहो गाइस, जिन लोगों ने लाइक नहीं किया है, कोई क्वेश्चन है तो कमेंट बॉक्स में पूछ सकते हो। डेटा लिखा हुआ है 7:30 पर एक कंपोजिट 20 HPI का डेटा है। गोल्ड और सिल्वर को थोड़ा बहुत इम्पैक्ट करता है। 8:30 कंज्यूमर कॉन्फिडेंस और मैन्युफैक्चरिंग इंडेक्स का डेटा, ये भी गोल्ड और सिल्वर को इम्पैक्ट करेगा। लाइक करते रहो guys.
Vision. This peace must not mean a surrender of Ukraine. It must not mean a ceasefire without guarantees. This peace must allow for Ukrainian sovereignty and allow Ukraine to negotiate with other stakeholders regarding the issues that affects it. It is also a country in which we need to shoulder our responsibilities so that we ensure security and stability for Ukraine and for the entire region. And for us Europeans, this is an existential issue.
But despite Macron's overtures, Trump on Monday appeared to speed ahead with his plans to end the war without input from European nations or Ukraine, saying on social media that he's in serious discussions with Russian President Vladimir Putin. Separately, President Trump says Ukraine's Volodymyr Zelensky may travel to Washington as soon as this week to sign a deal over natural resources.
Germany's Chancellor-in-waiting Friedrich Merz is in talks with the Social Democrats to approve up to €200 billion in special defence spending. Bloomberg understands that officials from Merz's Christian Democrats and the SPD are discussing ways to get around Germany's tight restrictions on government spending to ramp up investment in the German military. Ideas under discussion include a special fund for new military spending and Ukraine aid, or adapting the so-called debt brake to allow for more defence spending.
Donald Trump is planning to toughen Biden-era controls over China's tech sector. The president's team is sketching out more restrictive US semiconductor curbs and pressuring key allies to escalate their own restrictions on the country. Bloomberg understands US officials recently met with Dutch and Japanese counterparts to discuss preventing Tokyo Conductor and ASML engineers from maintaining semiconductor gear in China. But Andy Budden, Equity Investment Director at Capital Group, says China's broader prospects are still positive.
The one thing that we can be sure of with China is that it is going to be a volatile market. And I would strongly encourage investors to really think about which of the companies that will do well over the longer term. But of course, we absolutely are going to see a lot of news flow on tariffs, on geopolitics. Investors just need to be ready for that and stay focused on the long term.
Capital Group's Andy Budden speaking there. Sources say early discussions about sanctions on specific Chinese companies are also taking place in Washington.
As well as curbs on China, Trump's administration is also going forwards with scheduled tariffs on Mexico and Canada. The president said the levies were coming soon, despite an initial delay.
We're on time with the tariffs, and it seems like that's moving along very rapidly. We've been mistreated very badly by many countries, not just Canada and Mexico. We've been taken advantage of. We were led by, in some cases, fools.
Donald Trump went on to add that the US Commerce Department is currently calculating the rate that it will impose on other countries and aiming to incorporate both tariffs and other barriers on US imports.
The European Union is expanding the list of US goods it will target with retaliatory tariffs. Bloomberg has learned the bloc is broadening its plans to respond to US President Donald Trump's planned levies on steel and aluminium exports. The US measures could impact €28 billion worth of European exports. That's 4 times more than the last time Trump went after the bloc's metal sector.
The European Union is about to walk back key pillars of its planned ESG rules. Sustainability drives have been blamed by some business figures for holding back the EU's efforts to compete with the US and Asia. Bloomberg's James Wilcock has more now.
The EU has long planned to make companies legally liable if their supply chains are found to contain ESG breaches. But documents seen by Bloomberg say the planned rules are being redrafted. Now only large companies will be targeted. They're only responsible for direct business partners, and the fines will be lower. It's a major watering down of arguably the EU's flagship ESG policy. That in turn shows how member countries are lobbying hard for deregulation in response to the wave of American loosening rules. The final proposal is set to be made public tomorrow. In London, James Wilcock, Bloomberg Radio.
And those are our top stories for you this morning. Let's have a look at the markets this hour. Stock futures for Europe are sinking, down 0.5% for the US Stocks 50 futures, even though we did see the Xetra DAX yesterday outperform after the German election. We saw a boost to defence names, including Rheinmetall. Overall, the markets yesterday in Europe ended lower. The S&P 500 is down now in negative territory. The Nasdaq also lower, 0.1%. So it does seem to be that risk off is perhaps winning at the moment. In the Asian session, you did have a sell-off too, particularly around the additional curbs from the Trump administration for China, for exports to China. MSCI Asia Pacific Index is down 1.2% this morning. The CSI 300 Index down 1.1%. And you have the Hang Seng Broader Index down 1.8%, but the Tech Specific Index was down even more, dropping as much as 4.4%. Looking at the bond markets this morning, 10-year US Treasury yields dropped 2.5 basis points at 4.37. It does also seem that on the long end of the curve, German Bund yields are beginning to take account of the discussion around extra defence spending. The euro this morning trades at 1.0468, so we pipped above 105 yesterday, but we're flat at the moment this morning. Gold is down 0.5%, oil prices nudging hard. Those are the markets.
That's news when you want it with Bloomberg News Now. I'm Jack Sidders.
I'm Caroline Hepker, and this.
Germany's new chancellor in waiting hits out at the US and calls for a
गाइस ये क्रूड ऑयल में अपर लेवल पे यहाँ पर रेजिस्टेंस मिलेगा, यहाँ एक सेलिंग का प्लान रखेंगे. ये ऊपर वाला लेवल भी रीटेस्ट ही है, ठीक है. दैट जोन इज आल्सो रीटेस्ट जोन. दोनों साइड रीटेस्ट ही बना हुआ है मार्केट में. इट इज आल्सो रीटेस्ट जोन. आई होप मोमेंटम आए. 130 हो चुका है. न्यूयॉर्क सेशन ऑलरेडी ओपन है. Now we can expect some momentum. लाइक भी करते रहो गाइस, जिन लोगों ने लाइक नहीं किया स्ट्रीम को. लगभग ऑलमोस्ट 45 पॉइंट की रेंज आप एक्सपेक्ट कर सकते हो. 45 और 46 पॉइंट. फिर ऊपर एक 6000 आपके पास 260 टू 255 टू 265 के बीच में भी एक रेजिस्टेंस है. ये भी स्ट्रॉन्ग ही है रेजिस्टेंस दिस वन. बायस थोड़ा ध्यान रखना, ठीक है. ज़्यादा बड़ा टारगेट नहीं है, छोटा सा ही टारगेट है. वापस ऊपर आएगा तो ऊपर से सेल प्लान है.
A stronger Europe. Elon Musk's "What did you do last weekend" email to federal workers. And Ukraine marks 3 years since Russia's invasion, with Zelensky promising to step down if it leads to peace. It's Monday, February 24th. This is Reuters World News, bringing you everything you need to know from the front lines in 10 minutes every weekday. I'm Tara Oakes in Liverpool. A win for Germany's Conservatives in a fractured election. The CSU-CDU bloc won the most seats, but far-right and far-left parties hoovered up support from disaffected voters, with the far-right Alternative for Germany, or AfD, surging to a historic second place. Conservative leader Friedrich Merz is likely to be the next chancellor, but the hard work now begins with complex coalition talks. He's ruled out working with the AfD, a party which is monitored by German security services on suspicion of extremism. And Merz isn't wasting any time laying out his foreign policy agenda. He's already taken aim at the US, criticizing recent comments from Washington as ultimately outrageous, comparing them to hostile interventions from Russia. Merz is vowing to make a stronger Europe his top priority. Our foreign policy editor John Durfee has been looking at what the US reaction could be to a coalition led by Merz.
I think that other European leaders would really welcome having Merz, who's a conservative who opposes Russia, supports NATO and the traditional transatlantic alliance. But all of those things would put him at odds with the Trump administration, which, as we've seen, has taken a really tough approach with its European allies. Trump and his officials have downplayed the Russian threat. They've insisted that Europe bear more of the cost of supporting Ukraine and criticized what it characterizes as the censorship of right-wing voices in Europe. And there was this remarkable speech by Vice President J.D. Vance in Munich a couple weeks ago where he barely mentioned the war in Ukraine, and instead really laid into European allies and Germany in particular for marginalizing right-wing parties. And in Germany's case, the far-right AfD. And you've seen Trump's close advisor, Elon Musk, also being really vocal in support of the AfD.
So what kind of a relationship could we expect Merz to have with US President Donald Trump?
The Trump administration has shown itself to not be shy about inserting itself into other countries' political debates. So it's really not out of the question that Trump might try to pressure a Merz government to give a greater role to the AfD. After all, the AfD does share many of the same anti-immigrant views as Trump's MAGA movement. And I don't think we've seen enough to know how Merz himself would manage a relationship with Trump.
Markets have been relieved at Merz's victory. Carmel Crimmins explains why.
So the euro has hit a one-month high and European stock futures are charging ahead. Investors are hoping that this election result means more state spending to counter Germany's weak economy. Merz and his party are seen as pro-business and pro-investment. But it won't be all plain sailing. The surge in support for the far right and the far left means it'll be difficult for him and other mainstream parties to revise strict limits on public borrowing that the market wants to see, and it could take him months to form a coalition. If you're interested in hearing more about the economic challenges facing Germany, check out a Reuters Econ World podcast I did, all about the transatlantic economy. We'll put a link to it in the description of today's show.
Pope Francis remains in critical condition, according to the Vatican. He's in hospital battling double pneumonia and an issue with his kidney function.
And the winner goes to Conclave.
The papal thriller picking up the top prize at Hollywood Screen Actors Guild Awards. A story of secret manoeuvring at the Vatican during a selection of a fictional pope. Isabella Rossellini, who stars in the film, wished the real pope well during the ceremony. and Timothée Chalamet's portrayal of Bob Dylan landed him a Best Actor win. Israeli tanks rolling into the occupied West Bank for the first time in 20 years. The military has been ordered to prepare for an extended stay to fight Palestinian militant groups in the area's refugee camps. A spokesperson for the Palestinian president, Mahmoud Abbas, has condemned the move as a dangerous escalation. Don't respond. That's the message some federal agencies are giving employees after Elon Musk demanded that they document their accomplishments over the last week or lose their jobs. Federal workers on Saturday evening received an email with a subject line that said, "What did you do last week?" Musk later warned in a post on X that failing to respond would be taken as a resignation. Joseph Axe has been looking into the emails sent to roughly 2 million employees.
It seems pretty clear that it was very broad and went to basically everybody that works for the federal government. It has this deadline of Monday at midnight. From the response that we've seen from a number of officials in those agencies and departments, they didn't expect this. Because a lot of the responses have essentially been, we don't really know what this is. Don't respond to it until we do a little more digging, until we figure out a little more about what this actually is and what it means. You know, it came from an address that I think some agencies didn't necessarily recognize. We know that at least in a couple of places, officials wanted to make sure that it wasn't some kind of phishing attempt, right? And so it does appear that the agencies were taken pretty aback by this move from Musk.
Does Elon Musk have the legal authority to tell workers that they'll lose their jobs if they don't respond?
I think legal experts have looked at it and said they don't think that that is something that DOJ can do. A couple of unions that represent federal workers have quickly put out statements saying they view this demand as illegitimate, that they will fight any attempt to terminate workers who don't participate in the request. And the largest federal workers union sent out guidance to all of their members, essentially saying, don't respond to that email unless your supervisor tells you to. And even then, you should ask your supervisor to explain in detail precisely what it is you need to say, what you can and cannot include in the email, so that way they're at least covered.
Ukraine's President Volodymyr Zelensky marking 3 years since Russia's full-scale invasion with a promise. He vowed to give up his position as leader if it means peace in Ukraine, adding that he could exchange his departure for Ukraine's entry into NATO. His comments were seen as being directed at US President Donald Trump, who last week labelled him a dictator. To mark the anniversary of Russia's invasion, many world leaders are in Kyiv.
This is an important day for all of us to be here. Thank you.
Canada's Justin Trudeau joining dozens of others from across Europe for a security summit in a show of unity with Ukraine.
Good morning, Mr. President.
Mr. President, good to see you.
Notable for his absence is Trump, who's overseen a change of policy in the last 2 weeks, pushing for a quick end to the war and talks with Moscow. At the UN later, the General Assembly will vote on 2 rival resolutions, one put forward by Washington, and the other by Ukraine and the European Union. But Russia has come out and said it wants a long-term peace deal and not a quick US-backed ceasefire. Deputy Foreign Minister Sergei Ryabkov says a deal must stand the test of time. On the front lines, fighting continues unabated. Yevhen Kolosov is the head medic at the treatment site in the Dnipropetrovsk region. He says around 70% of the injuries on the battlefield come from drone attacks. But he adds that Ukrainian soldiers are determined to fight on, despite the political battles with the United States. And for today's recommended read, a weekend concert in Damascus where hundreds packed into a courtyard in the old city for a night of music and dance. It was a cultural event the singer wasn't sure would go ahead as HTS Islamist rebels advanced on the city at the end of last year. But it got the green light from the new authorities. We look at how Islamists have taken different approaches to artistic expression and cultural heritage in territories they've ruled. There's a link to the story in the pod description. For more on any of the stories from today, check out Reuters.com or the Reuters app. Don't forget to follow us on your favourite podcast player, and we'll be back tomorrow with our daily headline show.
There to Cape Town, where finance ministers and central bank governors are meeting for the G20 summit, the first since Donald Trump returned to the White House. Our very own Jennifer Sabasaja is there for us on the ground. And walk us through the mood. What are people talking about?
Yeah, Kriti, I mean, you've been talking all morning just about a lot of the complications that these finance ministers and also central bank governors are going to be focused on. We should remember that this is a convening of 85% of the global GDP, these member states, and also 75% of international trade. And so they are in the thick of a lot of the uncertainty that we talk about day in, day out when it comes to tariffs, when it comes to geopolitical tensions. And then what does that mean for their own economies and how they can fortify their own economies to withstand some of the potential shocks to come. Now, top of mind for many people here is tariffs. And we actually earlier spoke to the South African Central Bank Governor, Reserve Bank Governor, Lesetja Kganyago. And this is what he told us about his perspective on tariffs and how that factors into his calculus.
Tariffs are a risk to the global economy and to the global disinflation process. And what I'm saying is that a year ago, it was not something that we were worried about because it didn't exist. Now that it is here, we have got to take that. We have got to take that into account.
Right. So that was just part of what we heard from Lesetja Kganyago. And you can only expect that many finance ministers, when they do get here later today, will be talking about that. The first 2 days of these meetings are focused on the deputies, and then we get the finance ministers and the central bank governors. But also what's important to note, especially when you think about the location that we're in, this is the first African country to host the G20 presidency. And so for President Ramaphosa, it is important to not only focus on some of these global issues, but also talk about how the global South and African economies and the issues that present to them, such as debt restructuring. There's also the issue of climate finance also be factored into these conversations. So you can only expect that that is going to be top of mind for a number of these leaders throughout the week.
Well, as you say, Jen, you've got the central bank governor of South Africa really bogged down in the geopolitics, but lots of issues to deal with at home as well. The South African budget delayed to next month. What's he said about the proposed increase in the country's VAT rate? How's it been received?
All right. Yeah, and also, Lizzie, the fact that South Africa has sort of found itself in the crosshairs of the U.S. President, especially when it comes to disputes around some laws that have been passed here, but also cutting off aid potentially. So, you know, we asked Lesetja Kganyago what he thought about this, and he said this proposed budget in particular that was supposed to be unveiled last week, as you noted, could have presented a potential shock. But he does say at the same time that in his role, it is a central bank governor governor's job to respond to the secondhand shocks. Now, we're unclear of what that could have potentially looked like. That was the proposed budget, the 2% added VAT tax, was a political. There were disagreements about how to actually impose it, and so we did see it collapse. But now the question is, how does this look like moving forward? We did get Lesetja Canyaho, though, to talk to us about what he thinks in terms of their inflation targets. He says his expectation is that potentially we will see inflation start to rise, at least here in South Africa, because of a number of the issues that we have been talking about, tariffs in addition to that. But still, their baseline case is that they will, inflation here will remain within their target, which is this 3% to 6%. But the question, though, is how can they respond to what will inevitably be some secondhand shocks from some of the measures that are being passed by a number of officials?
Jennifer Sabasaja on the ground for us in Cape Town. We thank you, Bloomberg's chief Africa correspondent at the G20 finance ministers meeting. Coming up, we're going to switch focus to cars. Tesla's sales slumping across Europe as rivals see an uptick in EV demand. We'll dive into those data next. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
Welcome back to the programme. This is the opening trade. Now, Tesla sales plunged 45% last month across Europe as rival car makers saw a surge in EV demand. Despite strong EV sales, total sales in the region declined 2.1% due to falling demand for plug-in hybrid, gasoline and diesel models. Joining us now is Sigrid de Vries, Director General of the European Automobile Manufacturers Association. Sigrid, thank you so much for joining us. So a bit of a complex picture, sales down overall, but EVs doing well. Within that, Tesla not doing so well. We'll come back to Tesla and its role in Europe in just a moment. But just sticking with the EV theme more broadly, it seems like EV sales actually doing okay, Sigrid. So I know that you've been arguing that the European Union needs to slow down the imposition of emissions rules. Do you still think that, given that EV sales seem to be doing okay?
Well, EV sales are doing okay, but it depends on the measure that you use to measure success. It's indeed remarkable that in less than 5 years, we reach a market share on average of 15% battery electric vehicle sales in Europe. That's remarkable by any standards, but it is not enough to meet the regulatory objectives that the EU has set. To meet these objectives, to be compliant with the law, we need to be closer to 25% market share today. And that's why we are sounding this alarm bell, because yes, we're on a great trajectory, in a great transformation, but it's tough. There's a lot of friction. It's a bumpy road, and we're not where we need to be. And this is critical because rather than having to pay penalties or pool with others or reduce the production of internal combustion engine vehicles or reduce prices in an unsustainable way, we'd rather continue investing in that transition. And that's why we really need measures to be taken to provide short-term relief for car manufacturers, but also to double down on charging points infrastructure in Europe and also demand measures.
OK, so you're calling for those incentives. I just want to pick up on Anna mentioning these falls in Tesla sales, 45% in Europe. But in particular, I was interested to see that they registered fewer vehicles than China's BYD in the UK. This surely has to be a boycott effect. Is that what you're putting it down to, the response to Elon Musk's wading into the politics of the likes of Germany and the UK?
You know, as a director of a trade association, you will understand that I cannot really comment any individual manufacturer's performance. I won't do that about my own members, and I won't do that about Tesla. It's interesting to follow, and of course, we're also closely monitoring, but I don't want to comment on that.
Sigrid, let's talk a little bit then about the broader kind of automotive industry right here in Europe. I mean, I think it's crucial that we keep hearing from the Trump administration about the word level playing field. How can Europe offer a level playing field to international automobile manufacturers, not just in the States, but perhaps players in Asia as well?
Yeah, that is the million-dollar question, because I think it boils down to really looking at the internal framework conditions for being competitive. And the lack of competitiveness of Europe also affects the competitiveness of the manufacturers that operate in Europe, be they European from origin or Asian, because you see, of course, Japanese and Koreans and now also Chinese setting up shop. So, I mean, that is the fundamental issue. It needs to be profitable, sustainable, manageable, affordable to manufacture in Europe. And that is today where we're not doing well as Europe together. There are too many rules and regulations. The cost of manufacturing is too high. Energy costs are triple as much as in the US and in China. So there's a lot of work to do, and that's structural issues that need addressing. And of course, this needs to happen in sync with this huge transformation, digital and green transformation that industry also needs to go through. But they are very much linked, and they need to go hand in hand.
As perhaps some of this regulation is being unwound in Europe, or at least politicians say that they are trying to do that, there is a question as well, and you kind of hinted at it in your first answer with Anna, the idea of subsidizing some of these industries. Emmanuel Macron has talked about that as well, and offering those kind of incentives. Does that work in a place like Germany, for example, in terms of rescuing the auto sector there?
Yeah, I mean, just to come back to your point on relaxation, we don't believe that is the case. It's exactly to stay on course, to stay on track, that we want some relief in the form of flexibilities to make it easier to match the paper reality, the law, with industrial cycles and with market events. And that is what we're asking for. So not to let go of the destination. We're not talking about a U-turn here. We're talking flexibilities to make this transition actually work. And doubling down on that. And part of that will be also focusing on infrastructure and on demand measures. And they can help. We've seen they need to be sustained. It's not a self-propelling market yet. So we need also support for markets to make consumers more comfortable and transitioning.
Yes, Sigrid, you talk about flexibility around the transition, but I just want to ask about the level of commitment that European manufacturers really do have to it, because we've recently seen Porsche and Mercedes both increasing spending on internal combustion engine models, and in that context, how committed are European car makers to that transition?
Very
still?
Committed. They've already committed over 250 billion euros into electrification. They are also doubling down on electric vehicle investments, and that's in the announcements as well. So they're following actually an expensive and multi-trajectory path to make this transition work. They need to serve customers, they need to build what customers want, but they also keep very firm eye on the goal, on the future, and that's why they're investing heavily still as well in electrification.
It's certainly something we're going to be keeping a very, very close eye on, especially as we talk about what the narrative is coming out of the States. Sigrid de Vries, a pleasure to have you on the program. Thank you so much for joining us, Director General of the European Automobile Manufacturers Association. Let's get a quick check on these markets here, because you are seeing some of the risk sentiment absolutely turn around. We did open just about an hour ago in the red. We've seen those losses paired when it comes to these equity markets. The outperformance of the DAX, though, maybe not a continuing theme in terms of today. So you are seeing perhaps some weakness.
Yeah,
there.
Looking ahead, we're going to get an Apple annual meeting, aren't we? We're going to get lots of ECB speakers. That'll be something that we're watching for today, and a bit of consumer confidence data as well, Kriti.
Yeah, plenty to go on there as well. The FTSE 100 flat and not following the underperformance you're seeing in the rest of the region. Coming up, Bank of America CEO Brian Moynihan live from the Economic Club of Washington. You catch that conversation 1:30 p.m. UK time. This is Bloomberg.
Just have to strategize with each other, with our team, with our agents, with everyone to figure out how can we package something that's going to be able to go straight down the middle and hit it out of the park. Because right now, people are going to be more adverse. We'll look at our slate, and while something was amazing 3 years ago and felt like we were going to be able to get it made, we have to figure out how to build off of that today. How can we make it feel more desirable? How can we make it feel more undeniable?
It's important to clarify that straight down the middle doesn't mean bland.
No.
It doesn't mean for the most common denominator. It doesn't mean trying to make something for everybody, something that doesn't have edges or specificity. Straight down the middle almost means the opposite in this moment, right? It means so strategic, so specific, so clear. So I think one of the kind of unexpected, wonderful impacts of how challenging the ecosystem has become is that we have had to make sure that we are more committed to content than we've ever been before. Because the fight is so real that if we jump onto something or we develop something, we have no choice but to have to love it.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Well, Bloomberg has learned that the U.S. is pressuring allies to toughen chip curbs on China as President Trump says tariffs on Mexico and Canada are going ahead as planned. Will European stocks waver after a sell-off on Wall Street? The U.S. breaks with its allies, voting against a UN resolution condemning Russia's war in Ukraine as the French president tries to get Europe back to the table for talks with Moscow. Plus, Tesla sales in Europe plunge as rival car makers see a surge in EV demand. So there's a lot going on in the world. There's a lot of great guests that we have coming up. But first thing is first, let's check the European markets map. Now, again, a lot of the focus is on the Trump tariffs. Exactly what that means is still unclear, which is why we're seeing a bit of a whipsaw. Certainly.
The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values.
Tariffs, exactly what that means is still unclear, which is why we're seeing a bit of a whipsaw. Certainly, a lot of the market's actually quite undecided about which way they will go. So a lot of these stocks are now struggling for direction. You can see the CAC 40 down 0.3%. The FTSE is flat. The IBEX is gaining 0.2%. And then a bit of pressure also on the DAX. Now, 1 month into Trump's presidency, and it's uncertainty on how policies will affect, of course, U.S. economic growth that prompted investors also to cut risk and go into some of the safer havens, such as gold. So we look at Bitcoin below 90,000, and then a U.S. 10-year yield at 4.3424. Again, this is actually quite a big move. We've seen treasuries move in the last couple of days. Now, Tesla sales plunging 45%. Last month across up. But first thing is first, let's check the European markets map. Now, again, a lot of the focus is on the Trump tariffs. Exactly what that means is still unclear, which is why we're seeing a bit of a whipsaw. Certainly, replacement actually of the chief executive that was widely unexpected. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, let's begin with the Bloomberg scoop on the latest development in the trade war between Washington and Beijing. The Trump administration is planning to expand chip controls over China and pressure key allies to help with tougher restrictions. Let's bring in Bloomberg's Jill Dices, who's in Hong Kong. Jill, Trump sends conflicting messages, frankly, on China, recently saying he has a great relationship with President Xi. Is he a friend or a foe of China?
Well, Francine, I think while Trump may say that, he has this great relationship with Xi, certainly a lot of the actions that his administration have taken are ones that are pretty tough on China. I mean, he staffed his cabinet with China hawks. You look at Secretary of State Marco Rubio, among others. He's already instituted, new tariffs on China or up to, existing tariffs on China. And now it does appear that he's kind of continuing on with, sort of pushing ahead more aggressively on some of these Biden administration era rules on chip curbs. So the latest one that we're reporting on now, taking a look at, U.S. officials talking to their Dutch and Japanese counterparts about limiting, the ability for ASML or Tokyo Electron to have semiconductor gear in China. I mean, this is really this idea that's just furthering what we've already seen out of, U.S. officials over the last several years, which is trying to curb China's development on chips and trying to sort of curb, their advanced technologies.
Jill, the NVIDIA chief executive was also pretty hopeful that President Trump would opt for a lighter regulatory touch. Are Trump's policies on chips an extension of his foreign policy, or is it actually just pure commercial reasons?
I mean, I think, your answer there is kind of just yes, both. I mean, on the one hand, you do have U.S. officials that have been pretty serious about saying that, they've got national security concerns about China's ability to develop advanced technologies, advanced chips. Again, we saw this during the Biden administration under former Commerce Secretary Gina Raimondo, when you really saw these concerns about, what Huawei, for example, was developing and how that could kind of lead to more advanced chip technologies in China. It does seem like, there's an element of that that's certainly a concern for the Trump administration. But then, yes, I mean, there's a commercial aspect to this as well. You take NVIDIA, for example. I think, there's been a lot of attention paid to what exactly happened with, the development of that Chinese company, through the DeepSeek AI program earlier this, that model earlier this year. You saw, some conversation about them using older NVIDIA chips to sort of develop this lower cost AI model that's, hitting benchmarks equivalent to some big American firms. So there's, and that obviously had a pretty big impact on the U.S. stock market. So there's certainly a commercial aspect to that there. But of course, this kind of, goes without saying that there's a big national security concern here as well. The U.S. has really kind of, sort of for a while here wanted to make sure that they're staying on top of the semiconductor game when it comes to what they're doing against China.
Jill, thank you so much. As always, Jill Deesis there in Hong Kong with a terrific briefing on some of the Trump policies and actually what that means for the tech sector in China in particular. Now, the U.S. has withdrawn its previous stance, condemning Russia's invasion of Ukraine at the United Nations, a pretty dramatic policy reversal from President Biden's administration and another blow to ties with the EU. Now, this comes as French President Emmanuel Macron also visited Trump in Washington to try and get Europe back to the table in talks with Russia. Well, speaking during a press conference in the Oval Office, Macron corrected Trump about European support to Ukraine.
Europe is loaning the money to Ukraine. They get their money back.
No, in fact, to be frank, we paid 60% of the total effort, and it was through, like the US, loans, guarantee, grants, and we provided real money, to be clear.
The body language is also something to behold. Now, later in the show, we'll discuss the geopolitical change of direction from the White House and what it means for Russian President Vladimir Putin with Bill Browder, the celebrated author and, of course, critic of the Kremlin, who was the largest foreign investor in Russia until 2005. He's on the program in about 25 minutes. Now, Donald Trump says tariffs due to hit Canada and Mexico next month are on time and moving along very rapidly. This comes even as U.S. officials caution that the fate of the special 25% levy on the two countries was still to be determined. Well, let's bring in Christian Muller-Gleesman, head of asset allocation research at Goldman Sachs. Christian, as always, thank you so much for coming on. There's a lot, right? There's a lot to go through. Geopolitics, either be it with Russia, just also some of the things that President Trump is trying to do on China and chip makers. First of all, how do you cut out the noise to actually what changes the fate of U.S. equities?
Yeah, I think you've got to ask yourself what are the most important things, the most important drivers of U.S. equities. And it's been AI and the U.S. consumer. And we need to understand how all the policies and what's going on in the world is impacting those two drivers. And the market is getting more nervous. You have had data that's been mixed, like on Friday, the service PMIs, the inflation expectations going up. That might reflect the tariffs. It might show that tariffs are kind of a bit of a tax on the consumer, possibly hitting the consumer. And as you were mentioning already, we have this lingering uncertainty with regards to AI CapEx, DeepSeek. So I think these are the two things that we look at in particular in the US, the consumer and AI, and how that's going to impact the S&P, in particular the ROE. Like what we've been saying for a long time is return on equity in the S&P can justify these elevated valuations. Right. If it starts coming down, i.e. profit margins, like we have results from NVIDIA on Wednesday, we're all watching very carefully if you can maintain profitability in the face of these headwinds.
But Christian, when's the right time to diversify if you do start worrying? I mean, we also had the University of Michigan number on Friday. That was a little bit worrying.
Yeah. I think we've been arguing for diversification across and within assets already at the end of last year. Okay. So we've been saying that, first of all, you want to think about more balance in the portfolio. If you look at last year, most of your performance was driven by equities and was driven by U.S. equities. So the idea is from here, you probably get more broadening out. Maybe you have the bond market contribute a bit more in terms of returns, not necessarily because bond returns are higher, but maybe equity returns are lower. Maybe equity risks are higher, bond risks are lower. So we've been advocating balance, a balance between equities and bonds. bonds. And then, as you were already saying, regional diversification, which arguably is a good idea. Certainly academic evidence points towards that, and recent evidence points to that. I think it has a bit of a comeback right now. We've seen that year to date. China, Europe have had a significant outperformance versus the US. And obviously, as we were discussing, even within the US, there's been a broadening out relative Max 7 and 493. So I think we're dealing with a huge opportunity and necessity for diversification.
Where do you see the biggest opportunity right now? As you say, Europe has been unloved for many years, but there's so much concern about growth and also what happens with Ukraine. If you get the big stocks, is that a way of actually almost hedging against some of the nasties in Europe?
Yeah, I think I would argue that Europe is a bit more difficult as a kind of a momentum trade, you could say, because most of the kind of potential we see for European equities is coming via risk premium reduction, less via earnings growth. The earnings growth is going to be a much slower grind. So our economists have upgraded their German GDP forecast in function of the election results. We've obviously looked at the Russia-Ukraine deal, but a lot of the potential impacts on growth might be a bit more backloaded. So near term, you rely on risk premium. And European equities are already a bit above their long-run average valuations. So that makes it a bit more difficult to get too excited about the runway in Europe. We're a bit more selective. So we've been very focused on quality, you mentioned already, and low volatility, because we do kind of like adding duration to equities, and adding low volatility quality is a bit like adding duration within the equity space. So it is kind of a bit more defensive into a pretty uncertain backdrop, as you were saying from the beginning, with tariffs, with the growth picture breaking away, geopolitics.
Christian, what do you do with gold? Is there anything to do with gold right now?
Well, we've upgraded our target to 3,100. And what's so nice about gold, as an asset allocator, you want to have things that are not correlated to each other. And gold is currently having this very idiosyncratic outperformance, which is probably most likely driven by central bank demand, which continues to be strong. And that's very valuable in a portfolio. Like historically, you remember gold had this link to real yields, to the dollar, this risk on, risk off link. And this link has started to soften a bit. There's still an element of that where gold reacts in geopolitical shocks. It reacts in broad, big risk offs. And we haven't even seen that reaction yet. Most of the movements we've seen in recent months have been linked to tariffs and have been linked to concerns on geopolitics and central bank demand. So if you do actually get a US growth issue emerge, like gold potentially still has some convexity left. If we look at investor positioning into gold, like ETFs, etc., it's still very low. So you haven't seen that safe haven rotation, which you often get.
Christian, I have a viewer question, but we'll get to break and then I'll ask you. They're asking about Asian equities, so I'll ask you what the catalyst for those are shortly. We're back with Christian Muller-Gleesman from Goldman Sachs shortly. Also, just very quickly, a big corporate story we're following. Unilever Chief Executive Heinz Schumacher is to step down in a surprise move after less than 2 years at the helm of the consumer goods company. Unilever shares have fallen on the news. He'll be replaced by the current Chief Financial Officer, Fernando Fernandez, in March. Schumacher will leave the company at the end of May. Coming up, we'll have plenty more from, of course, Christian from Goldman Sachs. We also look at Germany and coalition building. This is Bloomberg.
Good morning. Just half an hour away to the opening bell here, Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Annabelle Jewelers.
Our top stories: fears of deepening trade tensions spark risk aversion in Asia, with Chinese tech stocks facing pressure from President Trump's latest executive order targeting Beijing.
Now, elsewhere in markets, the Canadian dollar and Mexican peso also coming under pressure. That's after President Trump says the tariffs will go ahead as planned next month.
Also ahead, President Xi Jinping backs Russia's talks with the US on Ukraine in a call with Vladimir Putin. Washington, meanwhile, breaking with allies at the UN over the war.
And Tesla said to be preparing to deploy long-awaited driver assistance features in the Chinese market, similar to full self-driving in the United States.
Taking a look at the market action this Tuesday morning, there's a little bit of a flight to safety that we're seeing. So you've got yields, for instance, on the 10-year dropping a little bit. You've got gold here hitting a fresh record high. The dollar is a little bit bid. So this is really a confluence of factors that leads to risk off in Asian equities. And again, this morning, you've got the broader gauge trending down 0.7%. All the major markets as well in the red. Taiwan just coming online off 1% to start the day. So look, there's a couple of different stories, but really the key theme that threads through all of those is President Donald Trump. Firstly, you've got this deepening in the rift that we see between the US, its European allies, over what happens around Ukraine. You've got trade, of course. President Trump saying that tariffs on Mexico, Canada, those are proceeding. So you're seeing as well the back of that dollar strength is the Mexican peso, the loonie coming under pressure as well. Just to note on the currencies front, we have had the Bank of Korea decision cut coming through very much as expected by economists. But again, you're seeing the won there a bit weaker against the greenback. So that's the state of play there at the macro level. But let's dig a little bit into the details. Take a look at what happened with the Golden Dragon Index overnight. This is a real doozy. I don't think there's any really other way to say it, because we saw that big slide. It's the worst drop we've seen for about 4 months for this gauge. The story around this is that continued reaction that we're getting to these weekend events. President Trump notching up the pressure on China in some respects. Further restrictions coming through rather into Chinese investments into U.S. tech, energy, other strategic sectors. Alibaba, one of the key drops in that, and we can get into the details in just a couple of minutes. Moving on. It's not just that story around what we see in equities, because, of course, crypto is one of the earliest indicators we can track for trader fears. And you are just seeing this big slide across the board. You've got Bitcoin under pressure, but altcoins as well, very much the focus. Yes, we did have the Bybit exchange hack on Friday, so $1.5 billion of tokens stolen. It's the biggest hack we've ever seen for the industry. But our Markets Live team is just saying this is part of the story. And actually, you should be watching Bitcoin. If we track below $89,000 a token, that could set us up for full crypto sector capitulation. But taking a look at how we're setting up for Asian trading today, in China in particular, we do see, Dave, I'm not going to say it's any sort of surprise, but futures here are pointing to a bit of a drop.
Yeah, well, a bit is being generous there, Belle. I mean, certainly the tech conversation, so we will see a substantial drop at the open. The question, I guess, right now for investors is what will sort of investors this part of the world do? We've been waiting for that dip. Will they buy this dip that we're getting today? I'm looking at Alibaba right now. We're called about just under 130 Hong Kong dollars a pop here, so we're called substantially lower. Looking at the prelim markets, also to the broader tech conversation as well, and this goes into the DeepSeek part of this. Reuters reporting, I believe it was, we're looking at this last night, I'm talking from an Asia point time perspective here, that it seems that the big tech firms in China, Tencent, ByteDance, and Alibaba, which we just talked about just now, have increased purchases of chips from NVIDIA. Now, of course, the broader story there, it's H20 AI chips. The company, of course, reports in about Thursday morning Asia time, so certainly the plot thickens as we go into that as well. We are down about, I would say, about 2% going into the open today. There are also, in terms of the risk aversion out there, dollar China, 100-day moving average. We can get to the Trip.com earnings later on as well. And we are still in the window for that rate decision on one-year lending rate to the banks and trade numbers coming out of Hong Kong later on today. Oh, yeah, I almost forgot. On the tariff story, Vietnam imposing tariffs on some steel products coming out of China. We'll look at that, of course, going into the session here today. Okay, so Alibaba indicated sharply lower right now, going into the open today, and unsurprising given that massive drop that you just talked about overnight.
Yeah, it's the biggest slide we've seen for the company back to 2022. Of course, you're kind of in that face of that huge run-up, you know. So Alibaba, in some ways, has kind of been priced to perfection. Maybe you do partially just see a bit of profit-taking as well. But traders are really nervous because Donald Trump is someone who's incredibly unpredictable, and you don't really know. Yes, you've kind of seen a bit of a softening in a stance toward Beijing, but he's still got a lot of hawks in his team, and he has done things that for instance, the CFIUS lines over the weekend that do say, yeah, the tension is going to be ratcheted higher.
Yeah, just because he hasn't talked tough on China doesn't mean he won't. But yeah, go ahead.
And actually, just going back to that H20 story around NVIDIA, that is the chip that NVIDIA specifically designed to
can sell to China.
Yes, exactly, to get around, or not get around the export restrictions, but to meet those. Even that sort of chip could be in the firing line for further curbs, essentially.
Yeah, there we go. So we talk about the front loading of shipments ahead of tariffs, the front loading of buying for these things, of course, ahead of any potential tightening on that front as well. Now, we talked about, so it's Alibaba. It's not just Baba in focus today, right? So you have really a lot of other names, given this world-beating rally we've seen in Hong Kong, that are, I guess, in many ways in the firing line. So you have Alibaba, you have China Unicom, you have a lot of the banks, you have a lot of the semiconductor plays. I think we showed that too. So a lot of, I think, about 10 or so names. Did we show that already? Did I miss that? 6 minutes into the show? There we go. Thank you so much. There we go with the list, because I forgot my script, so I need my producers to help me out here. Some of
from an index standpoint, you may not see as much excitement this year.
Markets have been resilient so far, and maybe more than resilient in the second half.
When you look under the hood, there's rotation happening and there's dispersion, and that's what's dampening volatility.
Ultimately, it'll be a good environment for stocks, but it's going to be a little bit more difficult.
Right now, it is about being broadly diversified.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Monday following the biggest one-day loss on the S&P 500 so far this year. Equity futures bouncing back. Your scores look like this. Up 0.5% on the S&P, on the Nasdaq 100 up by 0.3. That positive growth shock of early November felt like a long time ago in Friday's session. Consumer confidence down. Inflation expectations up. Existing home sales lower, and the worst PMI going back 17 months.
Especially when it has to do with services, not necessarily manufacturing. Suddenly, the engine of this economy seems to sputter, and growth concerns seem to be in the front and center at a time where, if you take a look at the U.S. City Economic Surprise Index, it has reached the lowest level, negative, for the first time going back to September.
This is going to be a bearish start to the program, so forgive us for the next 2 minutes or so. 6 consecutive weeks of lower 10-year bond yields. Is that good, or is that bad? That move has been reinforced by weaker than expected outlooks from the likes of Walmart. The week before, weaker than expected retail sales. It's not the mix you want to see to start a new year.
It's definitely not the mix you want to see, especially for an administration that one of the reasons why they won is because they were concerned and were listening to American voters when it comes to inflation. And the Michigan survey on Friday showing these inflation expectations going up is not good news, especially when you have a threat of tariffs coming down the pipeline of this year.
Stevie Cohen, I'm actually pretty negative for the first time in a while. Tariffs cannot be positive. It's a tax. Put his name together with Ken Griffin. They're two very big names in this world.
And listen to some of the more bearish prognostication from even Warren Buffett, the man who's talking about American dominance and the incredible gift of being born in the United States. A very different tone over the weekend. At a certain point, they might be saying the quiet part out loud at a time where a lot of people are trying to justify surgical use of tariffs when they're being used in a whole host of different manners and threatened in a blanket type of way. I will just say, some people might say on a surgical level, tariffs are good and they can be used well. Right now, there is not a sense of what the ultimate goal is, and that level of uncertainty is making it very difficult for anyone to plan.
There's a couple of things to watch this week. There's two. One is earnings and the other's a data point. On the earnings front, Nvidia in the middle of this week. Later on in the week, the Fed's preferred inflation gauge, core PCE. Do you think we get a clear pass on PCE because we've had PPI, CPI, that ultimately it's not going to be a big surprise?
That's what a lot of people seem to think. We get personal income and spending alongside core PCE. Any incremental change to the upside, you can imagine people will respond much more significantly to. But right now, it doesn't seem like people are worried about longer term inflation. Right now, people are worried about the growth shock that could come, the growth hit that we can see with some of the data that's coming in less positive from a growth perspective. And so at this point, I'm not sure how even the bond market responds other than higher short end and lower long end.
The Fed seems to be on pause at the moment, and that's critical. For the Chicago Fed President Austin Goolsbee, he was asked about the University of Michigan survey and the fact that consumers do seem to be a bit concerned about inflation. He said this: it wasn't a great number, but it's only 1 month of data. You need at least 2 or 3 months for that to count. I think that's pretty much going to be the Fed throughout the entire first half of the year. Punt. It's only 1 month. We need more.
Apple, with some news already this morning in the first few minutes of this program, planning to invest over $500 billion in the United States over the next 4 years. Let's put some jobs on that. They will add 20,000 US jobs to begin producing Apple intelligence servers in Texas. A nod to the new administration.
And maybe trying to insulate themselves from coming under fire for their large presence in China, where they are increasingly partnering with local companies to try to roll out their artificial intelligence. A real question here about how substantive this is versus the signaling to a president that clearly is looking for transactional wins.
I'm not really surprised about this statement, maybe how quickly it came, because on Friday, President Donald Trump told us all of this. He said he met with Tim Cook and he's going to be investing all this money into the United States. Well, guess what? Here it is. What Tim Cook said in his statement, though, is we're bullish on the future of American innovation and we're proud to build on our long-standing U.S. investment with this. This is what you're going to see from a number of CEOs who are trying to make sure they are blunting the threat of tariffs as well. Does this potentially mean, you have to ask, does Apple get a carve out maybe somewhere else?
That stock in a pre-market right now down by a little more than 1%. We'll pick up on that story throughout this hour. Coming up through this hour, we'll speak to Bob Dole of Crossmark as stocks look to bounce back from Friday's losses. Ed Mills of Raymond James as Doge meets more resistance in Washington. And Holger Schmieding of Berenberg as Germany's conservative leader Friedrich Merz clinches an election win. We begin this hour with stocks pushing higher, looking to bounce back following their worst session so far this year. Bob Dole of Crossmark saying Trump has so far done the opposite of Trump 1.0 and policies potentially threaten risk to asset markets. Bob joins us now for more. Bob, welcome to the programme, sir. Bearish start to the conversation this morning. Make it constructive, will you? On Friday, do you think that was the start of a legitimate, justified growth scare in this country, or too much too soon?
No, I agree with you. The potential for a growth scare is sadly for real. You enumerated it. It's retail sales, it's housing starts, it's manufacturing production, the University of Michigan a survey. All of these things are saying, and just a second or two, we've had some pretty good growth over the last few years. Maybe we're going to take a little pause here. And what the only thing you didn't mention, in my view, from investor standpoint is, and valuations. 22, 23 times earnings. They're discounting a world that should be nearly perfect, and it's not. So I suspect we have some risk.
And you say that we have some risk based on the fact that we have high valuations and earnings that aren't keeping pace. How much of this has to do just with where we are in the cycle and how far we've come versus some of the policies that are coming down the pike?
It's a combination of both, sadly. You mentioned the policies. Look, you all been watching the opinion polls. A lot of people who voted for Trump, believe in his policies, are struggling with the pace and method of implementation. And so the polls for Trump are beginning to drop some. I suspect there's more of that to come.
We were talking about what we heard from Stevie Cohen over the weekend, saying that tariffs cannot be a good thing. Some people, like Jamie Dimon of JP Morgan, have talked about how surgical tariffs can be useful. And you hear a whole host of different business leaders really taking it in stride and saying they can manage through it. Where's the truth here?
Yeah, great question. Depends how they're used. Part of the problem, as you all have been inferring, is it's one thing one day, it's another thing the other day. Friday, a week ago, remember the word reciprocal tariffs came up. I got encouraged because, if you and I are trading with each other, you have a tariff on me, and I don't have a tariff on you. Reciprocal means I'm going to put a tariff on, unless you say, hey, wait a minute, I'll take my tariff off. So reciprocal tariffs have the possibility of actually bringing tariffs globally down. But that word lasted, about a day and a half, and then we move on to other things.
Well, over the weekend, President Trump said that he's still working on reciprocal tariffs, but the list is very long. We have March 4th when it comes to that pause between Canada and Mexico, March 12th when it comes to aluminum and steel. We get the report on April 1st from USTR and Commerce, and April 2nd we're supposed to get auto tariffs. But all of this potentially could be negotiating tool. What happens if this is just perpetuity of uncertainty when it comes to tariffs?
Well, you use the word uncertainty. Markets hate uncertainty. We all know that. And it comes back to it's complicated. It's requiring further study. It gets pushed out in time. And there are all kinds of trial balloons put up. We just need to take a pause, study this, have some conversations, and not just throw all kinds of stuff against the wall to see what will stick and what won't.
This morning, we also get news that Apple will plan to spend $500 billion domestically over the next 4 years, really a nod to President Trump. Do you think his carrot and stick approach is working when it comes to tariffs on one hand, but maybe better taxes and deregulation if you come into the United States?
It's possible. His intentions are good, in my view. The problem is the world, American businesses can't move on a dime like that and go this way today and that way tomorrow. So it's going to take a little bit of time. But in general, I think that's the approach.
That said, all of this sounds really bearish, but as John was saying, we're not going to dominate the whole show all day, maybe, with some bearish prognostications. You have the likes of Michael Wilson from Morgan Stanley talking about how, given all of what you heard, the U.S. is still pretty good. He said it's premature to conclude the rotation away from the U.S. is sustainable. Mislev Mateka over at J.P. Morgan having a similar kind of discussion over the weekend. Do you think that everything that you've laid out in this uncertainty really undermines the idea of American exceptionalism, especially at a time where you have Europe that still hasn't gotten its leadership coalitions fully intact?
I agree with your premise. That is, this doesn't get rid of U.S. exceptionalism. What it does is say there are cycles, and perhaps we're in the part of a slowdown in the cycle with all the things you enumerated at the front of the show, again, accompanied by high valuations. So we probably have a period of sidewise consolidation and maybe some pullbacks. Hard to see the market moving up 10% from here.
Hey, Bob, appreciate it. As always, sir. Bob Dole of Crossmart. Looking into an important week. Some earnings from Home Depot, from Nvidia, some data, core PCE, the Fed's preferred reach of inflation. And it hasn't been a great start to things over the last month, that's for sure. That move in bonds, yields lower for 6 consecutive weeks. We asked this question with Chris Ferrone earlier on in the month. We asked him whether that supports cyclicals in equities or whether it's something we should be worried about the cycle. And based on what the stock market is now telling us, Friday's session alone, then maybe you should be worried about the economy.
When you take a look at the actual data, you could see that consumer confidence has been falling, and you can argue about the political bent to the University of Michigan sentiment survey, but that's the reason why tomorrow's consumer sentiment data is going to be very important as well. Does it confirm that? On the flip side, there has been this feeling that we've priced in all the good news, and now we're getting some of the anti-growth or the sort of the brakes to growth policies coming out of the White House without a clear sense of how long it will take for them to get some of the tax cuts and the pro-growth policies through.
This can change. It's only February 24th, just to keep us all up to speed. We're going into what, week 5? Is it week 5?
Yeah.
I think it's the 5th week,
Fifth week
of the Trump administration. It feels like much, much longer than that. Equity futures right now on the S&P up by 0.5%. Some big news out of Apple this morning. Let's get you an update on that and stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Starting in Germany, where the conservative leader Friedrich Merz emerged as the winner in Sunday's election. According to the prelim results, Merz's center-right CDU-CSU alliance won almost 29% of the votes. Merz says that he will form a new government in less than 2 months. In D.C., the Trump administration sent emails to more than 2 million federal workers, ordering them to report on what they did last week or be forced to resign. The deadline to reply is just before midnight in Washington. Elon Musk said the directive came from President Trump. However, several agencies, including the FBI, NASA, and the Pentagon, have asked employees to hit pause on acting on the directive. Now, to that breaking news, Apple has said that it will add 20,000 new workers and produce AI servers in the U.S. The company plans to spend $500 billion domestically over the next 4 years. That will include work on a new server manufacturing facility in Houston and a supplier academy in Michigan. That announcement coming just days after Apple CEO Tim Cook met with President Trump in the Oval Office. And that's your brief, John.
Hey, Danny, thanks for that. More from Danny in about 30 minutes. The words of Tim Cook this morning. We're bullish on the future of American innovation. We're proud to build on our long-standing U.S. investments with this $500 billion commitment to our country's future.
With 20,000 new jobs over the next 4 years, it is the biggest U.S. commitment to date. In new reporting just out this morning, key question here, is this the beginning of more? How much is this trying to placate some concerns by Donald Trump?
Equity futures positive this morning by 0.5%. That stock is down by a little more than 1%. Up next on the program, Doge versus DC.
I think that there are many fine public servants, and if you don't move quickly, then the lobbyists get involved, the entrenched interest, and it's impossible to get anything done.
Can we get anything done? We'll ask Ed Mills of Raymond James next on the program, live from New York City this morning. Good morning. Equity futures positive here, up by 0.5%, bouncing back from the biggest one-day loss of the year so far in Friday's session. That loss driven by much weaker than expected economic data. In the bond market, 6 weeks of lower bond yields on a 10-year maturity this morning, just about unchanged. The 10-year 443.71. Under surveillance this morning, it's Doge versus DC.
I think that there are many fine public servants, and if you don't move quickly, then the lobbyists get involved, the entrenched interest, and it's impossible to get anything done. Anyone who has experienced financial hardship, any kind of the mental duress, I'm sorry for them, but that's also what the average American experiences every day.
So here's the latest this morning. Federal agencies, including the Pentagon and the DOJ, telling workers to ignore demands from Elon Musk's Doge team to justify their jobs after sending mass emails, Musk posting on X, quote, failure to respond will be taken as a resignation. Bloomberg's Tyler Kendall joins us now for more. Tyler, how much confusion was there in D.C. over the weekend? I think we've lost that audio. When we saw it at the microphone, we'll turn it up for you. Tyler Kendall there in Washington, D.C., who you could see but could not hear. Certainly some confusion over the weekend regarding Doge. They sent out that email, and I think the email read something like, tell us 5 things you've done over the last week, which maybe works in the world of information technology over on the West Coast. But if you're in particular parts of the U.S. government, you can't actually tell everyone what you've been working on over the past week.
Especially if you work in things that have to do with intelligence, and you actually cannot share that to the world. This is classified information, or potentially if you're doing something that legally could be an issue. I will say this is reminiscent of what Elon Musk did with Twitter. Very difficult to do across the federal government, which is why you have a number of people like those at the DOJ, Kash Patel at the FBI, according to the Wall Street Journal, telling employees, sit on this, do not respond. The subject line over the weekend, and believe me, if you want to see the confusion, you can just look into the text messages I received on my phone. Quote, what did you do last week? That's what Trump and Elon Musk want to know.
Well, the other thing, adding to this confusion, is that in the past couple of weeks, the directive from Doge actually said, don't necessarily respond to any of these emails. So it's such a crosswinds of directives at a time where a lot of people are worried that they are going to lose their jobs. Look, to the discussion we were having, it is important to strip away waste. The question is, how do you do it? And whether there is an ultimate goal, and whether you do it with some degree, as you pointed out, of compassion.
Ed Mills of Raymond James joins us now. We can extend this conversation. Ed, welcome to the programme, sir. Hopefully we can hear you, because we didn't hear our last guest. So hopefully we can hear you, so. Ed. Ed, there you are. Perfect. Wonderful. Ed, let's talk about the Doge effort over the weekend, sir. That email that went out. What do you think the consequence of all of this will ultimately be?
So, John, I want you to send me an email by midnight tonight, and if you don't respond, I get $1 million. I think that's one of the responses here in D.C. The question I have with this is that if you go into the executive order that establishes Doge, this is not within their charge. And so you are going to have a series of things, and this is a real issue here in D.C., as to who are you actually reporting to. And if you don't report, are there some legal consequences? Certainly everyone who wants to keep their job is looking for guidance of exactly what they are supposed to do with this under the executive order. Doge is supposed to be working on an upgrade to the IT system and support the chief of staff to the president, Susie Wiles. Doge does not set this out in executive order, but we keep on seeing expansion of that. And until we get some of the legal infrastructure around that, I think there's going to be a lot of quote unquote trauma and uncertainty here in DC. If you want to shrink the federal government, you can do that. We've seen that in the past. There are processes in place. Clearly, they want to move fast, as you saw Treasury Secretary Bessent say with your interview. However, it is unclear on if you move fast, is it more effective or not?
Ed, we have several government agencies, people that Trump put in place, people that everyone in a lot of mainstream media were calling serious loyalists, telling their employees to leave those emails on read. At the same time that Trump is tweeting out memes, one of SpongeBob SquarePants saying, "This is what I got done last week." Quote, cried about Trump, cried about Elon. If you're an employee at one of these agencies and you want to secure your job, what do you do?
You listen to your manager, because ultimately that is going to be what you kind of have to work with. But there is a lot of uncertainty. And, I think that when we look at kind of some of the, we've discussed the national security issues, the, classified issues, it is very kind of appropriate to have the Director of National Intelligence, Tulsi Gabbard, come out and say to the entire intelligence community, do not respond. There's just certain things that you can't. When you hear from Elon Musk through his posts, some of this is, are there government employees who are not on their email, are not responding to things? That's an appropriate thing to get a pulse check for individuals, whether or not they are engaged in their job. There have been individuals who've been told not to do their job. You look at the Consumer Financial Protection Bureau. There's been a number of folks told, stand down, don't work. So if you're in that position, how do you respond? But I'm also really looking, Anne-Marie, at what's going to happen here in D.C. We have a lot of to-dos in Congress this week. We're going to see at the end of the week, are they going to be able to fill out that 5-step thing? Did they pass a budget? Are we moving forward with the tax credits? Are we moving forward with that new defense and immigration spending?
Do you think the House will pass the budget this week?
I'm really skeptical. I think that, we have a situation where one or two members can sink the entire thing. We already have one hard no out there. When we look at this bill, I don't know if there's enough of a crisis or a deadline to get this done just yet. So I wouldn't expect it to kind of go clean on the first start, but almost nothing happens clean on the first start. I am expecting that more attention is going to go to the Senate-passed budget. Maybe that provides a quick win for the president on immigration spending, on defense spending, if they need a backup plan, if the House just can't get everyone on the same page just yet.
How much spending that you see being cut from the U.S. government is real versus just sort of theorized about? In other words, how much oxygen have they really saved by making some of these cuts in the federal workforce and announcing cuts to the Defense Department that haven't been approved yet and are sort of discussions at this point?
Yeah, at least at this point, it's very low. A lot of the savings that have been announced are contracts that have actually already been paid. So I want to see more kind of on a go-forward basis, how much that is going to kind of take into account. When we look at Congress, we're not quite sure when they are coming up with some of their budget cuts, how much are those paper savings, how much of those are real savings. I do think, though, there is a lot of momentum of making the tax cuts that passed in 2017 permanent. And I don't think they're going to be able to get $5 trillion worth of pay-fors, either through Doge savings or through some of the savings that Congress chooses. So having this conversation about how aggressive Doge is being, how aggressive we are going to be on tariff policy is providing political cover and groundwork to actually add to the debt and the deficit over the next 10 years, even when you've had this narrative that there's such a significant reduction in staff and savings of the federal government, Lisa.
Ed, thank you, sir. We're going to leave it there. Ed Mills there of Raymond James joining us on the latest Doge effort down in Washington, D.C., and a sprinkle of a little bit more. This from Elon Musk this morning, who might be following the conversation, saying the following out on X. Those who ignored President Trump's executive order to return to work have now received a month's warning. Starting this week, those who still fail to return to office will be placed on administrative leave. The latest from Elon Musk this morning.
This is the threat that if you don't get back to the office, you're not going to have a job. Just to let people know, I think about 60% of current employees, federal employees, are already back to the office. There have been others that are part-time in the office and part-time not. A key question about how much resistance this is, and also what kind of grace period if people are not working near their offices.
They've made it a mandate that they want everyone back to the office. Work from home is not going to work under this administration. And you hear that time and time again from the Oval Office, but also the head of those agencies. They want to see their employees, especially if you're dealing with national security concerns, they want to see you using the computers that they have control on inside those government buildings.
They've made that quite clear over the past month, that's for sure. Up next on the programme, Holger Schmieding of Berenberg as Germany's conservative leader, Friedrich Merz, clinches an election win over the weekend. That conversation up next, with the euro at the moment against the US dollar just about unchanged at 104.69. Live from New York City, you're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
If you are just tuning in, welcome to the programme. Equity futures on the S&P bouncing back from Friday's losses, up by 0.5%. Bigger bounce on the Russell. That's where the big losses were in Friday's session. We're positive by 0.9% there. Closing out last week on the S&P with the worst day of 2025, sending the S&P 500 to the biggest weekly loss going back to January 10th. Friday delivering a whole host of negative economic data, boosting the bond market's fortunes, yields lower across the board. Let's turn to the bond market. The 10-year maturity yields dropping there for 6 consecutive weeks, the longest weekly streak going back to June 2019. Sent the 2-year yield lower last week as well for a second consecutive week. The 2-year this morning, Lisa, 421.51.
You said it earlier, and I think it's important to repeat it, that yields are falling for the wrong reasons. And that's the reason why you saw on Friday the Russell 2000 underperform and the worst day on the S&P 500 going back to late last year. A real question about the services component of PMI coming in contractionary territory for the first time since the beginning of 2023. The prices paid increasing the most since 2022 in that sub-index. A real question here about how much of a realistic read this is through what's to come in the months ahead.
The dollar story has been a weaker one over the last several weeks. We've had 3 weeks of DXY weakness for the first time since September. Let's check out the euro. Euro dollar bouncing only a little bit following the German election over the weekend, 104.67. I think a lot of people stateside just have one very simple question. Does it mean they can spend more? And based on what we've seen on Sunday, that won't be easy.
They don't have the full mandate, and they do have to get some of the fringe groups on board in order to pass some sort of new amendment that removes the debt brake from the Constitution. A real question here about how they do that without making concessions that potentially are unpalatable for the ruling coalition.
We'll catch up with Ollie Crook a little bit later in about 5 minutes' time, who's on the ground leading our coverage in Berlin, Germany. On our radar this morning, federal agencies are advising employees to ignore emails from Elon Musk's Doge team, demanding they justify their jobs. The Pentagon, DOJ and the Department of Health and Human Services telling workers to pause on replying to the emails.
So Elon Musk has this subject line, what did you do last week? And he wants these 5 bullet points to explain, basically justify your position and your job in the federal government. Now, if you want to give some credence to what they're doing, potentially then they could look at what everyone else is doing and see maybe where there's overlap in the U.S. government. The issue is a lot of people in the U.S. government, if they respond to this, it could be illegal. Maybe they can also give away some classified information. So the heads of those agencies are saying, stop, this has gone too far. We need to recalibrate. It remains to be seen then what comes next.
All I can say is Senator John Curtis, a Republican from Utah, said over the weekend, and I want to quote his own words because he is a supporter of Donald Trump. These are real people. These are real lives. These are mortgages. It's a false narrative to say we have to cut and you have to be cruel to do it as well. We can do both. There are ways to improve the efficiency of government without being arbitrary and somewhat mean about it.
We talked about it a few times on this programme, talked about it with the Treasury Secretary. You mentioned it earlier. Are we doing this with dignity for these workers? I've seen some pushback from both sides of the aisle, not just Democrats, from Republicans too, as you suggest.
At this point, there is a real question also of what the ultimate goal is and the consistency, the whole concept of due process in law. How do you apply that in a way where there is a predictable framework for the ultimate goal and the process by which it will be administered?
We'll stay on top of the headlines down in Washington for you throughout this morning, including the latest on this effort. The French President Emmanuel Macron set to meet with President Trump at the White House later today. The UK Prime Minister Keir Starmer also heading to DC later this week. European powers trying to secure a role in Ukraine peace talks between the US and Russia.
So united front, I think we're going to see from Emmanuel Macron and Keir Starmer. Our reporting is that actually these two men were coordinating their objectives with a phone call yesterday. So before they went to Washington, D.C., they spoke about what do they really want to hammer home in the Oval Office to President Donald Trump. It's going to kick off actually very soon, in the next 90 minutes. Macron will join Trump as they talk to G7 leaders. Of course, this comes marking 3 years of the war in Ukraine.
I'm curious what the relationship will be between Donald Trump and Emmanuel Macron in particular, because we've heard a little bit of the back and forth between Keir Starmer, but this hasn't been a government that has really embraced some of the stalwart leaders in Europe, especially if they're on their way out. So there is a real question here about what this will look like.
So this is the UK and France, so we still need to put together a government in Germany. We're told they're going to try and do that really quickly by Easter.
Yeah.
Yeah, so on everyone else's clock, maybe not that quickly.
2 months is when they want to put a German government together. When I heard that last night, and I was talking to Oliver Crook last night, we were texting each other, I said, 2 months? They have tariffs to deal with. They have potentially, Trump wants a peace agreement on Ukraine ASAP. 2 months. They're going to be very far behind on where Trump is on his timeline.
The continent could look very different in 2 months. If you haven't seen the results, these are the results. Germany's Conservative leader, Friedrich Merz, and his Christian Democratic Union Party emerging as the winner of Sunday's snap election. But Merz seeing a narrow path to power, partnering with Chancellor Olaf Scholz's Social Democrats, potentially. Joining us now is Bloomberg's Ollie Crook out of Berlin. Ollie, let's start with the results. Any surprises there whatsoever?
Listen, John, I think that overall this sort of came in sort of accordance with what we were expecting. These polls really had been basically unchanged since November when they pulled the plug on the government. And we saw that sort of reflected in the sort of numbers that we got last night. There was a little bit of sort of move around the margins. For example, I was at the CDU headquarters last night where Friedrich Merz gave his victory speech. When the numbers dropped, they came in at about 28%, 2 points below what was anticipated. There was not really a high amount of excitement in the room. And I spoke to a number of lawmakers. They obviously are going with this as a sort of strong victory and that they have a strong mandate. But the reality of the situation is, yes, they are able to build a government with only two parties. This was one of the big concerns for the markets in the sense that basically you could end up with a three-party coalition that's as clumsy and not as ideologically aligned as the last one, which required them to basically dissolve the government ahead of time. Now they can do it with two. But the reality of the situation is, for those people who are waiting for a sort of fiscal shock and awe, they're going to be waiting potentially a very long time. This is not as straightforward in terms of the CDU being able to get its pro-business agenda through. The SPD, despite having done the worst basically that it's ever done in its history, now is still holding quite a few cards because they are really the only viable coalition partner for the CDU. And as you were just pointing out, we are talking about a moment here where in the United States, Donald Trump has been president for only about a month. Think about what another 2 months means, if that is the amount of time it's going to take to get a government in Europe's biggest economy.
Especially when you have Friedrich Merz coming out and saying that this American government, at least, quote, are largely indifferent to the fate of Europe. Europe, and he said the world will not wait for us. So then why are they waiting 2 months? 2 months in a Trump news cycle, Oliver, I don't need to tell you, is basically a lifetime.
Listen, I think that you could take this as emblematic to some of the larger problems with the German economy, right? Which is basically sitting a little bit further back and not being proactive. You see it with the auto industry. Why wasn't the German auto industry one of the most proactive to electrify and be ahead of the curve? They were being a bit complacent. This is a bit the story politically here for Europe. If it's going to take 2 months to put together a government, it could even take longer, right? This is a sort of optimistic timeline for them. And the reality of the situation is, though, for Friedrich Merz, despite the fact that he did tack a bit more to the right, certainly on the issues of immigration, in order to try to sort of pull support from the AfD. As far as Europe is concerned, as far as solidarity within Europe, Friedrich Merz is very pro-Europe. He's a former MEP. He's sat in the European Parliament, and he's been sort of emphasizing that overnight, basically saying that Europe needs to try to get a seat at the table, but basically they can't ever get that seat by begging. Those were his messages yesterday, and that basically you need to have a much more unified Europe and a much more strong Europe. The question is, how do you achieve that if you're not willing to move on some of the stimulus domestically? And again, the big question, will he eventually be forced to go to Brussels, talk about joint debt, potentially to get that defense spending up? That still seems like a distant prospect, but that could be a way to make a major step forward, and for Germany, frankly, to have a very large hand in shaping the future of the European Union.
Ollie, appreciate the update over in Berlin, Germany, following the election results yesterday evening. Joining us now to extend the conversation, Holger Smeeding of Berenberg. Holger, as you know, a lot of investors stateside just have one question. Will this mean Germany can spend more? So I'll ask you that one question, Holger. Will the results over the weekend complicate that effort?
The results actually complicate this effort because we now have the parties at the extreme, at the right-wing fringe of the spectrum and the left-wing fringe of the spectrum. We have the AfD and the Left Party together with more than 1/3 of the seats in the federal parliament. And that means these two parties can veto any change to the constitution, can veto any change to the German debt brake. And so this is a result that was possible, but that did, according to opinion polls, not look like the most likely outcome. It doesn't really matter that much whether Friedrich Merz and his party got 30% or 28 point something percent. What matters is, do they have scope for a serious change in fiscal policy? And that is now even a bit more difficult than it seemed before, because to get either the AfD, a party to which nobody else wants to talk, or the Left Party to agree to a reform of the debt brake would be very difficult. For example, the Left Party would love to issue more debt, yes, but exactly for the wrong purposes, for more welfare. They would like to keep borders open, exactly the opposite of what Merz wants, and they would like to cut defense spending, exactly the opposite of what Germany needs. So finding an agreement so that parties, all in all, with more than 2/3 of seats in the Bundestag, do actually vote for a reform debt brake is going to be very, very difficult.
So, Holger, without the reform of the debt brake, what kind of fiscal space does Germany actually have?
Well, there are ways around it, of course. For instance, Germany could declare a national emergency by a simple majority in parliament. Problem is that national emergencies are by their very nature temporary. You cannot put the long-term secure funding of the military on a safe basis by having an emergency. There is a small chance that if the Germans are really, really fast, that the outgoing parliament, where there would be a majority for the parties that might possibly want to reform the debt brake, that this old parliament still does it, but there are serious legal technical hurdles ahead of that. And as already mentioned, one way around this would be to have the European level finance more, but that with an unchanged German constitution would also not be easy, or more precisely, would have to be very specific, would have to be limited, because otherwise, for simply a lot of Eurobonds for a long time, the German Constitutional Court, judging by how it has ruled in the past, would also say no. So the German fiscal situation is complicated. There are ways to raise federal spending, but it's not easy.
What are some of the concessions that the ruling party would have to make in order to get some of the fringe parties on board to pass either an amendment, that 2/3 required to pass an amendment to remove the debt brake, or to, as Friedrich Merz promised, achieve independence from the U.S.?
Well, to change the debt brake, you need this 2/3 majority. And sort of, as I tried to say, to get the left party on board is very, very difficult. They would like to ditch the debt brake, unlike Mr. Merz, who might possibly want to just reform it. But the left party wants to do exactly the wrong things with the money, and to get them to agree to doing the right things with the money. That is to have a pro-disarmament party agree to a major lasting rise in military spending, and that for a purpose confronting Russia and Ukraine that this left party does not share would be very difficult. And if Merz had to compromise on his pro-growth reforms, for instance, by having more welfare and higher taxes on the rich rather than the opposite, that would compromise his urgently needed pro-growth agenda. So once again, it is possible, probably. There are ways around this debt brake issue, but it's going to be complex and not easy and probably not fast.
When you put it all together, Holger, are you more optimistic or less optimistic than you were on Friday about the prospect for the German economy in the next year and 2 years ahead?
Relative to what the opinion polls had projected on Friday, I'm slightly less optimistic. I remain optimistic that Mr. Merz will be able to implement pro-growth reforms, but it will be more difficult rather than easier for him to actually get the fiscal space for the things that need to be done, such as business tax cuts and secure long-term funding for the military. These are serious questions ahead.
Holger, appreciate your input, sir, as always. Holger Schmieding there of Berenberg. President Donald Trump has been pretty consistent on the issue for much of the last decade. He's been justified in making the push, pushing the Europeans to do more for themselves. The effort over the weekend, the outcome of that election, it's going to complicate that push.
Because it's going to be that much more difficult to remove the debt brake. I love what Mario Draghi said a couple of days ago. You can say no to public debt. You can say no to the single market. You can say no to create a capital market union. You can say no to everything. But at a certain point, what are you going to do? And he's saying, I have no idea, but do something. And that, I think, is what a lot of people are wondering, how that's going to happen.
Listening to Holger, it sounds like it's going to be a lot harder for them to then increase military defense spending. And that is going to infuriate Donald Trump, because he has made it crystal clear in Trump 1.0 and now coming to Trump 2.0, he wants an even higher NATO defense spending per each of these countries, maybe as much as 5% of GDP. How does Germany do that if they don't have the fiscal space?
That push will continue, that's for sure. If you are just joining us, welcome to the programme. Equities bouncing back from Friday's losses, higher by 0.5% on the S&P 500. With an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of Berkshire Hathaway are higher by 1.1% in the pre-market trade. Over the weekend, it reported earnings, with operating earnings surging 71% in the fourth quarter. Buffett's cash hoard also grew for a 10th quarter in a row, now standing at a record $334 billion. Ukrainian President Volodymyr Zelensky says that he is willing to step down if it means peace and NATO membership for his country. Zelensky says it's clear that he wouldn't be in power for decades and would happily make that trade if the offer was made. Pope Francis remains in critical condition as he continues to battle severe pneumonia. The Vatican says that the 88-year-old pontiff is still receiving high-flow oxygen to help with his breathing. Some blood tests show an initial mild renal failure, which is currently under control. The Vatican says the Pope continues to be alert and well-oriented. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the programme, bracing for higher prices.
If tariffs raise inflation by 0.5 point and we end up with 2.9% inflation, it may be that Americans aren't really noticing it quite as much as they did a couple of years ago, but the Fed will certainly be noticing it.
We noticed it on Friday in the UMich survey. How reliable is that economic data? We'll get to that with Nita Richardson of ADP in just a moment. From New York, this is Bloomberg. Good news if you're working for Andrea Ocel over at UniCredit and you're a top manager. He's lifting the bonuses for top managers by 11% after a record year. All right? So just sprinkle of good news out there.
Like 5 people with little, celebratory hats and yay.
might be hungover after a long weekend. I don't know. Equity futures right now positive by 0.5% on the S&P 500. In the bond market, yields just about unchanged. 443.90. This run of gains we've seen. 6 straight weeks of lower yields on a 10-year yield. The economic data was not good on Friday, and that contributed to the move going into the weekend. Under surveillance this morning, bracing for higher prices.
If tariffs raise inflation by half a point and we end up with 2.9% inflation, it may be that Americans aren't really noticing it quite as much as they did a couple of years ago, but the Fed will certainly be noticing it. The Fed's not cutting rates in a world with inflation like that, and in fact, it might even be raising them.
So here's the latest. UMich sentiment showing consumer inflation expectations jumping to their highest level in almost 3 decades. Survey responses, mostly along party lines, showing new inflationary concerns about President Trump's tariff policy. Joining us now to break it down, Neela Richardson of ADP. Neela, good morning.
Good morning.
Got to start with you, Mitch, on Friday. How reliable is that economic data? How much weight should we put on that?
I think it gives you good situational awareness. Should you create monetary policy around it? No, I don't think so. But in terms of where the consumer is going, what they're thinking, and tracking that every single month, I think it gives you a benchmark or at least some context for how consumers are feeling. We can't interview every person on the street. If we could, we get, more real-time data, but it's a survey. There's luckily other things from the Fed about consumer expectations from the New York Fed and other Fed banks that we can also use to support this data. But I think if we take from it that consumers are still feeling inflation and it's dampening their sentiment, I think that's a great piece of information to move forward to and think about the economy in a broader context.
We've been pretty bearish. I've gotten a couple of emails, people saying, really, this is coming back. And on the flip side, there's a lot of optimism among businesses. See, I'm actually being positive here. And even though you have consumers that feel negative, the optimism among small businesses has skyrocketed. So which is more important to hiring and to the overall economy? If people have jobs, what they do and what they say are going to be different things.
What they do and what they say are different things, and I think it's a matter of timing because feelings do translate into action. And if consumers are feeling bearish about this economy, it matters for hiring because it's a consumer-driven economy. Consumers are driving the industries that are surviving and thriving right now: leisure and hospitality, healthcare, which includes a lot of discretionary procedures as well, like dental work, for example. So, we can't discount the consumer mood and the consumer vibe. At the same time, it's encouraging to see small firms feeling optimistic because small firms are the engine of growth for the economy. So what are they optimistic about? I think they're optimistic about perhaps lower interest rates, lower financing costs, maybe an easier hiring environment vis-a-vis larger firms who have outmanned them in recruitment and talent. And maybe there's a feeling of less regulation going into this new year, new administration, that gives them some tailwind to their spirits, so to speak.
Is there a sense that the negativity in consumer sentiment could persist for a very long time and it not be felt in the broader economy? And I say this because there was a data out of Moody's that said that the top 10% of U.S. earners now account for about half of all consumer spending, that actually in the period, in the year ended September 2024, they increased spending while the rest of the earners decreased spending. Can this continue for a while because people at the top are feeling pretty good?
As long as asset prices hold up. So if you are a wealthier consumer, some of your optimism and your spending patterns are based on the fact that assets have been really strong over this time period. So while lower income consumers are feeling inflation in a very visceral way. I mean, I was in Louisiana where the price of eggs were over $10 because of the bird flu. You're going to feel that as a low-income consumer. But if asset prices stay strong, you may not feel the same pinch as a high-income consumer and can keep, that fluidity in that spending. But yes, the fact that this is a lopsided consumption market is a very real thing. If asset prices turn sideways, that changes the dynamic for the economy.
That's a tough anecdote and something this administration or any administration, Biden, Trump, very challenging to do because what's going on with the bird flu. Something else that struck me with the University of Michigan survey was that more than half of consumers expect the unemployment rate to rise over the next year. Do consumers think they might be out of a job?
We're seeing that in the turnover rates. There is some anxiety perhaps on the worker side. I mean, everyone's seeing the headlines on the federal government and what's going on there, but we don't really talk about what that could mean for the private sector. And from what I'm hearing anecdotally and what I'm seeing in the ADP data, and we've saw that before the new year and the new administration, is that people and workers are staying put. There's a sense that the economic prospects, the job opportunities aren't as plentiful as they were 2 years ago. It's taking longer to get a job. It's taking longer to find a white-collar job. We've seen business services retract their hiring. New college graduates are taking longer to get a job. And there's a sense that maybe I should stay with the employer I have. Also, with the Great Resignation, a lot of people switched like 2 years ago, and they're not ready to move. So that turnover is having an effect on the labor market, and it's leading to the stasis that we're seeing. It's like the quiet before the storm in some sense.
Andrew Honhorst of Citi talked about the same thing, this low churn dynamic in the labour market they think is inconsistent with a healthy labour market.
If the market is strong, you should be able to quit your job. And that's why people are watching quits come down to some of the lowest levels since the pandemic. And that's the reason why some people are saying it could portend something less positive.
Focused on jobless claims as well at the moment, aren't we? Every single Thursday at the index level, things are still OK. Beneath the index, just focused on Virginia, Washington, D.C., certain places, are things starting to break.
And people put out reports over the weekend of the proportion of federal workers that work in the D.C. area. It's about 20%. So people are going to be looking at specific counts in specific counties to try to understand how this is trickling into numbers to get a broader sense of how to even frame this in conversation.
The estimate for Thursday morning, by the way, is 221. The previous week was 219. Neela, good to see you. As always, thank you. Neela Richardson there of ADP. Up next on the programme, Matt Stuckey of Northwestern Mutual, Henrietta Trays of Vader Partners. Will catch up with the former senior advisor to President Biden, Amos Hochstein, and Earl Davis of BMO.
The starting level of yield is still quite attractive, and risk assets are still quite rich.
We still believe that the Fed is much more sensitive to labor market weakness.
If the labor markets really deteriorate, we would expect the Fed to react in a strong way.
The single most important economic data point right now is unemployment claims.
35,000 feet, the labor market still looks really good.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, the second hour of Bloomberg Surveillance starts right now, and your week ahead looks like this. It concludes with the Fed's preferred read of inflation, core PCE. That comes on Friday. Lots of earnings in between, two big ones. The big one is Nvidia on Wednesday. But look out for Home Depot on Tuesday. Some reads around the US consumer. Not satisfying. Disappointing on Friday. Let's see if that continues. And that was reinforced by the weaker outlook from Walmart as well last week. That dragged US stocks lower, the biggest one-day loss on the S&P 500 so far this year. Equity futures bouncing back by just 0.5% on the S&P 500 this morning. Big losses on the Russell. Going into the weekend, we bounced back this morning, Bramo, by just 0.8%.
I like how you framed both Home Depot and Nvidia. They're two pillars of the American exceptionalism story exemplified. On one side, you've got consumer spending, albeit challenged in the housing sphere with Home Depot and some of those renovations. But then in Nvidia, this idea of how much can chips and the AI hope and dreams that we've seen really power that U.S. exceptionalism. To me, that might be the key moment for markets that are still hinged on the idea that U.S. tech can keep outperforming.
When it comes to the consumer, how much are they concerned with the tariffs that right now, only thing we have certain on is the 10% on Chinese imports? There's a long list of diary dates we need to keep an eye on in terms of whether or not these tariffs are going to come into play. Walmart, in their outlook, acknowledged that there are still uncertainties related to consumer behavior and global economic and geopolitical conditions. Without saying it, they said it. They are unsure about what the tariffs could mean, even if it is going to be a one hit on inflation and prices.
Sentiment was sky high coming into 2025, particularly for small and large businesses. For the C-suite, for CEOs, we said repeatedly on this program, we don't want to see that squandered. We want to see some follow through, some investment decisions, some hiring decisions. We get some of that from Apple this morning, with Mark Gurman reporting suggesting Apple will hire 20,000 new workers and produce AI servers in the United States. The company plans to spend $500 billion domestically over the next 4 years. So how does this compare to previous plans? Mark's saying this, that Apple is going from investing $86 billion a year to $125 billion in the United States, and from hiring 4,000 R&D employees a year to 5,000 based on its prior 5-year commitments compared to the new 4-year commitment.
Back in 2021, Apple released a statement saying they were going to invest about $500 billion and hiring some 20,000 people in the United States, reaccelerating. This sounds like it's bringing it forward. A key question here is, how much does this really highlight what we're going to see on an ongoing basis, which is companies sort of gussying up some of their ideas and their plans to try to curry favor with the president without us getting a sense of how much this is a difference from what was announced and what was planned, say, a year, 2 years ago?
Who's the audience for the announcement? Investors on Wall Street or politicians down in Washington, D.C.?
Given they already announced such a big chunk of this years ago, to Lisa's point, this feels like icing on the cake with an audience of one, and that's Donald Trump. And guess what? He already told us on Friday when he was speaking to a group of governors that he had left a meeting with Tim Cook and he plans to do this. Why is Apple doing this? That's the question. Probably because, like in Trump 1.0, they're looking for carve-outs when it comes to tariffs.
The Wall Street Journal wrote an editorial over the weekend, and the first line of it I thought was applicable to a lot of different announcements and things we've been hearing. The Trump administration is moving so fast, it's hard to know what's real and what is a media panic. It is hard to know what is actually concrete and different from before versus something that is simply signaling. And I think that is what we're going to be trying to figure out for a while.
There's always a lot of media panic. Always. There was 8 years ago, right?
Yeah. Well,
panicking about just about everything.
Right. And so at this point, it's hard to know what's real and how much this is actually going to be carried through on all sides, whether it has to do with job cuts, whether it has to do with investments.
We're going into week 5. Just week 5. The way people talk about it, it's like we've been doing this for months. It's week 5. Coming up on the programme, Matt Stuckey of Northwestern Mutual looking ahead to Nvidia results. We'll catch up with Henrietta Trays of Veda Partners on the odds of one big, beautiful bill, and the former senior advisor to President Biden, Amos Hochstein, on securing peace in Ukraine. We begin this hour with stocks looking to recover their worst day of the year. Traders awaiting Nvidia earnings on Wednesday and core PCE on Friday. Matt Stuckey of Northwestern Mutual writing, mega caps are ploughing into AI. It's a big tailwind for near-term economic activity and long-term productivity. Matt joins us now for more. Matt, welcome to the program, sir. Is it a big tailwind for Nvidia?
Well, it certainly is. And if you're looking at kind of what the hyperscalers are spending money on, it is NVIDIA chips. And so, ratcheted up CapEx expectations as you look to 2025 and what's been happening in the last few years has kind of falling directly into NVIDIA revenues. And we expect that to continue.
How crucial is the NVIDIA report on Wednesday, Matt, to really give fuel to this story that we've seen about big tech really being the center of the AI dreams and hopes and continuing its meteoric rise?
Well, it's a large piece of the S&P 500, as you know. And then when I came in this morning and was looking at the eco function on my Bloomberg terminal, I didn't see the NVIDIA earnings report listed there, but it might as well be on that number just in terms of its importance in the U.S. economy and its overall kind of impact and what separates the U.S. economy from the rest of the world. In terms of kind of the earnings story of the United States relative to the rest of the world, it has been driven by big tech, and NVIDIA is a huge component of that.
Matt, just more broadly, we started this show on a pretty bearish note, people talking about what happened, people meaning us, what happened on Friday with some stagflationary data in a sense that momentum was hitting the pause button. How much do you see this as just sort of a momentary blip versus a real shift in narrative that's affecting how you plan to position going forward?
I think, Lisa, I would classify this more as churn versus trend as it relates to kind of what we saw in late last week. And really, if we're kind of on lookout for sources of corrections, really there's two I would point to. One is a ratchet up higher in interest rates or a ratchet up higher in unemployment. With the labor markets, somewhat resilient here, and the forward indicators, whether you're looking at small business confidence, the Conference Board hard easy numbers, or overall just the consumer spending profile, which has been firm, outside of kind of some softer retail sales in January and so far. Looking at what's left in terms of correction possibilities, it's interest rates is where you're looking at. And in my mind, if we have a little bit of a softer start here in Q1, I think that helps kind of keep the interest rate kind of upside breakout potential somewhat more muted. And to me, so this is kind of more of a consternation, more of a churn dynamic versus more of a trend, if you want to call it that. Just looking ahead, I would say January, again, you look at one of the coldest Januaries we've seen in more than 130 years. I think that really impacts some of the spending numbers and some of the softness we've seen so far.
Matt, there's a note this morning from an analyst about Microsoft that they think will be canceling leases for a substantial amount of data center capacity in the United States. That begs the question, and potentially, are you cautious about this, about the outlook for demand when it comes to AI? NVIDIA to me has a large list of customers. Microsoft's being, a big spender in the AI story. But look, in terms of kind of what else is out there in terms of the overall kind of investment, we've heard from Meta, we've heard from Google, we've heard from Amazon ratcheting up CapEx expectations, and the announcement this morning from Apple also confirming their desire to continue to build out AI compute capacity. Of course, you're always kind of looking at the risk that there's some cyclical correction in terms of AI compute demand if, for whatever reason, we don't see the follow through in terms of productivity enhancements roll out to the broader set of the economy in the coming years. But as it stands today, the checks into the NVIDIA quarter were very strong, and the product transition moving from Hopper over to Blackwell seems to be kind of moving forward fairly well. Do you think there is still, though, this nervousness or angst in the AI space when it comes to what China is doing, the money that they're throwing at their AI development?
I think that it's certainly a risk that's out there. It's not as much of a direct risk, though, for NVIDIA's revenues. With export restrictions that are in place for U.S. semiconductor companies selling into China, higher competition there means that U.S. companies also need to be aware of that competition and spend more on their own AI roadmaps to compete with China. To me, I don't think that's necessarily a direct negative for the overall kind of AI story. It just means that there's more competition, which to me means more spending.
Hey, Matt, appreciate it. Looking ahead to those earnings on Wednesday. Matt Stuckey there of Northwestern Mutual. NVIDIA results drop in on Wednesday after the close. Look out for that. Data-wise, looking out for jobless claims later this week and PCE, the inflation read for the Federal Reserve on Friday. Got to pick up on this bond move, though, over the past 6 weeks or so. 6 consecutive weeks of falling 10-year yields. And I'll go back to that question that Chris Verona, strategist, asked on this programme in the last few weeks. The lower bond yield supports cyclicality or suggest growth is slowing. On Friday, I think we got a definitive answer for that session alone.
Which is unfortunate when paired with this sense that maybe inflation is going to be a bit more sticky, which is the reason why you're seeing yield curve flattening. And if you get that continued sense, it is absolutely a negative thing for a lot of equities, which is what we saw with the Russell 2000.
The complete opposite of what people were expecting closing out 2024, kicking off 2025. Yields down every single week of the presidency so far. Not up, lower.
This has to do with two things. First of all, we're getting some of the tariffs and some of the less growth-focused policies from Donald Trump to start the year. We also are just entering a later cycle of this economic period. But then on the flip side, there's a real question here of what some of the offsets will be, what some of the investments will be, and how much people can make those given some of the uncertainty.
Bond yields just a touch higher this morning, up by close to 2 basis points at the front end of the curve. Let's call it 421 on a 2-year yield. On a 10-year, just about unchanged at 444. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Ukrainian President Volodymyr Zelensky said the U.S. dropped its demand for Kyiv to pay $500 billion to compensate for prior U.S. support. That demand had been part of the talks to give Washington a cut of Ukraine's mineral wealth. Zelensky insisted, though, that U.S. military support must be part of any deal. He went on to reject the U.S. argument that American companies doing business in Ukraine would serve as a form of security guarantee. Over at UniCredit, the bank is increasing its bonuses for top managers after a record year. People familiar say the bonus pool for so-called material risk takers will increase by 11%. The Italian lender is also planning to raise the average bonus for staff by 20%. Researchers at the Wuhan Institute of Virology in China say that they've discovered a new coronavirus in bats that enter cells using the same gateway as the virus that caused COVID-19. According to the journal Cell, the finding raises the possibility that this new virus could spread from animals, though it has not yet so far been detected in humans. And that's your brief, John.
Danny, thank you. Appreciate it. Kinda, with the exception of the last story. How many people turned around on Friday and over the weekend when they read this for the first time and just said, nope, not doing that?
Literally, that's exactly what I was going to say. My oldest son turned to me. He's like, if there's another lockdown, I'm not doing it.
Close the laptop. Don't want to read about it. Don't want to hear about it.
Not having anything to do with it.
Basically, we can't do this again. And the market was saying, well, maybe we should.
Well, we'll talk about it
exactly.
in about 60 minutes from now. So maybe you want to turn down the volume. Jeff Meacham, Global Head of Healthcare at Citibank, joining us on some of the vaccine makers and the latest story out of China. Up next on the program, attempting to secure peace.
Standing here and saying, you're good, you're bad, you're a dictator, you're not a dictator, you invaded, you didn't, it's not useful, it's not productive. And so President Trump isn't getting drawn into that in unnecessary ways. And as a result, we're closer to peace today than ever before.
Bloomberg's Tyler Kendall joins us next in the nation's capital, live from New York. This is Bloomberg. So this right here is your bounce back in equities. We're up by about 0.5% on the S&P so far this Monday morning. In the bond market, yields just about unchanged. The 10-year 443.71. Under surveillance this morning, attempting to secure peace.
My question is, does all the finger pointing and pearl clutching make peace more likely? Standing here and saying, you're good, you're bad, you're a dictator, you're not a dictator, you invaded, you didn't, it's not useful, it's not productive. And so President Trump isn't getting drawn into that in unnecessary ways. And as a result, we're closer to peace today than ever before. And I've been privy to these conversations. Great progress is being made. Zelensky should come to the table because this economic partnership is an important thing for the future of his country.
So here's the latest. Defense Secretary Pete Hegseth avoiding calling Russia the aggressor in the war in Ukraine. The United Nations is set to vote today on separate resolutions to stop the war drafted by Ukraine and the United States. Bloomberg's Tyler Kendall joins us now for more. Tyler, it's a new approach from a new administration.
Right, John. Well, it's also the latest example of what has become strained transatlantic relations with Washington. And we could see one of the first meetings here in Washington today from these rising tensions when French President Emmanuel Macron visits the White House. President Trump criticized the French president as recently as Friday, calling him a friend, but saying that he's had a seat at the negotiating table when it comes to Ukraine for the last 3 years, of course, a sentiment that has been met with widespread criticism among our European allies. Now, the French president did preview some of what he might tell President Trump, saying that any concessions to Russia could be viewed as a sign of weakness and that he would tell President Trump, quote, that is not your trademark style. We also know that he is expected to tie what an emboldened Russia in his terms could mean for an emboldened China, of course, another one of the White House's priorities. But, John, really, this Trump administration looking for firmer European-led security guarantees as well as a boost to NATO defense spending. If we keep on France as the example, of course, France spends about 2% of its GDP when it comes to military spending, a number that this White House would like to see higher.
Tyler, we've seen Emmanuel Macron fail in the past with Trump, trying to keep Trump 1.0 in the Paris Climate Accord, trying to keep Trump 1.0 in the JCPOA when it comes to the Iran nuclear deal. What is his strategy going into this meeting today with the president?
Right. But also, of course, we did see the French president invite President Trump in one of his first visits after he was elected to Paris for the reopening of Notre Dame. We do know that the French president is coordinating closely with his UK counterpart, Keir Starmer, who is also expected to be here in Washington later this week, and that we are expecting the pair to put forward that they are ready to up those security guarantees. You heard in that sound played earlier there that this White House is looking particularly for Ukraine to sign that deal when it comes to an economic cooperation agreement and opening up Ukraine in order to be able to get their critical minerals. That is also something that we are expecting to be discussed this week in Washington as these European allies try to push the Trump administration to give forward some sort of guarantee that they will remain in the region moving forward. It's something that we saw became a big point of contention during the Polish president's visit over the weekend when he met with President Trump on the sidelines of CPAC. He did emerge from that meeting saying that he had a sense that President Trump was not going to pull troops, at least out of Poland, of course, the closest ally to Ukraine's border.
Tyler, appreciate the update down in Washington, D.C. Tyler Kendall there in the nation's capital. Here's an update on the latest from Apple. If you are just joining us, some news about 1 hour and 20 minutes ago that Apple will hire 20,000 new workers and produce AI servers in the United States. The company planning to spend $500 billion domestically over the next 4 years, including work on a new server manufacturing facility in Houston and additional spending with its existing suppliers. What does this mean relative to what we've already heard over the last several years from Apple? Mark Gurman, our star reporter here at Bloomberg, saying that Apple is going from investing $86 billion a year to $125 in the US, and from hiring 4,000 R&D employees a year to 5,000, based on its prior 5-year commitments compared to the new 4-year commitment announced this morning. The president responding to that new commitment, saying the following: Apple has just announced a record $500 billion investment in the United States. The reason? Faith in what we are doing, without which they wouldn't be investing 10 cents. Thank you, Tim Cook, and thank you, Apple.
So this goes to the heart of the question: how much is this actually a massive ramping up of Apple's plans versus signaling to President Trump saying, look, we're doing our part. You can celebrate this as a win. Now you can not penalize us potentially for doing business outside the U.S. and having production in China.
This is a slight acceleration of prior investments, how Mark Gurman talks about it on Twitter, from their April 2021 announcement of how much they were going to move some jobs and investment into the United States. But for Donald Trump, he is going to sell this as a record brand new investment. It's not. There's a little bit of nuance and a caveat we need in this truth, which we're not exactly getting.
To extend the conversation, Henrietta Trace of Vader Partners joins us now for more. Henrietta, the objective of this administration has been pretty clear on the economic front coming into power. They were going to make life very easy and very simple if you invest in America, and difficult if you're trying to export into America. Apple's making an investment decision this morning to invest more on the margin, to hire more on the margin. To help that a little bit more, they talked about lowering the corporate tax rate. Henrietta, where are we on that front? And what's the timeline for the tax bill now?
Great segue. I didn't see that coming, but happy to talk taxes. The corporate tax rate reduction is something that scores really well from a dynamic perspective, meaning when the House Republican Conference released its budget, they are telling the American public that keeping taxes at their existing rates for individuals will boost the U.S. economy by $3 trillion. They're not going to get a score from any government official or JCT or CBO that suggests that that's remotely true. The real number is somewhere $379 billion, if I recall. But if you're able to cut the corporate rate or bring any tax preferences for businesses into the equation, you do generate more dynamic scoring. So it's expected that you'd hear jawboning about reducing the corporate rate. Every percentage point costs $150 billion. They're already $500 billion short of where they need to be. So my expectation is very low that we see a corporate rate cut going into the tax bill this year.
Well, if they want to get to the corporate rate cut, they got to start somewhere. If they want to lower it, will we see potentially this budget deal that Mike Johnson is going to be back in Congress this week? Will he put it on the floor, and will it pass?
Yeah, that's the question of the week for sure, Emery. The expectation is that tomorrow night, beginning somewhere after 6 p.m., he's going to bring the House budget as it stands right now to the floor. Now, this budget is going to need to go through the Rules Committee, but once it gets to the floor, you have members who have heard an earful from constituents all week long. And that is from, Texas to Pennsylvania. Members who are very concerned about the $880 billion in Medicaid cuts. When you have representatives from states like Minnesota, for example, 21% of their constituents are on Medicaid. So $880 billion worth of cuts from energy and commerce is going to hit them. There's massive cuts to Pell Grants, as well as SNAP and TANF. Members have serious heartburn in both the House and Senate on this legislation. And the public outcry from members is what you really want to watch. And there have been members who are very willing to go on the record, from Susan Collins in Maine to John Curtis in Utah, saying, hey, this bill is not ready for prime time yet.
Can they cut from the Commerce Committee without hitting Medicaid?
Not at $880 billion. There is not a way. So what you want to look at is the tiering of what is possible from Medicaid. My colleague Spencer Perlman is our healthcare expert, and he thinks the work requirements are the lowest hanging fruit. That's about $120 billion in revenue. You're still going to need more than that if you need to get $880 billion from E&C. So they're going to need to be looking elsewhere. The Senate Republicans are saying, hey, I've got a better solution. Increase the deficit by more. So we'll see if the House Republicans can address that.
Over the weekend, Henrietta, there were a number of reports about Republican representatives getting angry responses from constituents. And then I looked at the popularity of Donald Trump and some of his policies being at some of the highest levels of his administration, and certainly much higher than going back to his previous tenure. I'm just wondering, where's the truth here?
Yeah, cuts for thee, but not for me. I think that Donald Trump personally remains extraordinarily popular. People like the disruption that he's bringing to Washington. The culture wars are very much a part of his appeal. You saw it on display in Maine earlier this weekend, talking about transgender sports. So there is a incredible salesmanship that goes on in Trump's ability to connect with his voters that is entirely distinct from his actual legislative policies and the Republican platform, which across many provisions, including these cuts, is unpopular with constituents. So I think we've said this before on the program, but reducing the deficit is popular. Cutting spending is not. And that's something that they're going to have to equate with and take those tough votes. And that's why it's harder to be a House member than an executive.
Framing matters. Henrietta, thank you. Appreciate it. Henrietta Trace there, Aveda Partners, the latest on the tax bill. He's done exactly what many people voted for him to do. Wall Street spooked, and I use the word spooked loosely because we're still very close to all-time highs on the S&P. I'm talking about Friday directly. Wall Street was spooked on Friday because of the sequencing. Tariffs have come before taxes. And if we did this the other way around, like we did in the first term of President Trump, I think you'd have a different result.
Which is the reason why Bob Dole said he's doing exactly the opposite of what he did in his first term. I think it's right that you bring up Home Depot. We had Walmart and some of the expectations from them coming down, dampening because of tariffs. Do we get the same from other types of corporate executives? That could change the tone.
The housing data has been pretty awful.
Yeah.
That's for sure, including the numbers on Friday. Coming up on the programme, I saw him walk into the building out the corner of my eye just moments ago, already looking 10 years younger. Amos Hochstein, the former senior advisor to President Biden for energy and investment, joins us in just a moment. From New York City, this is Bloomberg. Equity futures bouncing back from Friday's losses. We're positive this morning by 0.5% on the S&P 500. Losses on Friday on the Russell, pretty dramatic, down by 2-3 percentage points. The Russell this morning up by 0.8%. With 2 hours until the cash open, let's get you some morning movers. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. We start with a big story here. Apple investing big here in the U.S. Shares are lower, though. So I asked Dan Ives earlier why this is happening, and he said that this knee-jerk reaction is on the premise that Apple will diversify away from China. But he says it's the wrong reaction because it's just a doubling down on the U.S., and it's a way for Apple to get on the good side of the Trump administration. We have seen shares recover a bit from their initial drop, so the market may be coming into that view as well. Next up, we have Nike shares. Those are up 2.2%, and that is after analysts over at Jefferies upgraded the stock to a buy. They say the new CEO, Elliott Hill, has the right playbook. Not only is he engaged with current and lapsed partners, retail partners, he also says that they also see that he's driving innovation. And they say that you saw that last week with their announcement of their Skims partnership. And last up, we have Domino's, the pizza chain, getting hit here in the pre-market, down about 4%. Same-store sales here in the U.S. missed estimates, and it just shows how difficult it is to entice those budget-conscious consumers that, of course, Domino's is targeting. John?
Yahara, thank you. That stock is down by 4%. More from Yahara a little bit later on this morning. Lululemon and Lewis Hamilton partnership coming up as well, apparently. That was teased over the weekend.
Lewis Hamilton, really? Are we going there? I will just say this. Increasingly, it needs to have the star power behind it in order to get.
John loves him now because he drives for Ferrari.
I know.
So everything is going to be Lewis Hamilton.
I'm not embarrassed or ashamed of that. Obviously, Ferrari first, and then whoever sits in the seat, you back them.
All right, so you're going to put on a Ferrari jacket? Is that what you're going to wear tomorrow? With
Possibly.
a skinny tie?
Like when the season
With
starts,
Lululemon.
yeah.
With Lululemon pants.
On our radar this morning, several government agencies telling their employees to ignore demands from Elon Musk's Doge team to justify their jobs or face dismissal. The Pentagon and Department of Justice citing potential legal pitfalls and agency autonomy.
Legal pitfalls as well as potentially national security issues. What if you work at the CIA or the FBI, which Kash Patel, according to the Wall Street Journal, he's the newly confirmed FBI director, also telling employees to please pause any response to Musk's note because this could create more problems than find solutions. I will say, though, my phone was blowing up all over the weekend. There's more than 2 million federal workers who received this email with the subject line, "What did you do last week?" And then on top of that, they felt like they were being trolled by the president, who put out a meme of SpongeBob SquarePants marking off, cried about Trump, cried about Elon. So some are saying, is this really being done with a lot of dignity?
So this is the reason why I'm putting aside the dignity issues and the questions, even among Republicans that are saying you can make cuts and it doesn't have to be done this way. There's a larger question of how is this going to trickle into the data and how many people are actually leaving the government. And that's the reason why a lot of people are looking at jobless claims on Thursday and trying to decipher some of the counties in Arlington and around the D.C. metro area.
I'll say something quite controversial. I find that the people who are really good at self-evals are often the ones who aren't good at doing the actual work. You know, they're like really good at managing up and not good at like doing managing.
Deleting my self-evaluation
Just experience.
right
Anyway,
now.
let me turn to this story. I might get in trouble for that one. TD Cowen reporting that Microsoft has cancelled leases for a substantial amount of data center capacity in the United States, amounting to a couple of hundred megawatts. This coming as Alibaba pledges to spend $53 billion on AI infrastructure over the next 3 years.
So this is really important for a lot of investors. Peter Bukvar put this out and said this story out there that Microsoft is canceling AI data center leases gives me more reason to believe that a stock market regime change is upon us, where the AI trade no longer dominates and that DeepSeek was a game changer. A real question about whether you invest in the infrastructure and that's over or not. Microsoft, for its worth, came out and said, listen, we're still investing the $80 billion. We still have our plans. We still believe that there is going to be sufficient demand to meet this supply. That's going to be the real question.
I want to hear from NVIDIA on Wednesday. My question, they came out and said that that effort was export compliant. I'm not sure how they know if it is or not. I'm talking about DeepSeek, of course. I'd like someone to follow up on that on Wednesday and actually get some real answers on that front.
Yeah, how much is this, some of the high-powered chips that really fueled this, how much do you see some move to a more efficient way of programming some of these algorithms?
Those numbers drop on Wednesday afternoon. Look out for that. Let's turn to this story. Ukrainian President Volodymyr Zelensky saying the United States dropped its demand for Kyiv to commit to paying $500 billion as part of negotiations on a minerals deal. Zelensky saying U.S. military support must be part of any deal.
They want to see that military support, that military security. We heard from Scott Bessent. They're talking about this administration, that this deal would provide economic security and basically tether Kyiv with Washington when it comes to investment in commodities and raw materials. This deal is still being worked out right now. And it seems like the administration and Volodymyr Zelensky, the president of Ukraine, are using the media to almost negotiate the terms. I think we will get a clearer picture at the end of the week because you have Keir Starmer coming at the end of the week and then, of course, Emmanuel Macron this morning with the president.
Let's build on the conversation. He's 10 years younger. Without a tie, Amos Hochstein, the former senior advisor for energy and investment. Amos, welcome to the programme.
Thank you. It's great to be here.
Good to see you. You seem happy. We can get into that a little bit later. This came from Javier Blas just in the last week. I know you've read the piece. What Ukraine has is scorched earth. What it doesn't have is rare earth. Surprisingly, many people, not least US President Donald Trump, seem convinced the country has a rich mineral endowment. It's a folly. What's your view on all of this?
Well, first, I think Javier has done a lot of research into this. Rare earths, I've never seen any evidence of rare earths in Ukraine. There probably are critical minerals which are different from rare earths in Ukraine, but not at a stage where they've been identified and there's been any exploration drilling, not in any of the commercial quantities that we are aware of. There may be, and there are, I'm sure there's some data there behind some of this that suggests there is. But to get from a greenfield, from a discovery to a production can take many, many years. This is not expanding existing deposits. So I think this is a worthwhile conversation to have with Ukraine about how to develop their mineral resources. We should talk about how to redevelop their gas resources, how to develop their green power resources. Ukraine, I believe, can be a major supplier of power to Europe. Critical minerals, I think, is going to be, regardless of how this turns out, is going to be many years away.
When it comes to all these commodities, wasn't a discussion like this on the table when you were working in government under Biden?
This has been under discussion since I was working in government in the Obama administration. So this has been many, many years. We've always wanted to see Ukraine develop its resources because that will give them economic boost that will allow them to be more independent from Russia and to grow their economy. The corruption was the issue, right? But the resources were there. The issue is we shouldn't be taking the revenue from it. We should want them to have the revenue so that they can invest in the country, so that their Ukrainians across Europe that had to flee can come back and they can rebuild a country, a military, a security apparatus, and a future for their people.
You mentioned corruption. So I am reminded of an opinion piece you wrote in 2020 when you left the supervisory board of Naftogaz. So you've done a lot of work in Ukraine when it comes to this sector. Do you think the corruption has gotten better since then, tackling the corruption?
Not really. I think there's a lot of corruption predates Zelensky. It was a corrupt society before the Maidan revolution. The idea was, let's make it better. I think it did get better, and then some of those efforts stalled. There's been a tradition in government when there's a little bit of stress to go and use that moment to rob the kitty from state-owned enterprises. That's a problem that sort of ebbs and flows. I think it continues with the state control and during the war. It's hard to criticize during a war when you're having your cities bombed regularly, how you don't do that. So there's a lot of temptation there. But I think it's a systemic issue that the international community should tackle.
For just ignoring some of the more heated rhetoric around the Ukraine-Russia war, because of the lack of accountability of where funding is going, do you think that there is validity in pushing back on just how much the U.S. and even European nations are contributing to the Ukrainians in this Ukraine-Russia war?
Look, you guys separate a couple of things. One is we need to support Ukraine because another country invaded. You can argue whether or not the words that Zelensky used before the invasion were smart or not, was it good or bad. Nothing gives you the right to invade another country because you don't like what the leader said. You just can't do that. So they invaded another country and we should support it. And they invaded Georgia in 2008. And if we didn't intervene, they would have controlled all of Georgia today and Ukraine. So you got to stop that. Then I think 100%, and we talked about this already in the Biden administration, there's a lot of concern about where's this money going and who's in control of it. And this came up in many conversations with Zelensky, with his top people about our concerns. So what you should do is tighten the controls on the money and put the oversight in place so that you know where the money is going. But you can't do it while also saying, well, because of that, we're going to allow the Russians to take a whole bunch of territory and win the war. So it's a really tough balance, but, government's hard.
When you left the government, where was the Ukrainian situation in terms of how much territory Russia had taken and the sense of the balance of power at a time where it seemed like Russia was making some inroads?
So Russia was making some inroads, but largely the conflict had been frozen for a long time, where Russia makes a little bit of inroads, then Ukraine makes some inroads somewhere else. On a net basis, Russia was making more inroads than it was losing, but it wasn't massive amounts of territory, so it was largely frozen. But that was in order to get to a negotiation. I agree with the Trump administration that enough is enough. Let's get to a negotiation. I think you have to force both sides to come to the table, and you got to force some tough choices by both sides. Need to make some tough choices. Freezing the war in place and saying, okay, we're done, let's call this a border, is really tough because hundreds of thousands of people have been killed. To do what? Just to allow for the parts of the country to go away? And then what? Is there a disarmed Russia on the other side? I don't think so. So they invade again in 2 years, in 4 years. So you have to create a negotiation that has both sides at the table, that allows for some kind of resolution that both sides don't like, but that ends the war.
Some people have made the argument that the current president, President Trump, is attempting to shock the Europeans into action. Can you walk us through your experience with the European allies? How frustrating was that?
I think for us, for the United States, it's always a bit frustrating. I think we like to go a little bit faster, and we want to do things more aggressively when it comes to areas of conflict and negotiations. On the other hand, on the economic policy, we tend to go a little bit slower. In the environmental issues, we were, as a pro-green administration, were frustrated by how far sometimes the Europeans would go without thinking through the consequences of where they were going, and then they would suffer the consequences, which affects us, and they create high watermarks that we then have to deal with our constituencies of why aren't you doing what the Europeans? And it's a bad answer. We say, well, wait 2 to 5 years, you'll see why we're not doing what the Europeans are doing. So I think there's always been frustrations there. We tried to do trade policy with Europe in the in the Obama administration, the Biden administration, the Trump administration. Now, again, very frustrating, very difficult to do it. So it's built into the system. But at the end of the day, these are our allies. And we have to recognize that the argument with them is this is the argument inside the family versus the arguments with others, which is outside the family.
But don't you almost sometimes need to maybe shake them up? You were part of the Obama administration telling Germany not to go ahead with Nord Stream 2, yet they did it.
Yes, and if they didn't do it, large parts of why their declining economy is now would have been avoided. They bought into the argument of your heroin dealer. The first hit is free, and after that you pay a big price. And it's not only that. I went to Germany before the Ukraine war, 5 months before, and said, something's wrong, you're in trouble. And they insisted that they weren't when the Russians were playing a game of filling their storage in the winter from their own storage instead of from Russia. I said, how is it possible your pipeline's empty, but your storage is filling?
What took the Europeans so long to see the intelligence that the Biden administration was seeing and that Jake Sullivan was openly telling the press from the podium?
We shared all the intelligence. I think sometimes they had the exact same intelligence we had on the invasion. We were saying the invasion is coming on this day, on this week, on this day, at this hour. They refused to see it. No, this is just an exercise. I think sometimes being the neighbor, you kind of can't see us being an ocean away. We see it with clearer eyes. We've missed plenty of intelligence. I don't want to, we had 9/11 that people were training inside the United States and we didn't see it. So I think they were just too close to the Russians and always making the excuses for him. And that was the problem with Merkel and others. They were making the excuses. No, he doesn't mean it. And I think we have to learn a lot of lessons, and Europe has to learn more lessons. But I think they have learned the lesson. They don't want this war to end this way because they're worried that this war, it doesn't end here, and 5 years from now he invades another country.
Wanted to finish on this because we could talk to you all day. I mentioned this a couple of times and I was half joking, but semi-serious, of course, 10 years younger, without the tie. I've said this a few times. There are some really, really smart, intelligent people that work inside our administrations here in the United States. We spoke to one last week, Secretary Besson of the Treasury. I worry more and more as years pass by that those kind of people want to go into US government. I consider you part of that. Dileep Singh, another, Wally Adeyemo, really talented, intelligent individuals. You might disagree with them on their politics, but when it comes to policy, they've thought things through. Do you worry about that too?
I think it's getting harder and harder to come into government. I mean, obviously the hours are terrible, the stress is high, your family time is terrible, and I've seen so much damage to people's families just by making the choice to, especially if you're at the White House or at senior levels in the government. And the problem is, if you're not already wealthy, it's becoming even harder because the income is relatively lower. And I get it, it's higher than the average American salary, but it is lower relative to what the earning potential is for the people that are in those jobs. And the stress on it and the amount that it costs you to manage your life, the government doesn't pay for, and the scrutiny. I mean, I have protesters outside my house yelling that I'm accusing me of genocide, going after my daughter and putting her on Instagram, my 13-year-old. That comes with the job. And it's not like the Secret Service was there to help me or the cops. I mean, they're just standing there watching. So what you get, the blowback that you get, and then to manage your life is really, really difficult. The process for confirmation by the Senate is out of control, and for relatively low-level positions. So to come and be an assistant secretary in some random agency, you are now supposed to hire lawyers and accountants and to do a forensics auditing of your life, of your personal life, of your financial life. I mean, it's too much. And so I worry that outside of it being, I made a lot of money, so I'm going to go into government and play with that for a little bit. And that happens in both parties. I worry that it gets harder and harder to get good people to come in.
I think a lot of people share that worry. Amos, it's good to see you.
Good to see you too.
Hopefully we'll catch up again soon. Amos Hochstein there, the former senior advisor for energy and investment to President Biden. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. At least 3 of ByteDance's major investors have marked up the TikTok owner's valuation to over $400 billion. Sources say that SoftBank's Vision Fund revalued the firm in December, factoring in potential for its AI business. Fidelity Investments and T. Rowe Price also marked up ByteDance. It is a sharp rebound after the threat of a U.S. ban. Elsewhere in China tech, Alibaba plans to invest more than $53 billion on AI infrastructure. That includes data centers over the next 3 years. The investment will be used to support the company's AI ambitions. It also plays into Alibaba's goal of becoming a key partner to companies developing and applying AI. In sports, Liverpool is moving closer to another Premier League title after beating Man City 2-0. Mo Salah scored the team's first goal in the 14th minute and notched an assist on the second. Liverpool now holds an 11-point lead over second-place Arsenal for the top spot on the table after the Gunners lost to West Ham. And that's your brief, John.
That's a happy weekend for Lisa. Danny, thank you. Was that right?
It was.
A better weekend.
And Mohamed Al-Arian.
Yeah, Mohamed.
So excited.
So pumped for Salah. I know. Up next on the programme, underpriced.
In my mind, the Fed is underpriced at the moment. We have about 2 cuts in the price for the next 18 months or so. In my mind, pricing really skews in favor of them doing more rather than less as this year progresses.
Earl Davis of BMO joins us next from New York City. You're watching Bloomberg TV. Equities bouncing back positive by 0.5% on the S&P 500. In the bond market, bond yields on a 10-year, 444.87. Under surveillance this morning, underpriced.
In my mind, the Fed is underpriced at the moment. We have about 2 cuts in the price for the next 18 months or so. In my mind, pricing really skews in favor of them doing more rather than less as this year progresses. And so the 10-year, the 10-year a little bit too high right now. I'd be shooting sub 4%, closer to 3.5%.
Well, here's the latest. 10-year bond yields declining for 6 consecutive weeks, the longest run since 2019. Earl Davis of BMO expected more to come, writing, expect 10-year yields to grind lower. Lower 10-year yields will be supportive of risk assets. Earl joined us now for more. Earl, welcome to the programme, sir. Peter Chair of Academy said this only makes sense if the economy is weakening. Does it only make sense if the economy is weakening?
No, it doesn't. And we actually see the economy strengthening. And I'll come back to that in a second. The reason why it doesn't make sense is you just think it's the simple laws of supply and demand. Yes, that demand for there, let's assume it's constant for U.S. Treasuries. The supply is controlled by the Treasury. So even if they need to raise more funds because of deficits, they could control where they issue. And with now the yield curve being not inverted as it was, it's actually cheaper or less expensive for the Fed to issue more T-bills in shorter maturity. We have a sense this is where Secretary Bessent, based on his recent speech, is leaning towards, is the control, not the control, but maintaining longer term yields at a lower level. And that will help growth.
So, Earl, you're saying that right now the story in the 10-year is a supply story, not anything to do with growth expectations. Is that correct?
That is correct. And actually, and the reason why that's correct is we see growth continuing to accelerate. There's a few reasons why we see that. One is the Fed, basically the only thing they're easing right now is stress test standards. And by easing the stress test standards, that's actually an easing of financial conditions, which helps to stimulate the market. More importantly, the Fed Senior Loan Survey, Officer Survey that came out for the first quarter of 2025 showed an easing of lending standards for the first time in 3 years. That's what will fund and support small and medium-sized businesses and continue to support growth underneath. So although our base case is for no hikes, no eases this year, we are leaning more and more towards the possibility of a hike or a higher possibility of a hike than an ease, given what I just spoken about.
So if you see a hike, how much does that increase the chance of a weakening in the economy? And I'm just putting this out there as people start to think about a stagflationary-like kind of environment. I mean, is that kind of what you foresee later on?
It will weaken the economy, but it'll still be at potential. So the reason why they would hike is twofold. The second one being more important, but let me talk about the economy. The economy is overheating, or the economy is running above potential. So they will hike to get it within the realm of potential. The reason why they target potential and will do it is because inflation in this environment could really pick up. when you have small and medium-sized businesses having increasing access to loans and leases from banks, they are the ones that drive the economy. Combine that with less individuals to hire because of the immigration policy, you could see inflation come through in two ways. And these are the things that we're looking at. We're looking at wage inflation, which is a bit slower in regards to the releases, but as importantly, service inflation. Because where immigrants typically, or undocumented immigrants typically work, is in the services industry. So with less immigration there, we may see that accelerate and continue to keep inflation higher. So the Fed will hike because of that.
Oh, appreciate the perspective. Thank you, sir. Oh, Davis there of BMO. Answer the question we've been asking for a while. Does it reflect slower growth or will it support growth? And he's in the latter camp by the sounds of it.
Yeah, that he believes it will support growth. He also believes that this economy is running above potential and that the Fed's going to have to hike rates again. Also, a controversial view at a time where a lot of people seem to be discounting the chance of that rate hike.
That's a very different perspective this morning. Coming up, Abby Yoda of JP Morgan, Jeff Meacham of Citi, Kathy Bosch-Jancic of Nationwide, Krishna Mamani of Lafayette College. That's the third hour of Bloomberg Surveillance. Up next.
From an index standpoint, you may not see as much excitement this year.
Markets have been resilient so far and maybe more than resilient in the second half.
When you look under the hood, there's rotation happening and there's dispersion, and that's what's dampening volatility.
Ultimately, it'll be a good environment for stocks, but it's going to be a little bit more difficult.
Right now, it is about being broadly diversified.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. 90 minutes away from the opening bell. Your scores look like this. Equity futures on the S&P 500, firmer by 0.5%, bouncing back from the biggest one-day loss on the S&P of the year so far. On the Nasdaq 100 up by 0.4, on the Russell up by 0.7. This week, full of economic data, including jobless claims on Thursday and the Fed's preferred read of inflation on Friday. Then the big earnings report on Wednesday, Nvidia. But I think we all want another read on the U.S. consumer. Look out for Home Depot coming up tomorrow.
Especially since we do have these fears of inflation, at least among some cohorts that responded to the University of Michigan sentiment survey. How much is that impeding some of the outlook for consumer-facing companies? We saw that from Walmart. It's the 1-2 punch. Consumers need to hold in to keep the economy going, and there has to be the hope that some of the investment in AI is useful and not necessarily going to be overproducing or oversupplying rather than moving to the next phase of the AI adoption.
We've had 6 consecutive weeks of lower 10-year bond yields. This morning, just a little bit higher by 2 basis points. The yield on a 10-year maturity at about 4.45. The data on Friday, difficult to ignore, just not great. Consumer confidence was lower. Inflation expectations were higher. Existing home sales, not impressive. A bad PMI, the worst one we've seen in some 17 months. Put it all together, not a great story to tell.
Not a great story to tell, and it comes at a time when you do see consumers and some companies alluding to the fact that they are concerned about the uncertainty in Washington, D.C. when it comes to tariffs. There's a number of dates on the calendar that we're still waiting to know exactly what level of tariffs will be put in place, whether it's aluminum, the auto sector, Canada, Mexico. The only one so far to stick is an extra 10% on China. On top of that, one thing also interesting, the unemployment rate. That is something that half of these consumers are also concerned about, that's going to go up by the end of the year.
It sounds like a muddle. It sounds uncertain. It sounds scary. And then you look over.
I sound bearish
You
today.
sound bearish. And then you look over at what's going on in Europe, and they're still struggling to get a coalition together. Over in Germany, they're going to take 2 months to do it, and there's a question about whether they can increase spending. And this is the reason that even with all of this uncertainty and bearishness coming from us, you have the likes of Morgan Stanley's Mike Wilson coming out and saying it's premature to conclude a rotation away from U.S. stocks is sustainable. And Mislav Mateka of JP Morgan saying something similar. So a real question here about, yes, all those things are true, but the U.S. still may be a brighter spot than some other areas.
We should point out that last week we had record highs on both sides of the Atlantic,
Yes.
both in the United States on the S&P 500 and in Germany on the DAX.
Because ultimately the economy is still working fairly well. And in Europe, it's another story. It's just that there's such little optimism that anything could get done, that a little bit of optimism could ignite that, especially with some of the funds that are coming from the United States.
If you are just joining us, welcome to the program. We do bounce back by 0.5% on the S&P. Coming up this hour, we'll catch up with Abby Yoder of JP Morgan. As equity markets bounce back, we'll speak to Jeff Meacham of Citi as vaccine stocks rally on reports of a new coronavirus in China. You might want to give that a miss in about 12 minutes' time. Kathy Bostjancic of Nationwide looking ahead to PCE inflation data later this week. No one wants to talk about that story, do they, from Friday?
Well, not really. I mean, really, we really are going to speculate about another pandemic, which we have no visibility on, and yet people are worried about what else can happen, especially with bird flu and egg prices going up. And, how many people send me messages over the weekend? I delete them immediately, but, you got to pay attention.
Jeff's a smart guy. He joined us in 10 minutes' time. Turn the volume up, not down. I said down earlier.
Yeah, you did.
Honestly, I really just don't want to deal with this again. OK. We begin this hour with stocks looking to bounce back from Friday's sell-off. Abby Yoder of JP Morgan writing, the momentum sell-off could be attributed to weaker retail sales and some weaker than anticipated earnings from some retailers, stoking concerns about the health of the US consumer. We think this is overdone. We maintain our year-end price target of 6,400. Abby joins us now for more. Abby, welcome to the programme.
Good morning.
Good to see you. Lots of economic data to get through on Friday. What stood out for you? What was most concerning?
I think the confidence numbers are really what people were gravitating towards in terms of the headline number and the inflation expectations, the longer-term inflation expectations hitting a 30-year high. Again, I think, and you all have been talking about that this morning, really that if you dig into the details, there's some political leanings that are driving a lot of that. And also I thought it was interesting, this was the highest level of unsolicited feedback around uncertainty as it relates to the political economy or what's going on environment. So I think that's interesting for that survey in particular. And so that's driving a lot of things that are going on in markets. But I also think, look, we got some data that was a little bit less than, rosy that we've gotten over the past couple of months. But the picture on the consumer is still the same. The narrative's kind of still the same. It's uncertain, but it's still really strong. And I think what we've seen, again, is a momentum unwind and some dollars gravitating towards areas that people were really not loving over the past couple of years.
At the index level, we mentioned the S&P 500 hit a record only last week. Beneath the index, the market internal speaking to that growth slowdown that maybe the bond market's been playing off.
Yeah, you look at the top of the leaderboard here today, it's staples, healthcare, utilities. It's this really risk-off move. And what you've seen actually, and speaking of that, you've seen just this very stark rotation from cyclicals, out of cyclicals into defensives. But, when I think about that, that's in the U.S. in particular. But then you're also seeing money move to Europe and China, which you would argue is a little bit more cyclical and more risk on. So I'm not really sure what the market's trying to say in terms of where the dollars are flowing.
Do you think that what we're seeing in bond markets is supportive of an ongoing equity rally, or perhaps questioning it just simply because it is on the heels of slower growth fears?
I think it's going to ultimately be a positive for the market. I think the market is very quick to react and change narratives that we're in a Goldilocks scenario and then very quickly say, oh, no, this is recessionary. We saw that last summer very, very quickly. I think once we settle in and we see, we're not in an accelerating growth environment, we're in a moderating growth environment, but at a fine level, right? At trend, let's call it 1.5% to 2%, which is fine. And so once you digest that alongside lower rates, I think that's ultimately a positive for the equity market.
We were talking about the week ahead, and we're concerned about the consumer and some sort of reality check. You said that you think that that's overdone. There's also a question around NVIDIA and how much we see a real shift in the AI story away from some of the picks and hammers and shovels to the applications, the software, et cetera, and how much that could actually pressure the index level just based on how much NVIDIA has been a huge driver. What are you looking for to really understand that?
Well, look, we've heard from the hyperscalers, they reiterated and even increased their spend. What we want to know is where that like-for-like dollar is going, right? Was it one for one? Is it one for, is it going to the picks and shovels one for one, or is it going elsewhere where it's going to be spread out a little bit more? Are those dollars staying more internally in terms of R&D too? I think that's a good question. For us, I do think, look, the news out of China a couple of weeks ago coinciding with the inauguration was something that we were expecting, like the change in the narrative in terms of the AI theme, it just happened a lot quicker than we thought, right? And that's not necessarily a bad thing. These things happen. I think your point around, concentration, that's something that investors have been very concerned about for a long time, right? The past couple of years, let's call it. So I don't know that it would necessarily be a bad thing to see that broadening out in terms of performance. I think what it means is you maybe don't see the market move as swiftly in each direction, right? Like the sell-offs are more extreme, the recoveries are quicker. Maybe that's what the like end-all be-all in terms of the index looks like.
You made a good point at the start that when you look at the consumer survey, a lot of it is heavily political. But there potentially could be an impact on tariffs when it comes to companies. Mm-hmm. How do you look at potentially earnings per share? How much could actually be hit depending on which tariffs we get?
So that's an exercise, right? Because we don't know what exactly is happening and what's written in stone and what's being, just talked about. And we won't know for at least a month, I think, is really the timeline. I think when we think about it, the worst case scenario really would be those 25% tariffs on Canada and Mexico, right? Like those are our real trading partners at the moment. Obviously, from a relationship standpoint, that would be burdensome as well. But if you take everything at face value and you have 25% tariffs across the board on those two trading partners, then you incorporate some kind of tariff, universal tariff in Europe, let's call it 10%, and then incremental in China. I mean, that's a major, major hit to earnings. Let's say we have $30 of earnings that are expected to increase from 2024 to 2025. I mean, you could theoretically see 2/3 of that wiped away from tariffs if you do see that.
If you do see that, then would you have to edit your year-end price target?
Well, yeah, but that's not our base case, right? So inherently, we're maintaining that 6,400 because that is not what we foresee coming to fruition. It's just a risk that's out there. And I think when you're thinking about not only consumers, but corporates, we've heard this over the past, during earnings season, which has been phenomenal, by the way, like 16% year-over-year growth for 4Q, highest level of growth since 2021. You're just not getting the enthusiasm around the outlook because it's uncertain, right? And what happened after the election was these animal spirits and this risk on move, but then it's being outweighed now, I think, by the uncertainty as it relates to tariffs. But to the point, we're still only 2% from the highs.
Your regional preference is the United States over the rest of the world. Europe has outperformed so far. Mm-hmm. Double-digit returns in places like Germany, in France as well. What's behind that move for you? Do you think it's sustainable?
Well, so I think the way that we're viewing it, you've seen a move in the multiple from 13 to 15 times. Historically, on average, it's around 14 times. So we're above average in terms of what we're seeing in terms of the multiple. You haven't seen it move from a fundamental standpoint on the earnings side. You've seen earnings come in a little bit better than expected there. Nothing, needle moving. And it's really a matter of like China's a little bit better than expected. Europe's okay. US is really what's holding it up. So to be able to, see a sustained outperformance, we can't get any more multiple expansion in our view. We're going to have to see it come from earnings. So until then, we're still on the sidelines there.
Just to wrap it up, Lisa wants to know if you're worried about bats and whether that changes the story.
About bats?
Bats, coronavirus.
Yeah, coronavirus.
Oh, well, actually,
bird flu.
When you were saying let's not talk about the coronavirus, I was like, aren't we still on bird flu? Like I am on egg prices.
Exactly, right? But isn't that what everyone sends you messages about, all of your friends? Is this going to be real? How many eggs? Did you hear about the person who was killed over the weekend, who was a dairy worker? My friend's just crazy. I'm just saying.
Conversations get dark. I didn't get those messages over the weekend at all.
Okay, well.
Do not disturb over the weekend for me.
Abby, appreciate your time. It's good to see you. Thank you. We'll leave that there. Abby Yoder of JP Morgan and the thoughts of Bramo over the weekend. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu said the new Syrian regime must demilitarize southern Syria. Netanyahu said that he won't allow the new administration to push forces into territory south of Damascus. Israel advanced eastward into Syria, creating a buffer zone after the former government was overthrown by rebels. Apple has said it will add 20,000 new workers and produce AI servers in the U.S. The company plans to spend $500 billion domestically over the next 4 years. It will include work on new server manufacturing facilities in Houston and a supplier academy in Michigan. President Trump responding to the news, posting on Truth Social, "Thank you, Tim Cook and Apple." New York City's congestion pricing program raised $48.6 million in its first month. The program has reduced traffic by 10%, with 2.6 million fewer vehicles south of 60th Street. The MTA plans to sell bonds next year to finance $15 billion of infrastructure upgrades repaid with congestion pricing revenue, and has seen increased paid rideship on subways and commuter rail lines. And that's your brief, John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes. You two done arguing over that?
Well, Governor
Clear that
Hochul
up?
went to the White House and tried to make this case to President Trump that congestion pricing works. They need this money, to Lisa's point. I think Trump said he's not budging on this one.
I just am writing my self-evaluation. Will not be so bearish. Will not focus on bird flu.
Doing your South eval. We back to that again. I got a message from management. You and I didn't do one.
But
you did.
No, I didn't.
You did.
I did not do one. But I will say we don't really need to do one. You can watch us every day at 6 to 9. So if Elon Musk was to send us those bullet points, it would just say tune in.
That's what you'd say to management.
Tune in.
Okay. Good. You had your eval. All right. Up next on the programme, the morning calls plus Jeff Meacham of Citi as vaccine stocks rise on reports of a new coronavirus out of China. That conversation next. This is Bloomberg. The opening bell is 1 hour and 14 minutes away. Equities still positive by 0.5% on the S&P, and the bond market bond yields just about unchanged. The 10-year 443.51. Let's get you some morning calls. First up, Jefferies upgrading Nike to buy. The analyst saying the new CEO has the right playbook. That stock is up by 2.3%. Your second call from Bank of America downgrading Rivian to underperform, saying its Volkswagen partnership is complicating earnings forecasts. That stock is down by about 3%. And finally, Morgan Stanley upgrading Alibaba to overweight, expecting cloud revenue to double in just 3 years. That stock a bit softer. It's rallied recently, but we're down this morning by a bit more than 3%. Let's turn to pharmaceuticals. Some vaccine makers rallying after researchers in Wuhan, China said they discovered a new coronavirus in bats, similar to COVID-19. The virus is yet to be detected in humans. Joining us now, Jeff Meacham of Citi. Jeff, welcome to the programme, sir. One of those occasions, and I said this to you in a commercial break, where I'm really happy to see you, but really don't want to talk about this subject, but we have to. The news out just before the weekend, Jeff. From your perspective, how serious is this?
Thanks for having me. Yeah, and I'm with you. No one really wants to talk about, COVID going back to the 2020 sort of era. And I don't think we will. When you look at the seriousness of this, there is billions of folks that have been vaccinated, have been boosted. I think that protects against if there is sort of bat to human transition. There's a lot of folks that have sort of immune protected. I don't think we're going to have a round of boosters, for example. And just in case, there is Pfizer's Paxlovid, I think, which could address obviously some of those more severe symptoms. So don't fret yet. Is my is the comment.
Love that. I'm very excited to hear more of this sort of soothing rhetoric. I am curious just how much vaccine makers have the capacity to ramp up production and, frankly, innovate new vaccines with some of the new technologies that they're using. Should there be a new virus that does come out? In other words, are they sort of more capable than they were 5 years ago to really stave off a pandemic?
Yeah, for sure. I mean, if you look at, Pfizer and Moderna, the manufacturing investments they've made over COVID, obviously they've had to redeploy some of that as vaccine demands have gone down. But, whether that's a new variant or whether it's a meaningfully different look of COVID, the capacity, the R&D, the investments are there. And I would say in general, though, maybe a next gen Paxlovid would be helpful, just having another oral drug available, which could address signs and symptoms. But that drug itself is, I think, pretty good, for getting rid of, some of the patients that are most at risk, immunocompromised, et cetera.
Jeff, on Friday, there were a lot of reasons for markets to sell off, and there was a risk-off mood. But some people said it was because they got a number of emails about bats in Wuhan, and that's always sort of traumatizing for people. How do you gauge whether something is a real threat or not, whether it actually is going to boost sales of some of these vaccine makers, but more importantly, cause real havoc?
We've looked back at what companies said, on fourth quarter and what they assume for 2025. In general, I think we've been in a market of stability for some of the vaccine makers for 2023, 2024. There haven't been a lot of new changes to demand, and obviously the supply can be there if a new variant, for example, comes out and has a massive sort of infection wave. But in general, though, I don't know if we're going to see another boon to vaccine makers. What I guess I would be worried about is if there is a new variant that was extremely virulent, much more so than this Omicron subvariant. And we just haven't seen that yet.
Lisa, I don't think people will comply in the same way they did 4 or 5 years ago. I don't think they'll be able to mandate it in the same way they did 4 or 5 years ago. I hope we don't even have to talk about this in the next couple of months, but you can really feel the mood based on the conversations you've had over the weekend and the conversations I had as well.
Yeah, I don't think I could mandate it with my family, let alone have some sort of broader mandate, because it was deeply traumatic for a whole generation of kids. And I point to kids in particular because the socialization was so important at that point. So at a certain point, you have to think the tools have to come from the medical community. And it raises the question of Steve Pagliuca when he was talking about the developments using machine learning to really innovate and speed up the process for vaccines.
Jeff, I know you don't cover Moderna, but Moderna's really struggled over the last couple of years, over the last 12 months particularly. Jeff, I think if you're a company and you're waiting for the next pandemic, some people might say you don't have much of a business, if that's the business. What's Pfizer been doing, a company that you do cover? What have they been doing? Because they're not waiting for the next pandemic. What kind of offering do they have right now away from this conversation?
Right. So, from a Moderna perspective, they've obviously moved on from, a primary focus of vaccines into things like oncology, infectious or rare diseases, which is I think a good application of the mRNA technology. I wouldn't say Pfizer has really taken the mRNA technology to the next level. Their partner, BioNTech, is mostly oncology, but Pfizer has done a number of things in cancer. The Seagen acquisition, I think, is super helpful when it comes to adding to their portfolio and their pipeline. So they're investing in other segments, but I don't think they're by no means doubling down right on vaccines.
Jeff, how do you take into account some of what we're hearing from the administration, given that there has been a crackdown on spending with Medicare and Medicaid, but also just with RFK Jr. in the office talking about vaccines and raising some questions? Has that affected any of the outlooks or the investment profiles of any of the pharmaceutical companies that you cover?
For sure. A lot of investors are looking to, Pfizer, to some degree, Merck, some of the earlier stage or companies like a Moderna, with less, on a dollar basis, less robust pipelines. But I would say in general, though, it's unlikely that you're going to see a lot of big companies maybe double down on their vaccine, kind of portfolios or their pipelines in terms of new vaccines that are needed. Most investors, I think, are worried enough about the risk that they're looking at, more easily understood markets like GLP-1s or oncology or, say other infectious diseases. I just don't get the impression that, we're hearing from leadership from a lot of biopharmas that vaccines are the way to go. And so there is a bit of a reactionary approach to some of the uncertainty from RFKJ, for example.
Well, when it comes to uncertainty, we also see the CDC's quote unquote disease detectors. These are the individuals that go out, say there's an Ebola outbreak in Africa, and have to go find out more about it. How much of a data gap could there potentially be for some of these companies if they're not going to be getting that data from the U.S. government?
Yeah, it's a good point. I would say the good thing is that you have a technology like mRNA, which can react very quickly to a lot of the viruses that we're talking about. Could be bird flu. Historically, it's been Zika, for example, rotavirus, norovirus. So the technology is there to react quickly to a new and emergent virus, and so I feel pretty comfortable in the safety profile of that technology. And so that's why I sort of can rest somewhat easy knowing that the speed of addressing a potential emergent variant could be pretty fast.
You've made us all feel a lot better, Jeff. Appreciate it. Jeff Meacham there of Citi. Jeff, thank you. That news dropped. What was it, Thursday night, Friday morning?
Yeah.
Started to move stocks, the vaccine makers, the likes of Moderna. I just sat there shaking my head. My phone has started getting the messages, literally repeat.
Yeah.
On repeat. I'm not doing this. We're not doing this again.
Not going to comply, even if it does. I love it. You were saying, turn down the volume. It's going to be awful. It's going to be scary. And he comes down and he says, basically, is it really that big of a deal? We've got vaccines. We can handle it.
Even Jeff's reluctant to talk about it. Up next on the programme, we'll talk about the economic data. Kathy Boshantyk of Nationwide, Krishna Mamani of Lafayette College. That data on Friday, just how reliable is it? And will it be confirmed by economic data still to come? Still to come this week, we've got jobless claims on Thursday and core PCE on Friday. Equity futures on the S&P 500 with until the opening bell. Firmer here by 0.5%, bouncing back from Friday's losses. In the bond market, yields just about unchanged. The 10-year 4.43. From New York, this is Bloomberg. Equity futures positive here by 0.5%. The opening bell about 60 minutes away. Let's get you some morning movers. We can get those with Yahara Hackers. Morning, Yahara.
Hi, John. We start with Tesla. The stock has been feeling pressure lately, and this is Domino's, not Tesla, but we'll get to Tesla soon. Tesla's shares have been feeling pressure lately, and it's no different today. And of course, some of that has to do with investors feeling like, there it is, Tesla now up. And that is on this news that we just received, which is that Tesla's premium cars will be getting a refresh. Apparently, there was an interview with a company executive, Lars Morave, who said that refresh will be coming later this year. But it's all over the map now, John. Next up, we have Coinbase shares. Those are recovering here. It's been whiplash for the shares ever since that announcement that U.S. regulators are planning to dismiss a legal case against them, because just hours later, we got news that there was a massive hack where about $1.5 billion worth of tokens were stolen at another exchange called Bybit. So Coinbase shares fell on that news, but it appears the happy mood is back in the crypto sector. And next up, we have Freshpet shares. Those are getting a boost after analysts over at Jefferies upgraded the stock to a buy. They're up about 5% now. And not only are they seeing positive revenue trends because people keep spending on their pets, they're saying the stock is worth 50% from where it's trading now. John?
Yahara, thank you. Appreciate it. You know the game that TK used to play with me, foreign exchange roulette? Used to join the programme from London. Bloomberg Surveillance here in New York. I'd get on there, A block, top of the programme. He'd bring me in to talk about markets. Argentina, go. That was it. It was like foreign exchange roulette. Argentina, go. Switzerland, go. And I had no idea what was happening. And these graphics would just come up on the screen.
Exactly.
And I'd have to respond to like whatever was happening.
He loves the Thai baht.
There, yeah.
I remember a week of that.
Hungary, the foreign. Yeah.
Oh, yeah. Hungary was a big one. How about, why is the Swissy here?
Loved FX roulette. Me, not so much. Investors looking ahead to key data ahead this week with the core PCE inflation print due out on Friday. Michael McKee, our economics and policy correspondent, joins us now for more. Mike, lots of economic data. What tops the pile for you?
Well, it's going to be a Friday deal, Don, because we're going to be looking at PCE, the personal consumption expenditures index, and also personal consumption. And we'll see whether consumers continue to spend. The big news is that we're expecting a mild PCE inflation number on Friday, just 2.6% for the core on a year-over-year basis, suggesting that the Fed is still making progress. We get consumer confidence tomorrow after the Michigan numbers upset the markets on Friday. That will be interesting. Durable goods are companies still investing, and jobless claims will be watching for any sign that federal government workers have been laid off. Lots of Fed speak, as you can see that calendar go by. Not really going to matter a whole lot because the deadlines for Donald Trump's tariff announcements aren't until next week and the week after. So the Fed is basically still in the same position it has been. We just don't know what the president is going to do, so we just can't make any decisions on what we're going to do. And John, I'll finish up by noting that Argentina has an economic activity index coming out on tomorrow. So that's going to be the news of the day there in Argentina.
I'm pleased you're still on top of things, Mike, because I'm not in the same way. Michael McKee there, looking at that economic data a little bit later through the week. We'll be looking for jobless claims on Thursday. This coming from Starbucks this morning, cutting 1,100 corporate jobs worldwide. Seen a few of these headlines from various companies, haven't we, over the past few weeks?
Yeah, and a real question about whether this is just simply culling the fat kind of cuts or whether it's something more significant. Starbucks said that they're going to notify employees who are losing their jobs by tomorrow, by February 25th, and they're limiting several hundred open and unfilled roles. This is a real question, though. Is this the time for people to make efficiency reductions, or is this in response to something more?
I got to shake my head, though, when I see this headline drop. North America VPs at Starbucks need to be in the office at least 3 days a week. 2025, and they need to be in the office at least 3 days a week. Meanwhile, you're cutting a number of corporate jobs worldwide. It just feels like this is stale and outdated.
This is part of the Brian Nichols shakeup. Got to remember that as well at the same time. Is it a cyclical signal? I think it's Brian putting his stamp on a company over the past few weeks.
Speaking of Brian Nichols, is he remote? Isn't he working in a different place? I'm just saying. I mean, I think
he has access to a Gulf Stream and goes back and forth.
I'm just saying,
I think Brian has different access to travel than maybe others do at Starbucks.
Look, I think that you're right. Starbucks is specific, but we are seeing a number of job cuts being announced, particularly of big tech. And you do wonder how much this is going to be an increasing efficiency play.
Stock is down by about 0.2%. Jobless claims just around the corner. Kathy Bochantic of Nationwide Mutual Insurance expecting consumer confidence to reflect caution and optimism, and income and spending to advance at a slower pace. Kathy joins us now for more. Kathy, before we look forward, I want to look back just a little bit. UMich Consumer Sentiment Survey gets lots of attention. Does it deserve it?
Good morning, John. Well, it does in some sense. In fact, what I find most useful is the inflation expectations component, and particularly the 5 to 10 year portion. And then we know the Fed focuses on that, right? That's a longer inflation expectations component. The sentiment index, if you break that down upon amid political leanings, it's really sways, right? When Republicans are in power, their optimism is very high and Democrats are in the dumpster, and vice versa. So it is very sentiment based and maybe not based on the economic reality. Plus, as you know, right, consumers continued to spend even when sentiment was really low. So we need to look at the fundamentals, and the labor market is key.
It's getting harder and harder to understand what the fundamentals are as we get a lot of noise. And we're talking about consumer sentiment, how politically it's being driven. We talk about the jobs market and how politically driven that might be. Earlier this morning, we got news from Apple, 20,000 new U.S. jobs with a nod to Donald Trump. This morning, Starbucks job cuts. Which is it? Is it jobs being created in the U.S. or is it jobs being pared back? Which headlines should we pay more attention to?
Well, good question. One thing, there's always jobs created and lost, right? There's tremendous churn in the U.S. labor market. And what we see and usually focus on is the net payroll number, right? Or net household employment number. But this churn continues to go on and on. From all indications right now, the labor market is still very strong. There certainly can be headline announcements here or there. Jobless claims still remain incredibly low, continuing claims. I don't get a sense that we're seeing a big change. Now, of course, we have to be nimble, right? And because the economy can operate on the margin and changes can occur, but we're not really quite seeing that at this moment.
John, you were talking about Brian Nichols. I was a little distracted because he's got a corporate jet. Yes, he does. But his offer letter included a small remote office at his home in Newport Beach, and he was expected to be in the office 3 days a week, which is exactly what they're saying to other people, that they have to be back in the office.
Can the office be Newport Beach?
I don't know if they can join his small private home office.
Like the remote office, the official office.
I don't know if that is the official office, but I just know that was sort of the distinguishing feature. Kathy, we're talking about the idea of coming back to the office, and we're seeing that with certainly the federal workforce being demanded to come back to the office. We're wondering whether this highlights how much companies are getting the upper hand with workers in a new way than, say, 3 years ago when they couldn't have mandated return to work in the same kind of way. Do you view it as that?
Well, I think it comes down to probably, different companies making their own decisions for their workforce. I would say that there is perhaps more leverage for companies and maybe more of a need to bring people together. But I think it is very, it's idiosyncratic. And I think, businesses have to decide what model works, best for them. And I think as you talked about Starbucks, that's a very different, company. And I wouldn't say it's cyclical at all. As you mentioned, it has its own struggles that are really separate from the overall economy, which up until this point has been booming, actually.
Kathy, we've been talking a lot about the effects of the federal workforce and what DOGE is doing. On average, last year, we saw the U.S. government add about 35,000 people, once a month, and we got the non-farm payroll numbers. Do you expect a hit on the federal workforce to impact the jobs report?
So we're watching it. We're acutely, aware of the announcements and the work that's being done. We're trying to keep a spreadsheet and a tally of that. Not easy. But also remember, in that breakdown of the government, half is state and local, and actually probably even more is just state and local than federal. So that's one thing to keep in mind. And with these announcements of federal, it's not clear how many people were going to retire anyhow. I mean, there's a normal churn in the government sector as well. So it may be all told that the negative hit to employment is slower to unfold and maybe ultimately less than, the 10% at least that they initially were talking about. So my sense is, and people are on deferred contracts. So my sense is we're going to see the hit at some point, but it will be kind of more of a drip than a big drop.
Kathy, appreciate it. Going into the economic data later this week. Kathy Borchankit there of Nationwide on the data we've seen so far as well. Bit of a scare on Friday. I think we need to take a step back, get some perspective. Equity still very close to all-time highs. Unemployment still around 4%. Jobless claims in the low 200,000s. But I respect why people are jittery. We've got a new source of risk, tariffs, policy uncertainty. That's something we didn't have over the past year. Cuts to Washington in the long term might be a good thing. In the short term, might provide some disruption to the economic data. Got to think about this, though. What's worse than an economic slowdown? It's an economic slowdown the Fed cannot respond to or is unwilling to respond to. And Neil Dutter's making that point at the moment over at RenMac. The Fed doesn't have your back right now. That's a quote from Neil over the past week or so. That's a change.
It's a change at a time where people are worried about inflation still. And this raises a question of, is inflation as a concern overblown, which is something that Neil Dutta has made the point of. You can't have an inflationary shock if you have the housing market flat on its back. Or is this a Fed that has its hands tied because we are in a more stagflationary-like environment? And those are two different scenarios, and that's one of the key debates right now.
Neil Dutta joining us tomorrow, so look out for that on Bloomberg Surveillance. Here's the take from Krishna Mamani of Lafayette College. He goes on to say, what we have is a potentially softening economy that is being hit over the head with 2x4s of policy uncertainty instead of being nurtured. It's not good. Krishna joins us now for more. So, Krishna, the question I've got to ask you, sir, is why are we still very close to all-time highs on the S&P 500?
So the underlying economy continues to do well, as you just said. Economic growth is decent, employment is good, income growth is substantial, and the consumers continue to spend. So the challenge is really not right now. The challenge is 6 months out. So if you are a corporate executive and you're trying to make an investment decision as opposed to a consumption decision for your groceries or whatever else that you do, and your investment period is 4 or 5 years, I mean, do you just jump in and do all the things that you were planning on doing, or then let's take a pause and see how all of this works out? And I think that's really the risk. The risk isn't the current state of the economy. The risk is we may be potentially slowing down. The Fed can't do anything, and on the policy front, we are getting hit every day, twice a day.
If the risk is people pause, Krishna, and maybe that's reflected in the labour market as well, reinforced by this low churn dynamic which has gripped the US labour market too. What is most at risk in the equity market?
Well, so in the equity market, what is most at risk is really things that are extraordinarily high valuations rather than things where the near-term impact of a potential slight slowdown would be substantial. So it's really the tech sector that is very vulnerable, not because they're not making money. It's just that their valuations are too high.
You wrote in your notes, Krishna, that not having a view is still the best strategy. How do you not have a view as an investor that has to actively put money to work?
Well, so, as an investor, you have a long-term target, and then you move around that target. So if you have a view, then you can adjust that target on a tactical basis. So not having a view for somebody like us who are investing for 20 years, 30 years, doesn't mean that we get out of the equity market. It's just that we don't overweight equity markets or particular sectors of the equity market.
Do you have a view then on the equity bond mix? Because one of the fundamental questions right now is whether some of the structural changes that are occurring right now in Washington, D.C. are going to change the trajectory for U.S. debt markets going forward, whether it has to do with reducing the deficit or whether it has to do with things like the Mar-a-Lago Accord, which had all sorts of excitement over the weekend. How do you view that in terms of longer term balance?
So I think the reducing the deficit is a very noble goal. However, when we are talking about large tax cuts at the same time, from a realistic standpoint, that doesn't really reduce deficit in any significant or meaningful way. So I think if the structure of the market is going to change, it is not going to change because we have somehow found a magical way of reducing our deficit from very high levels that we have today. And as far as Mar-a-Lago Accord is concerned, I kind of shake my head, as somebody said a little earlier. It's like, this is third world thinking as opposed to a first world thinking. If the U.S. goes down that path, I don't know what to say. It'll be hell to pay at some point, it seems to me.
Krishna, when it comes to this policy uncertainty, you say it needs to be nurtured right now. What would you want to see out of the administration from a market perspective?
So I think the administration has some really nice goals that, rebalancing trade, creating jobs in the U.S. All those would be very good objectives, and I think are going to help the U.S. economy in the long run. It's just the way they are coming and the way the volatility is. We do say that we do something one day, take it back. We say something that we are going to do, then we postpone it. I think that that's really the issue. That is, we don't know exactly how things are going to shake up, what the timing of all of those things is. It's really more about that than anything else.
Hey, Krishna, always appreciate and respect your views, sir. I want to finish up with this. What would you do right now in markets? What are you doing?
Well, so, we are keeping ourselves very close to our long-term targets. If I have any spare money that I would like to invest, I would invest in bonds far more than equities. That's not a message that the market is taking to heart right now, but the risk is more on the downside with respect to the economic growth picture, employment, than it is for it to re-accelerate.
Hey, Krishna. Thank you, sir. Krishna Mamali there of Lafayette College. Mentioned Neil Dutta of Renmark, who will be with us tomorrow, published this just moments ago. Let me share it with you. Much of what we see in the financial press, tariffs, uncertainty, is a red herring. Goes on to say, an ex-post rationalisation for an economic slowdown that was already in motion. I would anticipate a decline in longer-term interest rates and a sell-off in equity prices as risk appetite wanes. For the economy, expect conditions to deteriorate in the jobs market.
This is the reason why some people don't think that a decline in the 10-year is a positive thing for equities. Just take what we just heard from you, that you read about Neil Dutta, versus Earl Davis, who said the reason why 10-year Treasury yields were going down was because the Treasury Department wasn't issuing longer-term debt. It just highlights how you can give two people the same metrics in the market, the same information. They can come to diametrically opposed rationales for what's going on. And it really highlights the uncertainty of to this moment.
Do you know who might have some sympathy with one dimension of what Neil Dutta had to say? A surprising source might be Kevin Hassett, National Economic Council Director, who a few Fridays ago after the payrolls report suggested that maybe this labour market wasn't as strong as some people thought it was coming into 2025.
This will get tested in 6 months when they can't necessarily attribute that to the previous administration. But you're right. How long can that kind of carry through before those pro-growth policies start to give tailwinds to a different narrative.
Looking forward to catching up with Neil tomorrow morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Trump administration sent emails to more than 2 million federal workers, ordering them to report on what they did last week or be forced to resign. The deadline to reply is just before midnight in Washington. Elon Musk said the directive came directly from President Trump. However, several agencies, including the FBI, NASA, and the Pentagon, have asked employees to hit the pause on acting on the directive. Ukrainian President Vladimir Zelensky says that he's willing to step down if it means peace and NATO membership for his country. Zelensky says it's clear he wouldn't be in power for decades and would happily make that trade if the offer was made. Elsewhere, Pope Francis remains in critical condition as he continues to battle severe pneumonia. The Vatican says that the 88-year-old pontiff is still receiving high-flow oxygen to help with his breathing. Some blood tests show an initial mild renal failure, which is currently under control. The Vatican says the Pope continues to be alert and well-oriented. And that's your brief, John.
Danny, thank you. He'll be in our prayers, of course. Up next on the programme, we'll set you up for the week ahead. You're watching Bloomberg TV. Equities positive here by 0.5% on the S&P 500. Bond yields higher by just a basis point on the 10-year, 444.68. The opening bell about 38 minutes away. The week ahead looks like this. Tomorrow, earnings from Home Depot. Wednesday, the big one, Nvidia. On Thursday, another round of jobless claims, GDP and durable goods. And on Friday, core PCE, the Fed's preferred inflation read. Look out for that. We're also watching a midnight deadline for federal workers. Elon Musk's Doge sending a mass email over the weekend demanding they defend their work. Tyler Kendall joined us now from DC for more. Tyler, what's next?
Well, John, there's still conflicting guidance out there after many agencies told employees not to respond. What that signals to us is that these agencies didn't get a heads up before this memo went out. Now, it's still unclear what sort of legal basis Elon Musk, in his capacity as a special advisor to President Trump, would have to terminate federal workers. But President Trump did make clear that he would like to see Doge get more aggressive. When we are talking about what's next, these legal questions, we are expecting the largest union representing federal workers to contest any firings that could come if people do not respond to this email. And remember, this really could be widespread. Only about 20% of the federal workforce is in the nation's capital and the surrounding areas. And often we talk about President Trump trying to shake up Washington institutions, but of course, this could go much broader than that and across the country. John, you've been talking about consumer sentiment all morning. When we talk about the University of Michigan's gauge that was out on Friday, it showed more than 50% of respondents said that their long-term unemployment expectations had risen. That is one of the highest numbers that we've seen since April of 2020, when we were in the height of the pandemic.
So the president has a busy day today when it comes to the international space. Emmanuel Macron is already in the White House with him. They have a call at 8 o'clock. Well, they're on it right now. When it comes to other G7 leaders, what's on tap between these two leaders today?
Right, exactly, Emery. They'll have a bilateral meeting followed by a lunch and then a 2 p.m. Eastern press conference. We'll be waiting to see what sort of headlines, particularly when it comes to security guarantees from Europe, come out of that. But also, I'm closely watching to see if we get any indication about how tariff negotiations are going. Of course, we know that pending aluminum, steel, auto tariffs could really hit the European Union. But Anne-Marie, I would just point out some interesting timing. Late Friday night, President Trump opening the door to potentially implementing tariffs as a way to counteract digital services taxes. I bring that up because France was one of the first countries to implement a DST back in 2019. It's something that President Trump tried to get rid of during his first term in office. And of course, these hit some of the biggest U.S. tech companies like Meta and Alphabet. And considering the Apple news earlier this morning, it would appear that tech is at least somewhat on President Trump's mind.
Hey, Tyler, appreciate it. Thank you. Tyler Kendall down in Washington, D.C. Haven't talked about it much this morning at all, but also pushing Mexico to put their own tariffs on China to prevent the goods coming through the back door into the United States.
This is the real story, though. And actually, this is the one that you got to pay attention to. There has been a longstanding gripe that has crossed administrations about Mexico being the back door for China products into the United States. And that is a real question. If you want to isolate the two economies, how do you do it without some of the allies participating?
It's a warning shot to anyone that wants to do nearshoring or friendshoring. You have to make sure that you are still isolating China when you're doing that if you want your products welcomed in the United States.
It's a good start to the week. Equities bouncing back by 0.5%. Long week still to come. Coming up tomorrow, Sharon Bell of Goldman Sachs, Mike Wilson of Morgan Stanley publishing a little bit earlier. The debate turns to growth. The debate is turning to growth in a big way. Bond yields down for 6 consecutive weeks coming into this week. The longest weekly run since 2019. Tom Kennedy of JP Morgan will respond to that, and Neil Dutta of Renmac on why he is not constructive on this economy and hasn't been for a number of months. That conversation coming up tomorrow morning. Live from New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance. This is Bloomberg TV.
News when you want it with Bloomberg News Now. News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Well, Karen, let's begin with the latest on U.S.-China relations because President Donald Trump is planning to toughen Biden-era controls over China's tech sector. Bloomberg News has learned the White House is sketching out more restrictive semiconductor curbs and is pressuring key allies to escalate their own restrictions. We get more from Bloomberg's Tom McKenzie.
It's the existing platform that's already there that the Biden administration built, and they're looking to tighten that up, which, for example, is working with U.S. partners like the Dutch and the Japanese. And we know officials from the Trump administration have been out to the Netherlands and to Japan, particularly Tokyo Electron in Japan and ASML in the Netherlands, to put pressure on both those countries to try and limit the access that engineers from those companies have to the Chinese markets to continue to work on the machines and the kit that is already in situ in China.
Bloomberg's Tom McKenzie says some Trump officials also aim to further restrict the types of NVIDIA chips that can be exported to China without a license.
Well, Nathan, China is not the only country in the crosshairs of Trump. As heard right here on Bloomberg Radio, the president says tariffs on imports from Mexico and Canada are on track to take effect on March 4th.
The tariffs are going forward on time, on schedule. This is an abuse that took place for many, many years. And I'm not even blaming the other countries that did this. I blame our leadership for allowing it to happen. I mean, you know, who can blame them if they made these great deals with the United States, took advantage of the United States?
And Trump also said he wants to revive Canada's XL oil pipeline. The project, which was meant to carry Canadian oil sands crude to Nebraska, became a litmus test for environmentalism under former President Obama, who rejected it in 2015. It's been subject to political jockeying ever since.
Well, Karen, President Trump appears to be breaking even further with U.S. allies on the war in Ukraine. At the UN General Assembly, the U.S. joined with Russia in voting against a European resolution calling out Moscow's full-scale invasion. Russia later backed a U.S. resolution calling for a swift end to the conflict without assigning blame. Meanwhile, President Trump says Ukrainian President Volodymyr Zelensky could come to the White House as soon as this week to sign a deal on critical minerals.
The deal's being worked on, and we're, I think, getting very close to getting an agreement where we get our money back over a period of time. But it also gives us something where I think it's very beneficial to their economy.
President Trump spoke alongside French President Emmanuel Macron at the White House. Macron says Europe would be willing to send peacekeepers into Ukraine after a peace is negotiated. Trump is signaling he would support that.
Well, former Treasury Secretary Lawrence Summers is denouncing the Trump administration's pressure on Ukraine over its natural resources. Nathan, Summers spoke with David Weston on Bloomberg's Wall Street Week.
What the Trump administration seems to be proposing, and to be fair, we have not seen all the details, is Versailles, a Versailles-like agreement imposed not on aggressors, but imposed on the victims of aggression.
Bloomberg contributor Larry Summers was referring to the post-World War I Treaty of Versailles, which imposed strict financial and other penalties on Germany.
Elsewhere in Washington, Karen, confusion reigns among federal workers on whether to respond to a threatening email from Elon Musk. Let's get the latest from Bloomberg's John Tucker. John?
And Nathan, the deadline was just before midnight. Elon Musk demanded that federal employees explain their recent accomplishments or risk getting fired. Now Musk says federal workers will be given a second opportunity to respond. But the federal agency that sent the email says it's up to agency leadership, not Musk, what happens to those who ignore the message. Everett Kelly, the national president of the American Federation of Government Employees, takes a pretty dim view of the tactics being used by Musk.
They want to confuse the workforce. They want to put fear in the minds of the workforce that they'll just quit.
At least 3 agencies, including the Justice Department, the State Department, and the Department of Defense, told their employees not to respond to Musk's directive, but other agencies sent the opposite message. Musk's escalating threats come as President Trump has urged him to be even more aggressive. I'm John Tucker, Bloomberg Radio.
All right, John, thank you. Meanwhile, Bloomberg News has learned Musk's SpaceX is seeking to deploy Starlink satellite internet terminals to help upgrade the Federal Aviation Administration's national airspace system. The The effort raises questions about conflicts of interest for Musk's business empire and the future of a $2 billion contract awarded in 2023 to Verizon Communications.
In political news outside Washington, Karen, former New York Governor Andrew Cuomo is reportedly on the verge of running for mayor of New York City. The New York Times is reporting Cuomo may announce his candidacy as soon as this weekend. Cuomo resigned from office in 2021 over sexual misconduct claims, which he has denied.
Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. The Green Bay Packers asking the NFL's competition committee to ban the so-called tush-push play, the play perfected by the Super Bowl champion Philadelphia Eagles. New college basketball poll, Auburn still number one. St. John's up to 7th in the rankings, highest since 1991. And Kansas, who started the year number one, 80 straight weeks in the top 25, and now out of it. Big NBA game.
Hi, I'm Renat. Welcome to my office in Ritzy. When I came here for the first time, I felt like I'm very lucky. You feel more connected to yourself. Come to the Ritzy and regenerate your mind.
I mean, I want to ask about some of these specifics of the role that China can play as a potential peacemaker when it comes to Moscow's war in and with Ukraine. Do you think Beijing sees itself as a possible guarantor for European security?
Definitely, Rebecca. Actually, I believe China can play three roles in this war. The first is one of the guarantors, along with other major powers, if a ceasefire is in place. Why is that? Because the Ukrainians deeply remember the pledges of the 5 nuclear powers when they decide to relinquish nuclear weapons. To some extent, of course, that kind of guarantee was not very much substantive in that all the 5 major powers could not provide a so-called positive guarantees. That is, if somebody beats you, then I will beat him. But this is what they remember. Given the volatility of the situation, I believe Ukraine will be afraid if there is no guarantee from major powers. Actually, this is what President Zelensky has been talking about. And on the other side, Russia also needs a kind of security guarantee. Why? Because Russia doesn't want to stand looking isolated, right? Because the whole West is behind Ukraine. Then who might be on Russia's side? China is not on Russia's side, but President Putin talked about how China, India, and Brazil, these countries from global south, can be honest brokers. This is the first thing. The second thing is a big if. If peacekeeping is needed, then of course China and other countries from global south are best positioned to play this role, because NATO countries, even if wearing the hat of EU countries, would not be trusted by Russia. Russia would simply take these countries as wolves in sheep's clothing, right? So otherwise, why would Russia have fought this war after all? It's because of NATO. The third thing is most obvious, given China's capability in infrastructure building that is next to none. China definitely can play a crucial role in post-war Ukraine, because China simply can do things more efficiently at lower cost.
It's interesting that you talk about this point about the potential for China to cooperate with countries from the global south and so on in terms of the potential sort of peacekeeping force when it comes to Europe. The other point here, of course, that's important is China has, the largest base of peacekeeping forces within the UN when we look at permanent UN security, the Security Commission there. But typically, China doesn't send troops in anywhere without authorization, and typically it hasn't played the role of this kind of security guarantor. So I wonder how you assess China's willingness to send peacekeeping forces into Ukraine.
Well, you see, for peacekeeping to happen, first of all, the warring parties have to have consent of the 5 permanent members of the UN Security Council. In this way, it is a bit different in that Russia one of the warring parties is a permanent member of UN Security Council itself. So if peacekeeping is needed and has to be authorized by UN, this has to be a special arrangement. But because of China's contribution to peacekeeping that can be seen by everybody, and so I think China simply is better positioned to play this role. Yeah, and because it can be trusted and it is impartial, because impartiality is one of the preconditions for peacekeeping. But the significance maybe is that for the first time, China will be seen in having a role in the security of Europe. That is something unprecedented, but China is invited.
Right. Now, my question takes a step back, Senior Colonel David here. You've been quick to emphasize that the role that China plays is post any ceasefire. Is there any role you think China can play that brings us closer to a ceasefire?
Well, I have some doubts about this. Yeah, that's a very good question, because right now Russia and the United States is having direct talks. So basically, I believe Ukraine should be invited to attend this talk. Otherwise, it look a bit like what Soviet and Germany did on the land of Poland, right? To have their own spheres of influence, because Ukraine is a country being invaded. So to let its destiny be divided by Russia and the United States, this is not so fair for Ukraine, I would say. But at this stage, I don't believe China can play a very big role. I believe China's role will come when they have negotiated something, but short of a guarantee. Then China can join other major powers in providing this kind of guarantee. And then China, of course, can do peacekeeping and post-war reconstruction. So China's role will come a little bit later.
There has been some discussion about the sort of so-called reverse Nixon possibility here, this idea that the US will move to split or at least create more distance between President Xi Jinping and President Vladimir Putin. How concerned do you think Beijing is about that possible scenario?
That is totally impossible. Just imagine for a moment, okay, in post-Putin area, we don't know when that will be, right? So a new president will normally change some of the policies by his predecessors. But given that China and Russia are largest neighbors towards each other, so whoever comes into Kremlin would have to consider about this fact that we are the largest neighbor toward each other. Therefore, we must have an amicable relationship. And I believe Russia's best chance of tilting toward the West was after its dissolution of the Soviet Union. Even Putin would want to join NATO. But if at that time that kind of dream was doomed, and given how good the relationship between China and Russia is, so I don't believe that even in the post-Putin area, this relationship will change a lot. And during President Putin's era, of course, I believe this relationship will simply continue.
Right. Can I just get your thoughts as well on, I mean, this takes us directly into Chinese-American relations, and we're trying to figure out where the rationale is amidst all the noise. And from your perspective in Beijing, has President Trump acted in a way that we were expecting him to act?
I think, well, this is sheer speculation, which I hope is not hallucination. I think it might be possible because after seeing how he has, acted in a different way against China. So I think there is a possibility that actually during his second term, China and American relationship might improve, contrary to most people's speculation. Because his legacy during his first term actually is a kind of a bipartisan, consensus against China. I don't mean he wants that himself, but he has largely left it to some China hawks like Peter Navarro and Secretary of State Pompeo to hijack this relationship. So who is the best position to change his own legacy? Of course, he himself, right? His attitude toward China so far has been friendly. So this gives me some hope. We'll see.
We also, nonetheless, still have seen this sort of flurry of actions taken by the Trump administration over the weekend, not least the shift on CFIUS, the change on U.S. investment, the pressure on Mexico to introduce its own tariffs on China. Do you think that all of these components of different pieces of news that we've had over the weekend, is this a step change in the response of the Trump administration towards Beijing?
As I said, we'll have to wait and see. But what is interesting for me is actually that his tariff on China is lower than the tariffs on Canada and Mexico, which is 25%, right? He only had 10% on China, and China, was swiftly retaliated with even 15% tariff on some selected American items. So because he talked about 60%, just imagine, when he was at election. So this turned out to be much, much more, milder than expected. So that gives me a lot of speculations. I don't know where the future will go, but there is a hope that he could be different from his first term, and he could even be different from his predecessor. Actually, Joe Biden was quite friendly toward China. He was even called a Beijing's Joe. But apparently he could not walk out of the trap laid down by those China hawks. So he even doubled down, on the road of competition with China to have this kind of a so-called small yard high fence on and so forth. So I have some hope.
Do you think there's a chance we'll get a meeting between Xi Jinping and, dare I say, Beijing's Donald, just to use that analogy you just mentioned there?
Well, yeah, anything could happen because for China, this kind of direct talk among top leaders would be most, useful and significant. I'm aware of the of the remarks by Russian ambassador in China. He talked about how President, Xi has accepted Russia's invitation to go to Moscow to attend the commemorations of Soviet victory over Nazi. The Chinese media did not confirm that, but normally on such kind of things, Chinese media would only make an announcement a few days before such kind of things. But it's interesting, the Russian ambassador has mentioned it. The question is, $1 million question is, I believe Russia has also invited President Trump. So would Trump go there? If that happens, that would be really, really interesting.
There is a question in Washington, D.C. that some have been asking about whether or not a potential deal between Trump and Putin effectively gives President Xi a green light to invade Taiwan. Has anything really changed on Taiwan? Would any kind of deal between Trump and Putin change how Beijing thinks about Taiwan?
No, I don't think so, because people have been talking how Ukraine today will be Taiwan's tomorrow. But I think this is really, really a big issue. If you observe, you would find that the Chinese government is still talking about peaceful reunification, right? So yes, the fact is two leaders of Taiwan are DPP. But still, we're talking about peaceful reunification. That means we still have lost the confidence. And why should we lose confidence? Because Taiwan would not move away. The strength of mainland is growing, both economically and militarily. So time is on our side. There's no such a hurry. We have never announced a timetable. That is most important. We have never announced a timetable for peaceful reunification. So I believe we are still confident. A big question for China is, would the growth of strength of China make China more confident about peaceful reunification, or would it make mainland China more impatient to resort to use of force? I believe the answer is the first part. We're still having confidence.
गाइस आई थिंक स्क्रीन अब चल रही होगी। नेचुरल गैस से पहले क्रूड ऑयल को देख लेते हैं। क्रूड ऑयल जैसा मैंने बताया 6:30 होने वाला है न्यूयॉर्क सेशन ओपनिंग। यहाँ पर एक रीटेस्ट था मॉर्निंग पे। मार्केट ने काफ़ी ट्राई किया बट नहीं कर पाया रीटेस्ट प्रॉपरली। वापस नीचे आ गया। यहाँ पर भी एक रीटेस्ट जोन ही है। दिस इज ऑल्सो रीटेस्ट जोन। इसमें सपोर्ट नहीं है, सपोर्ट नीचे बने हुए सारे। दीज आर द सपोर्ट एरियाज। ये सारे रीटेस्ट जोन है। यहाँ से एक बाइंग का प्लान है। क्वांटिटी थोड़ी कम रखना, टारगेट थोड़ा बड़ा रख सकते हैं। बाकी बीच वाले लेवल को चाहो तो रिमूव कर दो। ये रीटेस्ट सब कंसिडर मत करना। इसका हो गया रीटेस्ट जितना होना था। यहाँ पर बाइंग काफ़ी देर ट्राई किया, फिर ये ओपन इक्वल टू हाई कैंडल बनाई। उसके बाद देखोगे पिछले 2 घंटे से रुका ही था, नीचे वाले लेवल तक वापस रिटर्न आ गया। तो इस लेवल को अब चाहो रिमूव कर दो। वी डोंट कंसिडर इज एज अ रेजिस्टेंस। वो ऑलरेडी एक रेजिस्टेंस था, ब्रेकआउट हो गया तो सपोर्ट की तरह काम करना चाहिए था। 6:30 के कैंडल का ध्यान रखना। ये भी रीटेस्ट जोन ही है, ठीक है। दिस इज ऑल्सो रीटेस्ट जोन। सपोर्ट फिर नीचे 6000। 6092 के अराउंड है, फिर नीचे सपोर्ट और देन 6054। ऊपर वाले रीटेस्ट को भी अगर ये टेस्ट कर देता तो बेटर रहता। वहाँ पर लिक्विडिटी अभी भी पेंडिंग है। मॉर्निंग से देखोगे अभी भी 50 पॉइंट की 50 टू 60 पॉइंट की रेंज में ही है। दिस इज ऑल्सो रीटेस्ट, ठीक है। सपोर्ट नहीं है, इसको सपोर्ट मत कंसिडर करना। दिस इज ऑल्सो रीटेस्ट जोन। नेचुरल गैस कल एक रीटेस्ट जोन पे था, ये भी अपने थोड़ी बहुत सेलिंग कल आ गई थी, आज भी उसी लेवल पे रुका हुआ है फिलहाल के लिए। लगता है आज रीटेस्ट फॉलो ही नहीं करेगा ये। पर क्रूड ऑयल में एफईजी बने हुए हैं, दोज आर द फर्स्ट रेजिस्टेंस। नेचुरल गैस भी अपने रीटेस्ट जोन पर ही है। कल भी था, आज भी उसी लेवल पे फिलहाल के लिए। कुछ ना ऊपर निकला है ना नीचे। नीचे आता है तो फिर कल का जो लो है वो एक सपोर्ट है, उसके नीचे एक और सपोर्ट है। ऊपर रेजिस्टेंस के लिए ये एफईजी बना हुआ है और देन एक मेजर रेजिस्टेंस 370 375। 7:30 और 8:30 पे डेटा भी रहेगा, उसका भी ध्यान रखना। 6:30 की कैंडल इंपॉर्टेंट है, रिमेंबर। भी करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम। सेशन ओपन होने वाला है, 6:30 पे ही होता है। बस ओपन इक्वल टू हाई लो कैंडल ना बने, लो बन जाए, ओपन इक्वल टू हाई ना बने क्रूड में, क्योंकि 6:30 की कैंडल अगर ओपन इक्वल टू हाई बनी तो फिर और गिर जाएगा। रेजिस्टेंस दूर ही है, ये एक रेजिस्टेंस यहाँ पड़ा हुआ है, एक सपोर्ट यहाँ पर है, सपोर्ट यहाँ पर है। इससे पहले वाला भी रिटेस्ट जोन था, ये भी रिटेस्ट जोन है, ऊपर ये भी रिटेस्ट जोन ही है। एग्जैक्ट सपोर्ट रेजिस्टेंस दूर ही बने हैं। नेचुरल गैस में भी सेलिंग का प्लान कर सकते हो बिल्कुल, यहाँ पर एक फिर से अगर करना है, यहाँ पर फिर से प्लान हो सकता है। वो पूरा ही रेजिस्टेंस जोन है, इसके ऊपर भी रेजिस्टेंस जोन ही बना है, यहाँ तक ये पूरा रेजिस्टेंस जोन ही है। मैंने थोड़ा सा लेवल छोटा कर रखा है बस, नथिंग एल्स। किसी को अगर फिर से सेल करना होगा तो यहीं से ट्राई कर सकता है। एक पुल बैक अगर फिर से आ जाता है 354 से लेकर 352 के बीच में कहीं भी सेल कर सकते हो वापस से, यहाँ पर कहीं पर भी सेल कर सकते हो। एसएल वापस 356.5 इतना काफ़ी रहेगा। एंड टारगेट आप रख सकते हो नीचे 344.7 का, लाइक ऐसे समझ लो 344.7 44। उसमें दो दो रेजिस्टेंस एक साथ बने हुए थे तो दोनों का रीटेस्ट एक साथ ही होगा, जैसे नेचुरल गैस के अलावा क्रूड ऑयल में बना हुआ है। देखते हैं, नेचुरल गैस का डेटा नहीं है, वो 730 830 वाला गोल्ड और सिल्वर को नॉर्मली इम्पैक्ट करता है। नेचुरल गैस प्लीज, नेचुरल गैस का चार्ट लगाया हुआ है पटेल जी स्क्रीन पे। सेलिंग का एक प्लान रख सकते हैं 15 मिनट टाइम फ्रेम के अकॉर्डिंग 353 354 से 352 के बीच में। एसएल भी लगा रखा है वहाँ पे। पूरा रीटेस्ट जोन ही है, इसको रीटेस्ट ही कंसिडर करना नेचुरल गैस में अभी भी। ये कोई रेजिस्टेंस नहीं है, रीटेस्ट बना हुआ है बस। नीचे होता है ब्रेक 344.5, इसके नीचे कहीं अगर ब्रेक डाउन हो जाएगा तब फिर एक्सपेक्ट कर सकते हो वापस डे लो पे आ जाए, नहीं तो अगर ब्रेक हो गया 344.5 तब फिर एक दूसरा टारगेट 339 ब्रेक होता है तो। अभी काफ़ी दूर है, डिपेंड ऑन द नेक्स्ट कैंडल एवरीथिंग। लगता है क्रूड ऑयल के रीटेस्ट आज चलने वाले नहीं है। ओके 15 मिनट और रह गए, 630 कैंडल पे थोड़ा क्वांटिटी का ध्यान रखना क्रूड में, ठीक है। बाइंग का जो ट्रेड लगा रखा है, डोंट टेक द टू मच रिस्क बिफोर 630 कैंडल। ऐसा उड़ा के ऊपर जाएगा लग रहा है। स्काई कितना 6140। ठीक है निकल चुका है सेल निकल जाना है इसमें से ये अब 6:30 कैंडल का ही वेट करते हैं और एक एफईजी बना दिया इसने ध्यान रखना ये इस लेवल पे ठीक है रिटेस्ट को भी रिमूव कर देना कैंडल नीचे ब्रेक कर चुकी है पुल बैक दे सकता है बट ऐसा उड़ा दिया इसने यहाँ पर एक एफईजी बना दिया इस एरिया पे बाइंग वाले का असल जा चुका है, ध्यान रखना क्रूड में। ये ना कि पुल बैक आ रहा है उसकी वजह से वेट कर रहे हो, ऐसा उड़ा दिया उसने। तीन मिनट रह गए हैं न्यूयॉर्क सेशन की ओपनिंग पे, ओनली 3 मिनट लेफ्ट। ओपन इक्वल टू हाई बनी है, कोई नई एंट्री मत करना अभी नेचुरल गैस में। ओपन इक्वल टू हाई कैंडल है, डोंट एंटर डायरेक्टली। क्रूड नहीं, क्रूड में नहीं है। ओपन इक्वल टू लो क्रूड में नहीं है, नेचुरल गैस में है। ठीक है, नेचुरल गैस में डायरेक्ट एंट्री मत करना, थोड़ा सा ऊपर आने देना 356 तक। अगर ये ओपन इक्वल टू लो बनाते हुए ही ऊपर आता है अगर, क्योंकि अगर इस तरह से बनाने आया तो एसएल हिट करने आएगा, तो थोड़ा सा एसएल के ऊपर लेना जरूरी है। 356 अगर ऐसे ऊपर आता है। ये डोंट एंटर डायरेक्टली इन नेचुरल गैस, थोड़ा सा ऊपर आए तब फिर एंट्री करेंगे। अगर ओपन इक्वल टू लो बनाया है तो कहीं ना कहीं ये एसएल हिट करने की कोशिश करेगा इस एरिया के आसपास, और फिर नीचे जाने की कोशिश करेगा। आगे लेट्स से ये थोड़ा वॉल्यूम आ जाए और प्रॉपरली। हाँ, नीचे आता है तो यही टारगेट रखा हुआ है 344। अगर इसके नीचे निकल जाता है तब फिर कहीं और थोड़ा बड़ा रख सकते हैं, फिलहाल इतना ही रहेगा। और देखो नेचुरल गैस कैंडल क्लोज होने वाली है, ओपन इक्वल टू लो ही बनी है, ब्रेक नहीं किया है अभी भी लो। थोड़ा और ऊपर आ जाए तो एक बढ़िया रहेगा सेलिंग का ट्रेड। 630 ओपन हो गया है तो थोड़ा एक्सपेक्ट करेंगे वॉल्यूम आना चाहिए। ठीक है, यहाँ से ये इस पर मत करना करंट कैंडल पे डायरेक्टली सेल, बिकॉज वो ओपन इक्वल टू लो है, ओपन इक्वल टू लो पे डायरेक्टली सेल नहीं करते हैं, रेजिस्टेंस पर ही, बट ओपन इक्वल टू लो पे नहीं करते। इस तरह की कैंडल बनी है तो सेलर्स जरूर ट्राई करेंगे, बायर्स सॉरी एक बार ऐसा हिट कर दें बायर्स के सेलर्स, सो दैट उसके बाद वापस नीचे आए, तो ये एक ट्रेड रहेगा। नेक्स्ट कैंडल पे कभी पुल बैक आए बिफोर 8 PM, ट्राइड। इसके ऊपर और कहाँ पर है, ऊपर भी है रेजिस्टेंस यहाँ पर एक।
It makes it easier for these cases to get dismissed and then potentially recover some of the costs that these plaintiffs have that file them. So I do think that the fact that this
ठीक है, नेचुरल गैस में कब कर सकते हैं रेजिस्टेंस की अराउंड सेलिंग। लास्ट कैंडल तो ओपन इक्वल टू लो बनी से लाइट ले नहीं सकते थे, बट या इसमें कर सकते हैं। 348।
from HBO, now in its third season, because it's become a reliable driver of travel booms. Each season has taken place in a beautiful Four Seasons resort around the world. The first in Hawaii, the second in Sicily, and now the third in Thailand. While it was difficult to quantify if season 1 drove an increase in travel to the already very popular Maui, the second season had a much clearer cause and effect. One luxury operator told Bloomberg its Sicily bookings tripled after the finale of season 2. Another saw a 424% spike in sales. And now Thailand is hoping for a similar boom. Bookings at the $2,000 night Koh Samui Four Seasons Resort have already jumped 40% according to the New York Times. And we're only 3 episodes into this season, Anne.
I know, I haven't watched it yet. Is that a terrible thing to admit?
It's not. There's a lot of good TV out there, but yes, continue.
There's so much good TV, and I'm completely the target for TV-driven destinations. I watched Shogun. Did you watch Shogun?
I did watch Shogun.
Devour Shogun. I could not book a flight to Japan fast enough after watching Shogun. So look, I get it. I'm a TV tourist too.
No, this is a real industry that has, popped up. It goes all the way back to, Lord of the Rings, where, people saw the Shire and immediately started booking their flights to, New Zealand. Jet setting in this case literally means jetting off to a set of a movie or a TV show. I think it's fascinating too that Four Seasons have really, capitalized it. They have a formal marketing partnership with HBO. So it's not, a coincidence that these shows keep taking place at Four Seasons resorts. So they are kind of have this deal to market themselves as the real life version of the fictional White Lotus brand. So there is this promotional machine at play here for sure.
I mean, if the Four Seasons is listening and they happen to want to do a promotional partnership with Morning Brew,
Please.
I think Toby and I would be very open to having that conversation.
I do think too, this is just a growing industry. We're seeing American Express, the card brand, is offering White Lotus Thailand experience packages to, certain card members. It includes a stay at the Four Seasons resort. You can also do a 7-night White Lotus Thailand trip for just under $8,000 a person from another travel company. That includes private tours of Bangkok. That is what people are saying about this particular season. It's not just contained at the resort. It is broadening the world. You're going to other places in Thailand as well. So Thailand is kind of saying, yes, we're welcoming you guys with open arms, tourists, because right now the tourism is a little bit down from pre-pandemic. Pre-pandemic, they were getting 40 million visitors a year. That number fell all the way down to 28.2 million in 2023. It's back up to 35 million in 2024. And so they're hoping they can get, close that gap to 40 million that was flowing in pre-pandemic. Now let's sprint to the finish with some headlines you may have missed. Up first, the Starbucksissance is fully upon us. The struggling coffee company is laying off over 1,100 corporate employees and leaving several hundred positions unfilled as it aims to streamline its operations. Part of that effort also includes streamlining its coffee menu. 13 drinks are on the chopping block, including the iced matcha lemonade, the white hot chocolate, and whatever a chocolate cookie crumble creme frappuccino is. The strategic shift under new CEO Brian Niccol, all part of the effort to reduce wait times, focus on customer favorites, and revitalize the brand's core coffeehouse experience. And sometimes you got to cut the fluff in order to grow again.
I think that's right. And when are they going to fix their food offering? Do you know what I mean?
You're not a fan?
I'm not a fan. Every time I walk in there, it looks good. It tastes terrible. I think Starbucks, fix your food, and then you're on to your new chapter. Let's go on to our next headline, Toby. Lester Holt, the legendary newscaster and anchor of NBC's nightly news, is stepping down. Holt has been a mainstay for the evening program since 2015, but announced he plans to step away from the desk this coming summer. NBC executive Janelle Rodriguez called Holt, quote, the beating heart of his news organization, highlighting his steadying voice during the early days of the pandemic in 2020. At the time, the show was averaging 12 million viewers a night. Even though broadcast TV audiences have declined in recent years, nightly newscasts can still draw 20 million viewers on a good evening. Toby, look, trust can be the most valuable asset a news program can have. Lester Holt's been a trusted face for NBC for years. Is it going to be hard to replace Holt, or is this just the end of an era now for news?
It's a slow end of an era for sure, because you have seen a spate of high-profile news anchors stepping away from their posts recently. Just in the last few months, Joy Reid, she's leaving her position as a host of MSNBC. Her show was actually canceled by the network. Norah O'Donnell recently left her spot as anchor for CBS Evening News. And then Chris Wallace left CNN. Chuck Todd left NBC News. Hoda Kotb left NBC's Today. So we are seeing kind of these networks pull back on spending. They don't want to, hand out these hefty contracts to these faces of the network. And I do think we are just seeing a gradual but, sudden shift away from these, faces that we used to see all the time on network TV towards, more media news influencers like, podcasts like us. We are seeing just a shift happening over time. It is spring training time in Major League Baseball, and for the first time, MLB is allowing pitchers and batters to challenge balls in strike calls. But rather than adding another human into the mix, they found a neutral arbitrator, a computer. That's right, the league is testing out robot umpires with the hopes of adding them to the regular season eventually. Dubbed the automatic ball strike system, it allows players to challenge umpire decisions, adding a strategic twist to the game. The challenges can only come from the pitcher, catcher, or batter, and they must happen immediately, which so far has led to some pretty funny mix-up. Pitchers are horrible at it, said Dodgers pitcher Landon Knack. We probably had a 90% miss rate with all the pitchers last year. Dodgers catcher Hunter Fiducia chimed in. It is funny, Ann. As a player, you always think umpires are getting it wrong, but this is exposing it might be the opposite.
Hasn't this been happening in sports for years? Like tennis with the line calls. Hasn't this been happening in basketball? Why is this new news?
It's new news because baseball it's a slow moving game. They didn't want to replace umpires. They think that it's moving to a fully automated strike zone. Got negative feedback from fans, oddly. I don't know. I think you are right. Baseball is just behind the curve in this instance. But I do think that this is the way sports are going because it adds a lovely strategic element to the game as well because remember in tennis too, you used to be able to challenge, line calls.
Yeah.
But now it's just all automated for at least most tournaments. Same thing is happening in baseball now where some players just get way too caught up in the moment and challenge a call that is not even close to correct, but you're just like competitive and I don't know, you just have a vendetta against the umpire. So a lot of players and teams are like coaching their players to say, only use them in high leverage situations, only use them when the outcome could affect the outcome of the game. Don't just do it because you're mad at the umpire here. So I think you are right, though, that baseball is a little bit behind the curve when it comes to, automated systems like this.
I think right there, I just got a window into how Toby plays sports. Like right there, like the strategic timeout, the high leverage point in the game.
It's important.
Whether it's your golf, your tennis, I think everyone, we just figure out how Toby plays mind games in his athletic pursuit.
True that. That is all the time we have for today. And thanks again for joining me while Neil is enjoying his White Lotus experience. Let's roll these credits. Emily Milliron is our executive producer. Raymond Liu is our producer. Olivia Graham is our associate producer. Uchenna Nwogu is our technical director. Scoop Dardaris is on audio. Hair and makeup is pawning off a golden toilet handle. I wonder where they got that from. Devin Emery is our chief content officer, and our show is production of Morning Brew.
Great show today, Toby, and we'll see you all tomorrow.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
क्रूड ऑयल में कोई ट्रेड नहीं है मेरी ओर से. नो ट्रेड इन क्रूड ऑयल फ्रॉम माय साइड राइट नाउ. नेचुरल गैस में सेल कर सकते हैं ऊपर से.
doing. Well, that's good. We can get into that. And I just want to dial it back for a second. We're going to go through the definition of multiple here. We've been teasing everybody so far. So let's break it down. Multiple is a number you use to derive a company's value. You take a company's earnings or its revenue or another metric, and then you multiply it by that magic number to get the value. And that magic number is the multiple. So how do you think of it? How do you use it in your investing? We were saying maybe it doesn't matter this year, but like, why is that? Break it down.
Okay. Let me just make this easy for all the kids at home.
Please. And your kid right here.
Here's how it works. Nobody cares about valuation until you're in a bear market. Nobody cares about NVIDIA trading at a 30 or 40 until they can't hit their numbers. Now, value players always like to come in. That's kind of how I was classically trained. And you're supposed to buy things at book value. Good luck. Anything selling a book is going to be bankrupt. Look at Ford and GM. And you know why the multiples are so low? Because nobody thinks they will be a going concern in 10 years from now.
Going concern means they're in business.
In business. And there's a reason why a chemical company trades at 5 times earnings, because it doesn't grow. So when you see a multiple on something like a Procter & Gamble or Johnson & Johnson, when they have organic growth in the sub 5% world and they're trading at a multiple of 25, for instance, right? That's a real concern. I was a young kid in my 20s on Wall Street when we had the S&P 500 trade at 30 times earnings back in, 2000.
I was going to ask you the year, but
that was crazy.
Wait.
And it's too high.
I want to talk about how happy I am to talk about fundamentals because Jared wants me to be a technicals girly.
I thought you were all about charts.
Yeah, he wants me to be all about charts, and I want to be all about fundamentals.
We all love charts. We all love charts.
Yeah, please.
So,
not just lip service here. We love
tell
charts.
me what I should be. What is the most important metric in fundamentals or in a company's earnings report? What do I need to know if I know nothing about fundamentals?
Okay, bottom line, story has to get better. Bottom line, you need to have, if they say we're going to be making 15% earnings, I'm just throwing that out, that's crazy. You have to make sure that every earnings, they say it's going to be 15.1. Okay, because for instance, I was long Palo Alto Networks, big cybersecurity. Last year they came out, they said, hey, we're not going to be growing at the same, 18, 20%. It's going to be slightly moderated because we're going to do this or that. I mean, the stock just drops, right? So when you have a higher multiple company and you have earnings growth or revenue or some little thing that the analysts weren't looking for, just a tiny little softness, you're going to see an immediate 20+% drop in the price and what that tells you is that the multiple was too high versus not having the story get better. So you can have, value stocks. They run off of bad news. Value stocks are buying something horrible and then waiting to just be crappy, right? And that doesn't really work too much in today's because nobody cares about that. So you have to go with something that's really moving.
Let's talk about why that doesn't work and why it hasn't really worked this century. We've had persistently low interest rates, and it just kind of upended the business cycle, the investment, the boom bust cycle as investors were used to it. And so the value trades, they got caught in value traps.
They're all value traps.
So how do you navigate it now? And let me just ask you this. Do you see things changing because we do have higher interest rates now? We were just talking with Peter Borsch about a change in the 30-year trend in interest rates. Does that factor in?
Yeah, it does. By the way, we'll get to this later, but I'm long the 30-year treasury. I love it when bond gurus say things declaratively, whether it's that guy over at JP Morgan, or let's just say, the Gunlacks of the world, that who would buy a 30-year treasury? And
when it hits 5%.
Yeah, when it hits 5%. and it's like, well, it's just a bunch of pension funds doing, liability. But it's like, okay, great. So I have a bunch of goons in little blue suits looking at actuarial tables and nobody else. I'm like, baby, this is a sandbox I want to play in because it sounds like not much competition. But the bottom line is, interest rates do matter. There's this idea that as interest rates come down, we're going to be able to continue to have the delusion that multiples don't matter. Let me tell you why multiples in NVIDIA don't matter. Please. First of all, NVIDIA isn't trading at 100 PE, right? I love stuff like AI plays like Palantir and stuff, but when it gets close to a 200 multiple, triple digits? Yeah, even I'm just kind of like, do I really want to do this? You know, I keep thinking of all the trades of the past 28 years and how I got into trouble.
Forward.
It's just like when I'm dealing with PEs 60, 80, 100, my ability to get burned goes up exponentially, you know? And so the reason why NVIDIA multiples aren't that bad is because they're under 40. They make so much money. You know what the problem is? I heard all this crap 25 years ago in .com, right? Now there's a difference back then. The companies didn't make cash like they do. Completely different situation. But today, if we don't get the growth that NVIDIA is promising, and it slows down a little, and they can't hit their whisper numbers, that valuation is going to start mattering. And especially if we have a little bit of slowdown, which I don't think will happen, but if you get a little slowdown because, you know, maybe there's a little trade war, maybe, you know, you just have a buyer strike, maybe consumer sentiment starts to fade because egg prices are going up and people voted for Trump to make egg prices go down, which is out of his control.
So 15% this morning.
15% this morning. Then you're going to see people start shifting away. That's what happened in 2022. We didn't have a recession in 2022. We had a lot of inflation and people started saying, wait a minute, this is going to eat into earnings. You had Facebook incinerating money on the metaverse or whatever.
The margins were.
The margins were off. The margins get off a little bit. Suddenly everybody cares about charts, where the 200-day moving average is, and then the fundamentalists, they start saying, why are we paying 35, 40 times earnings when we can't hit our number?
Guys watching the charts are ahead of the game. I'll just add that.
That's just because it's Jared watching the charts. That's what he wants to say.
Well, I love charts, and I grew up with charts because, you know, when you're not that smart, it's what you do first because, you know.
That's my story, right there.
I love pretty pictures, and
they're worth so many thousands of words.
They are, or is, you know, I've got a great friend in the business who I've known forever, and she's mentored me for years. Her name's Helene Meisler, and she always says, you know, I love when she says, I'm just a girl with a pencil, right? And it's like, oh, what she can do with that pencil. And so what I've learned is
charts by hand, yeah.
Charts, they're self-fulfilling prophecies, and they're just a visual representation of, is everybody in this trade making money? Or is everybody in this trade losing money?
Yeah.
And
where's the emotion?
Exactly. And then also with something like a John Deere recently, where it's just, you just have this sideways action for years, right? Or, you know, I've been looking at Hershey's, just like getting killed for years. You know, at some point you get a breakout and you say, everybody who's been bored in this for the last 2 or 3 years is suddenly activated. You see volume come up, you see interest, you see the RS, you see relative, the S&P really start killing it. And that's what we're seeing in some of the value plays right now. You know, you look at, look at John Deere. You know, it's up big this year. There's various reasons why. I think it's because people think that these mass deportations are actually going to have a meaningful effect on agriculture, and we're going to need more autonomous vehicles to do X, Y, and Z. I don't need that to be true for John Deere. I just need people to believe it so the stock goes up. Maybe I get 2 or 3, 4 quarters of the happy. Maybe I can get to 12 months in a day to get my long-term capital gains, and then I'm out. But here's the deal. You get into a stock. You want it to be a fast grower because we're not in value land. We're still in, you know, the perception of low rate AI, hot delusion land. And you just hope that you get into something and you have 1, 2, 3, 4, 5 quarters of hitting their numbers and killing it before things get screwed up.
Well, you're speaking like a true trader here. I want to put you on pause for just a second. When we come back, we're going to be talking the magic levels in the SPOOs. That's the S&P 500. And we pit the big, boring banks up against a young, flashy upstart on today's Who Wore It Better.
Oh, yeah. You're not going to forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
We are back, and this episode is brought to you by the number 6,500, which is where the S&P 500 gets interesting to Lee here. So to clarify, this isn't necessarily a target or a prediction, but Lee, you're saying we get to 6,500, what do you do then?
And it's mostly if we get to 6,500 soon. Like if I see 6,500, 6,500, I'm just looking at maybe 10% earnings growth at a multiple that's around where we are right now. If we get there by, say, May or June, too early.
Summer.
Yeah, this summer, to me, the risks outweigh the reward. I'm probably going to rebound. See, right now, I'm overweight in stock. See, my clients are a bunch of retired, scientists and engineers out in New Mexico.
So they don't care about cash.
No.
They want to be overweight risk.
They want to be overweight risk, and they want me not to screw it up. They're retired. They live out their assets. Very different than a young person trying to accumulate wealth. But let me tell you, I'm bullish right now. I'm overweight. I'm long the 30-year. I'm long and not wrong, and I'm excited. But if I see this market get to, say, 6,500 by the summer, you know what that means? It means we've had a lot of valuation expansion, right? It means the PE is going up faster than the earnings come in. I need to let corporations show me the profits that they promise they can make. And I need to see that all year.
Can you say, show me the profits?
Show me the profits. Show me the money.
Isn't that kind of like AI, that people are waiting for the profits?
We are waiting for the profits. And so far, for full disclosure, I'm long Google, and all they say is that we're going to increase CapEx by 30%. That's not shocking, but let me tell you, by the end of this year, I better see some return on invested, investments in terms of AI. And if we don't, I think that it's going to be a more problematic 2026.
Talk about DeepSeek, because we touched on NVIDIA earlier.
Yeah.
Are you saying it's like that was a big surprise for the market?
Cheap AI. Come on, that's a game changer.
Let me tell you how this works.
Please do.
I thought, and I think a lot of other smart people, that I rip off and duplicate. I got the Chinese strategy. Rip off and duplicate smart people, right? It works every time.
We don't endorse that, but...
So I think that the narrative going into the year was, we can see NVIDIA earnings this year. Blackwell's great, big profit margins. 2026, they're going to have to share. With who? And then the value players say, AMD. I'm like, oh, please, child, you know nothing. But what's happened is...
NVIDIA itself.
It's NVIDIA itself. So all that happened. So we've known about DeepSeek for, since December. Here's what's going on. No, they didn't make a model for $6 million. Their final version was $6 million. They're probably lying about a few things. They probably, they clearly were ripping off ChatGPT to do this. But
if they did 25%, though,
they could be right about 10%, and it's a huge thing. Here's what the big issue is. What I was afraid about in 2026, about sharing and there being other things with NVIDIA, that's happening now. And I'll tell you where the clear and present danger is and what people do not understand.
Please.
NVIDIA is number one, not simply because their chips are hotter, because the Chinese just showed us we can use a throttled down version of the chips or lie a little bit about it and we can make it work. The issue is something called CUDA, like a barracuda. CUDA is a software, and that's what lets NVIDIA chips talk to each other and make the magic. AMD doesn't have that software. It stinks. They can't run on Linux. They cannot communicate. That's why AMD is dead money.
Why it's a value stock.
It's why it's a value stock. But here's the problem. What if something out of China or left of center or some open coder running Linux comes up with a way to make the AMD chips talk back and forth each other half as good as what CUDA can do.
Without a redesign. Interesting.
Without a redesign.
Huh.
Now, I doubt that can happen, and I wouldn't believe the first headline that said it could. But if that happens...
You're throwing it out there.
Throwing it out there. If you're sitting around looking for the big catalyst of why you should buy AMD, not to impress your uncle, value trap dude.
We all have one.
We all have one.
Yes.
It's if we can get that software. If not, then NVIDIA is still going to control supply chain. They've got the software. They got the only game in town, and that's going to last for a little while. But I didn't think that the big news this year was going to be NVIDIA has to share with its own self, and that's just I did not think that was going to happen 3 months ago.
Okay, so all this said, do you pile into NVIDIA? Do you look somewhere else?
What'd you do 2 weeks ago?
Let's talk about now. Or where should investors be looking at the AI trade for the next year? Where should they go?
So I decided not to add or do anything with NVIDIA. And where is it now? It's still just sitting there.
Right around the 200, yeah?
Yeah, it hasn't moved. It didn't bounce back. And by the way, just to tack on some pain, I really have done some soul searching and feel that my thesis on the amount of energy that we're going to need for this last year, I didn't buy any energy names, but I've been seriously looking at them. I think I'm wrong. I don't think that January, this big decline we saw, is a time to say go into CEG or go into some of these utilities. I understand what the hype was last year. I know some people in the utility business. The numbers were outrageous. I was looking at things like Eaton. I was looking at CEG. You're just looking around. I'm exiting that thesis. I'm not going to be playing any of those names because I don't believe now with DeepSeek we're going to have as much need for that. I think if you own NVIDIA, you can own it. They're going to still sell a lot of chips. They're the smartest people in the room right now, but I don't think that's where you're going to make the big money. I think you got to look at who's going to be able to provide bolt-on AI productivity tools right now. I think Microsoft paid too much for their infrastructure. I'm nervous about Google, but I'm still long. I could be wrong. Don't listen to me. What do I know? It's a small position. I cut it any day. But I think if you start looking at companies,
क्रूड ऑयल का एफईजी है कोई बीच में? नहीं, यहाँ पर नहीं है. अपर लेवल पे बना हुआ है, वो लगा रखा है मैंने. 7:30 हो चुका है, सीधा यूएस मार्केट ही ओपन होगा लगता है. टेस्ट का वेट करना सही है. नीचे सही है, दोनों ही सपोर्ट बढ़िया है. 6070 to 80 वाला भी सही है और उसके ऊपर वाला भी सही है, दोनों ही सही है. ऊपर वाला कल टेस्ट हो चुका है ऑलरेडी, बट ये अभी भी इंटैक्ट ही है, तो यस. मार्च मंथ का है. दिस इज अ मार्च मंथ चार्ट इन नेचुरल गैस.
have happened on Wall Street. I think the private credit, not only is it giving liquidity to places that are willing to pay 14% because they really don't want to go through the underwriting of banks, and because banks are slow, too methodical, and quite frankly, the best minds have been drained of the banking sector. They're all in private credit. Also, private credit can charge money. When you can charge more than 10 or 20 basis points for a product, and you can charge 1%, you can charge 2% for private credit, you don't have to offer liquidity all the time. You can leverage it. Wall Street can make a huge amount of fees off of private credit, and you have the demand for people who don't want to sit around trading the 30-year, and people may not want to sit around getting 6% on some, junky double B 2.5 duration ETF crap that you see today. So I think private credit's going to be what? Am I worried about the leverage and all this and that? Not particularly. Let it blow up. It'll just give me an opportunity to buy.
What, the 30-year?
Always.
All right. We have wound things down. We're up against the clock. Make sure you check out all our other episodes of Stocks in Translation on the Yahoo Finance site and mobile app. We will see you next time.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Welcome to Financial Freestyle. Hi, I'm Bob Howell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy. And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith. Let's bring you the 3 things that you need to know this morning.
Good morning, everyone. First up, stock futures wavering this morning after the S&P 500 closed lower in Monday's session, extending its decline after the benchmark saw its worst sell-off this year. Investors grappling with potential growth headwinds here posed by the Trump administration's tariff plans, which the president said are, quote, on time and moving along very rapidly following an initial delay.
Plus, investors digesting the latest earnings ahead of NVIDIA results tomorrow. Home Depot rising this morning despite the world's biggest home improvement retailer expecting sales to rise by less than expected this year as consumers remain cautious on large home projects. Meanwhile, NVIDIA out tomorrow after the bell. Investors will be closely watching for the potential impact of chip curbs on China following a Bloomberg report that the Trump administration is looking to toughen Biden-era rules.
And the sell-off in crypto gathering steam this morning, with Bitcoin dropping below 90,000 to its lowest level since November. Macro pressures on risk assets fueling the drop, as well as souring sentiment following the biggest ever crypto hack targeting exchange Bybit. Stock futures wavering this morning after stocks struggled to recoup losses following Friday's sell-off here. We're taking a look at some of the pre-market activity. We are mixed right now for the Dow and the S&P 500. We're in positive territory. However, taking a look at the NASDAQ, still got a little bit of catch-up on that one. It's flat, but to the downside here. I guess you could say the S&P 500 as well is flat here. We're getting even more earnings rolling out. We're going to dive into one of those big names here. But ultimately, as we think about what the markets are continuing to try and weigh and ultimately prove resiliency through, it is a lot of the tariff talk and the will they, won't they ultimately roll these out at the start of March. That is the core dates that we're continuing to look at here, and especially as even more of the geopolitical conversations are taking place. Macron taking a visit to the White House as well. All of these things considered, it's all about the tone that the president looks to strike and then what that could potentially mean for some of the additional tariffs he looks to levy in some of the negotiation tactics that have been rolling out within the first, it's only been a month. Just 4 weeks since the inauguration.
It's like a long month. There certainly has been no shortage of headlines, no shortage of topics for us to talk about. But I think what's interesting here in the market reaction that we have seen, the market action that we've seen over the last couple of trading days is more this risk-off sentiment. Yes, you are seeing the Dow right around the flat line. You are seeing the S&P hover there as well. But again, you're looking at tech under a bit of pressure with the NASDAQ on track to open the day in the red. You take a look at the move to the downside when it comes to Bitcoin, some of the crypto related trades. Yes, obviously, certainly that is a headline driven and very much market specific. Maybe when you dig underneath the surface and see some of the headlines that is driving and that move to the downside there when it comes to the hack and ultimately what that means here more broadly speaking. But I think when you take a look at the equity market, when you take a look at the fact that yields right now are the lowest that we've seen since December, we certainly have seen this risk-off sentiment certainly creep into the markets. And we're seeing more and more strategists point out in their notes over the last week or so just about a little bit more concerned about the slowing U.S. economy right now and whether or not this is the start of the trend, if this does continue for another month or two, just ultimately what that signals just in terms of whether or not the market's going to be able to continue to shrug off some of these slowing concerns.
Yeah, you talk about those strategists. We got a note just this morning as well from UBS, and their chief investment office continues to expect volatility. However, they are believing that the markets are likely to refocus on fundamentals, they say, that should support the equity rally further here. 3 of them that they're really pointing out here. 1, China internet remaining attractive on solid fundamentals, they say. Tariff headlines should be considered in the context of broader U.S. economic health. And then lastly here, the third to round it out, AI rally, they say has further to go. And that next test could be just later this week when NVIDIA reports.
Let's talk about that because chip makers are wavering this morning after dropping on reports that the Trump administration is planning to expand efforts to limit China's technological advancements. The clampdown would include tougher semiconductor curbs and pressuring allies to escalate restrictions on China's chip industry. With us now for more, we want to bring in Ben Bajarin. He is a Creative Strategies CEO. Ben, it's great to have you back here. Great to have you on Yahoo Finance. Let's talk about how much is at stake here for the AI trade. Obviously, obviously, when you take a look at the report that we will be getting after the bell tomorrow, what is that indicative of? Just how critical are NVIDIA's results to the overall momentum of the AI trade?
Yeah, I mean, I think, anybody who's followed NVIDIA long enough knows that, their CEO, Jensen Huang, has a pretty good point of view of where things are going. I think they're a very good predictor of demand. They obviously see their roadmap and what their customers are looking to do, not just buy GPUs, but to really run that software and what future models will look like. So I think, regardless of whatever the estimates are, I mean, I've seen everything from, flat to strong beats and raises, right? The bottom line is the demand for GPUs remains incredibly strong. And I think a lot of people are going to be looking for that commentary as to how do they set the market and how do they maybe talk more about full year demand, what they're seeing, because I think a lot of people still have a lot of questions about full year. And I think Jensen's going to be in a position to bring a lot of commentary to that as well. And, a lot of what he says will help seed and bring some lift to that market, not just this quarter, but really for the rest of the year.
Ben, when we do see dips in AI-related tech stocks here, how can investors aptly decide or make sure that they are evaluating the difference between quality AI stocks versus those who are just slapping AI on something and saying, hey, we're leveraging it and it's going to prove to be more efficient for us?
Yeah, I mean, I think there's some fundamental technology differentiators that any good play here is going to have, right? I mean, semis is one of the biggest ones, as you see, and you see some of the most popular names, not just being NVIDIA, but being Broadcom, Marvell, obviously AMD's in there, and I think people want to see more in terms of what Intel's got up their sleeve, not just from product, but also manufacturing, because manufacturing AI chips, as we've seen with TSMC, another one, right, ASML, these are fundamental companies that at a technology level aren't going anywhere and provide, critical underlying technology for the AI industry. I think there's some other elements in software that's going to be interesting. I know a lot of people talk about when are we going to see monetization in software from the hyperscalers. Everything we hear in terms of numerous CIO, CTO conversations continues to suggest that those enterprises will start to move from pilot to full deployment at scale toward the end of this year and into 2026, which again means that you've got to have all of that infrastructure in place to start inferencing at scale. So we think you're going to continue to see that wave, and I think there's those hardware and chips and then software and the hyperscalers and others where they're going to start monetizing this infrastructure toward the end of this year.
Ben, when you take into account the reports that we're getting just that the White House could potentially crack down even further on some of these chip export controls, what's the ultimate impact, do you think, to some of the leaders within the space?
Yeah, I mean, the big thing, like we've seen with tariffs in the past, is really just going to be an impact on margins, right? We don't think that this is going to slow down the sales of any of these things. And I think, when you look at the demand versus sales in any quarter, right, the big thing is just to say, like, well, we're not losing sales. They might be pushed to another quarter. They might be delayed, but they're not lost. And I think that's the part of if somebody decides to not buy this quarter, but next quarter or whatever those dynamics are, we just continue to see so much demand for AI infrastructure. And we believe that will continue, that it's really going to be a margin question, which then comes down to who has margins to give. And there's a handful of companies, there's not many, but there's a handful that can absorb those. And there's many where that will be more margin pressure, which will have a much dramatic impact on earnings.
What do you think DeepSeek exposed about the AI trade right now, or perhaps even about some of the froth that's around the trade?
Yeah, I mean, the biggest thing is it doesn't change anything in terms of demand. I mean, I think we have been wanting cost per token, right, from an inference standpoint to come down for a while. That's been predicted for years. The question was when we'll see models that can do things which we call reasoning or long thinking types of models for inference. Everybody wants these costs to come down. To be honest with you, we need those costs to come down so enterprises can move from project to deployment, right? Because if you just think of how many people in your enterprise are going to be querying or inferencing, doing any type of agentic research on a daily basis, if you're paying whatever 10, 15 cents per token, that could get pretty expensive. If you're paying 1 cent per token, that's much more economically friendly for your enterprise. So we want those costs to come down. Those costs come down so consumers can use Gen AI. Everybody who wants to monetize and have ROI on this needs those costs to come down. And that was the positive from DeepSeek, is that it really can do deep thinking, high forms of logic at lower cost and at efficiency. And I expect every model to follow suit, which will be very, very good economically for this industry.
But very much so going into this and ahead of the DeepSeek revelation and some of the advances that we learned about, NVIDIA very much viewed as the golden child almost when it comes to the AI revolution and adoption. Does DeepSeek at all change that?
No, I don't think it changes anything. I think, again, what you're going to see is more models follow suit. I think the big positive here was really just the opportunity for open source. This has been a real big question. You know, when you look at any enterprise survey today in terms of those enterprises I was talking about who are in project mode, it's like over 70% of them are using OpenAI, which is a closed model. So if that continues, great for OpenAI, great for Microsoft, who will benefit from the bulk of that infrastructure. But the reality is there's a lot of enterprises out there who will take a very good model that is more open source, that they can tune themselves and deploy either on-prem, on-device with AI PCs or AI smartphones, and those need to be open source. So I think what that did was just bring this question back to what does open source mean for this industry. Again, we don't know the answers. We're still in maybe inning one of the AI, momentum that we have here. But it's good for open source, and we hope, Meta does models there, Amazon has others. We hope that that's good. To just bring more variety and more competition to the LLM space.
Ben, just lastly while we had you mentioned Intel earlier in the chat here, and I just wanted to get your outlook for what the recovery story looks like for this business. It sounds like you believe there could be a recovery story. Is it a sum of the parts that ultimately then gets put into some type of deal conversation?
Yeah, I think you've always got to look, right, as the product portfolio, the whole sum of the parts, like you said, of Intel. I think there's two things going on that we should be, really focused on. One, what are their technology differentiators from a foundry standpoint? I followed this rumor around TSMC and others as a joint venture, and when you looked at how people were valuing Intel, or at least how they were valuing foundry, they were valuing its book value really just in assets. There was no much percentage of increase on that in terms of what a deal could look like for core IP. Yet at the same time, we know that Intel Foundry has a lot of very good core IP that they've been developing, and that should be worth something. And so I think we've got to take into account what are they doing with underlying manufacturing technology, things like Power Via, innovations in backside power, what they're doing in transistors, in design. We need to think about that the same way that we think about what TSMC brings to the table that differentiates their customers to go and compete and design products. So it's a foundry story. And then I think a lot of people honestly miss that the CPU is still highly relevant to AI infrastructure. It's one of the most critical parts to reduce latency, to manage the orchestration layer. And so I think we forget, we get really caught up in GPUs and custom ASICs, and those are all great. But you look at what's going on, and AMD and Intel are both in this case, is that there's actually a really nice upswing for designed CPUs that are built from the ground up for AI. And we don't have those yet. We have legacy CPUs running AI. And eventually both those companies, I think, will participate in the CPU side of this side as well, and be able to charge higher prices and play a more critical role just from the CPU side. So I think from Intel, you've got both of those. You've got product with a lot of opportunity, and you've got foundry with a lot of opportunity. But the point is, it's a long story. I think that's what people have been frustrated with Intel is it's going to take time. It's not next year. It might not be the year after. It's more toward the end of this decade. And I just worry people lose patience.
We didn't even let you know that was a topic we were going to talk about. Ben, appreciate it. Thanks so much.
Yeah, thank you. Thanks for having me.
Certainly. Home Depot narrowly beat sales expectations in its fourth quarter. The home improvement retailer posted positive same-store sales growth for the first time since 2022, after 8 straight quarters of declines. Here with more on the results, we've got Yahoo Finance's Brooke DePalma. Brooke, what do we know?
Good morning. Well, investors were certainly excited about that same-store sales growth, the first positive results that we've seen in 2 years from the home improvement retailer. But investors also a bit disappointed when it comes to a cautious guidance that the executives set out amid higher interest rates and stubbornly high interest rates that are really causing consumers to continue to push off those larger projects. And if we could take a closer look at that 2025 guidance here that disappointed investors, total net sales expected to grow 2.8% in fiscal year 2025. We also know that same-store sales growth expected to increase just 1%, and adjusted diluted earnings per share expected to decline approximately 2%. That's really causing some disappointment among Wall Street this morning. Now, sources that I've spoken to this morning said that did prove a bit conservative amid this uncertainty within the home improvement sector, but executives are hoping that consumers ultimately get used to these higher interest rates and pursue these higher projects, or rather higher ticket projects that they've been pushing off. Another thing is that exciting same-store sales growth that increased 0.8% in the quarter. Once again, that is positive results for the first time in 2 years, and that was largely boosted by Hurricane Milton and Hurricane Helene. That boosted results by roughly 60 basis points. It also reflects growth within their pro-heavy categories like roofing, drywall, and lumber. Also strength in e-commerce. That was up 9% for the quarter, and all that really led to positive foot traffic. That increased 7.6%. That's the best foot traffic that Home Depot's seen in a quarter in nearly 3 years. That's compared to a decline of 1.7 in the prior year. Now, one thing that has Wall Street also excited is this acquisition of SRS that happened last June. We're currently listening to the call, but CEO Ted Decker said so far in the call, he called it additive and complementary. He also said that it contributed $6.4 billion in sales for the first 7 months that it's owned this distribution for residential professional customers. So really focusing in on that pro business here, SRS is expected to bring in, grow mid-single digits as far as organic sales grow in fiscal 2025. So lots of excitement around the pro business, but consumers still pushing off those higher ticket DIY projects.
Well, they'll be very pleased to know that DIY projects for home improvement are very heavy in my algorithm right now. I don't know why. I don't even have a home.
Hey, what do you have in the pipeline that I don't know about?
Nothing. Just an IKEA Billy bookcase in the shopping cart.
That is exciting.
Yeah.
Gotta start somewhere.
Yes, you do. All right. Well, Brooke, thanks so much for starting off our day like this. As we head to break, let's get a check-in on shares of Palantir. PLTR is the ticker symbol. We are taking a look at shares right now. Pre-market up by about 1.7%. However, that is not going to be enough to erase the slippage that we've seen over the past few sessions here, as PLTR shares have been down, especially on some of the reports about cost-cutting at the Pentagon, and more broadly, what efforts the Department of Government Efficiency might put forward in order to try and slash some of those costs. The slippage has been bad over the past 5 days, down 25%. We'll continue to track that going into the opening bell. We've got much more ahead on Morning Brief.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
And that's the opening bell on Wall Street. Let's do a check of the markets as we begin a brand new trading day. You are looking at some gains, I think we could call it there, and be excited about here for the Dow. We are just above the flat line here, up just about 100. But when you see some of the pressure, more broadly speaking, obviously tech still in the red. When you have to see some pressure from the Nasdaq, you do have the S&P right at the flat line here at the open. Not too much movement here, but the big question here is whether or not we are going to be able to regain some of that momentum. How much of that is going to be hinging on the results that we will be getting from Nvidia tomorrow after the bell. Taking a look at the Nasdaq, under some pressure here this morning, off just about 0.3%. I do want to pull up some of the action that we are seeing in the bond market here. You are seeing this move lower in yields. Actually, the lowest level that we've seen in yields since the start of the year. So again, when you see that move lower here, we are seeing bond prices move to the upside. And also the VIX, the volatility index, just to call that out, we are around the highest levels, I believe, that we have seen since the start of the year. You pull back that year-to-date chart there, you can see right around the levels that we saw in early January there. So again, some of this move to the upside. And taking a look at the sector action here very early in the trading day, you are looking at a lot of green, or a little bit more green on the screen. You got financials up just about 0.5%. Consumer staples also not too far behind. On the flip side, because of the Nasdaq, you're having the tech sector, XLK, that's off just about 0.2%. Utilities, the worst performing so far, just here at the open, off about 0.6%. Jared Blickery is standing by with a closer look at some of that movement that we're seeing. Jared.
Thank you, Shauna. Yes, we are seeing kind of a risk market breakdown here, and I'm going to go back to back to the major indices. I'll put a 5-day chart so we can see the S&P 500 and what it has done recently. Yesterday, I think, was very instructive because we started out with a little rally, and then we got into yesterday and the day before's territory, into Friday's price action territory, and then we just sold off pretty hard. Let's take a look now. This is the S&P 500. Let's put a 4-day. Well, it looks like the charts aren't cooperating this morning, so I'll just tell you that the VIX has been up 4 days as well. Small caps leading down today. And let's see if we can get a chart of the 10-year T-note yield, and I'll just put the quotes on. That is down 8 basis points, so 4.32%. We haven't seen that in about 2 months, and that's fairly significant. And I've been highlighting that lower yields are generally good for risk markets, but that's always contextual. You don't want yields falling in terms of a safe haven flight into bonds. Bonds move inversely to yields, so bonds are going up right now. Let's get to the sector action, because not everything is going down. Consumer staples has been going up, but that is a defensive sector, and we'll see if I can get a 5-day chart on that. That has been heading higher 2.5% over these trailing 5 days. And another sector that's not doing so well, but in the consumer sector, is discretionary. And XLY, that had been down 6 days. Today would be the 7th day, and that is an Amazon and Tesla story. The weakness that we've seen in Amazon, because Amazon is down 6 days in a row as well, that has been a more dominant factor. But we know that Tesla has also exhibited a lot of weakness this year. I'm going to switch over to the NASDAQ 100, and you can see a lot more red than green. Apple has been a bright spot, but I did want to just pull up a chart on Amazon one more time. There we go. That is down 5 days in this chart. It's been down. That would be a 7th day if I'm counting correctly. So some weakness in the mega caps overall, which we can also see in the Mag 7 ETF. And I think that's instructive as well. So the ticker there is MAGS, and we'll see if I can find it on my little screen here. And even if I can't, we've had, there we go. It's down 0.7% today. I'll put a year-to-date chart on there, and you can see how it just broke that support that it held since the beginning of the year. And in fact, that is a 2-month low that we're looking at for the Mag 7. Bitcoin is another sore spot for the risk markets. I'm going to show you a lot of red right there. Bitcoin is down 7.41% over the trailing 24 hours. Ethereum and Ripple, those are each down 10%. But let me just show you the kahuna here. This is Bitcoin. We had a nice, what looked like a base, and you never know if it's a base or a top until it actually happens. But we are now heading down. And the one bright spot for bulls that they can cling to is we have had so many false breakdowns and breakups in Bitcoin, a lot of fake outs. This could just be another one of those. So we'll look for a reversal of this. If it climbs back over 92,000, especially within the next few days, that might just mean this was a temporary washout. And I think that's the best case we can say for the short-term bulls right now. But long-term bulls definitely have the edge, as we can see in this chart. Guys?
Jared, thanks so much for teeing up today's trading activity. Appreciate it. Time now for today's strategy session. U.S. stocks struggled to recover from the S&P 500's biggest sell-off this year on Friday. Still, the benchmark index has gone 36 trading sessions without back-to-back drops of 1%. So will the dip buyers return? That's the big question. Joining us now with more, we've got Michael Reinking, who is the New York Stock Exchange Senior Market Strategist. Great to have you back here in studio with us. I was reading your note at the end of last week and talking about some of the flashing warning signs, and I believe you were looking at the S&P 400 mid-cap, within that looking at some of the consumer staples as well.
Yes.
Where are there still flashing warning signs that you're
Yeah, so I mean, over the last couple of weeks, while the S&P 500 was making these marginal new all-time highs, you continued to see the small and mid-cap indices kind of trading pretty poorly. They couldn't actually break above their 50-day moving averages, right? And then one of the things that I like to watch, kind of at these sort of turning points, is the performance of staples versus discretionary, something that Jared was just kind of talking about, right? And you started to see over the last couple of weeks, you started to see staples start to outperform. That actually really, really accelerated at the end of last week, and that's despite the fact that you had Walmart trade down 10%, and that's the biggest component within kind of the staple sector, right? So you've seen kind of this flight to safety. You've seen defensive sectors have really been outperforming. You had the S&P 500 was down almost 2% last week, but yet you had kind of the split between kind of sectors under the surface, right? You had kind of all those defensive sectors that were kind of really outperforming.
Do you see that at all changing or reversing, just depending upon what we get from NVIDIA tomorrow?
It's hard to put it kind of completely on NVIDIA, because I think one of the things that, I highlighted that I was watching the mid-cap indices, right? And the mid-cap index is sitting right at its 200-day moving average right now, right? And we've reversed all of those kind of election, kind of all those election gains. I think part of what the market's dealing with a couple different things here, right? We're dealing with a growth scare, as we've seen a lot of the kind of survey data, right, has come in pretty negative, right? We were also seeing negative earnings revisions, right? So we've had a very, very solid quarter, kind of from an earnings perspective. But if you look at, kind of the year, the earnings estimates for the year, right, for the mid-cap index, they're down about, kind of about $10, right, from kind of 205 to the low 190s, right, over since the end of Q3, right? So NVIDIA could help to kind of put a bid back in that Mag 7 and take out some of the concern that we've seen in the unwind of kind of this AI infrastructure trade. If they can kind of convince people that there is still this kind of burgeoning demand, and it could kind of help the S&P 500. But I think for that broadening story to happen, right, we're going to need to kind of work through some of the other issues.
Don't we typically hear companies adjust their earnings forecasts for the year early on in this first reporting period? Why is this time atypical of what we've seen in the past?
Yeah, so I don't think it's necessarily atypical per se. I think that there were very high expectations coming in, right? So we were looking at kind of not only the S&P 500 to show 15% earnings growth rates, but we were also looking at kind of those small and mid-cap indices to show similar growth rates. Those have already been revised down to under 10%, right? And so I think part of what's happening, and this was something we talked about in our earnings preview, is that we would have a solid quarter, but just given the amount of uncertainty, right, that we have, from a policy perspective and just an economic perspective, right, management teams are going to be kind of cautious, right? And so you've seen some caution built into those kind of earnings estimates through the back half of the year.
Michael, when it comes to some of that risk-off sentiment, take a look at even just, for example, what's happening in crypto this week. Is there more of a read-through on that? Obviously, some of that being headline-driven with hacks and everything, but beyond that, is that a signal of something a bit larger here that's at play?
I think you've had this like very crowded positioning, right? So you've seen kind of the retail crowd, and people have just kind of been moving into these momentum assets, and momentum unwinds happen very, very sharply and aggressively. I don't know that it necessarily kind of signals anything kind of larger outside of a reset, which in theory, in the longer run, can actually be positive. I mean, it's interesting, to go back to Walmart for a second. Like Walmart was up over 50% from the end of Q2 heading into earnings last week. Walmart had become almost a momentum stock in and of itself, right? Where it was this kind of place to kind of move within the market. And you saw those, the numbers were pretty solid from a quarterly perspective. Their commentary was pretty solid. The guidance was a little bit light. I think there was some caution built into that as well, right? But you saw the stock get hit, by 10%, call it, right? And that was kind of this kind of momentum unwind, and it's just expectations heading in.
We've made it this entire conversation, and we haven't said the Fed or FOMC. What does that tell you about the prioritization in the minds of the market right now?
Right. Well, I will say that, the move that we're seeing in interest rates right now is concerning. For me, right? I mean, it seems like just yesterday that we were talking about, the move higher in Treasury yields, like it was all but, less than a month ago when you had the 10-year was at about 4.8. Right, we've now come in about 50 basis points, and everybody was worried about term premia and inflation concerns. Now we're seeing kind of those growth concerns, kind of start to bubble back up. I would caution, I think, what we're seeing in terms of those growth concerns, they're all coming from the survey data, right? And if you think back over the last couple of years, the survey data also told us that we were going into a recession, right? Multiple times, right? So that survey data has been, negative as things were positive. We're seeing kind of a turn here and some uncertainty. I think that's, kind of an expression of uncertainty. But until we start to see the economic data turn, that hard data start to turn, right? I don't necessarily, I wouldn't put too much weight into that survey data.
So you're not too worried then, I guess, about some of the weakness that we have.
I mean, there's concern, right? I think the key is from here, if we do start to get a bounce and we want to see kind of that broadening, like the broadening hasn't happened as investors have hoped in kind of the small and the mid caps. Right, it's happened outside of the U.S. Throughout the start of the year, with Europe outperforming, kind of pockets of Asia outperforming. When we start, if we can get this bounce, because we're at this key technical level, and we've been down for a couple weeks straight. If we can get a bounce, you want to see how we kind of interact with some of those, kind of shorter moving averages, and see if we can kind of build a base here, kind of for markets to propel higher. I think. We have a couple things from Washington that that are kind of top of mind. We have a debt ceiling negotiation. We don't know where Washington policy is. So there is this uncertainty. And we've had kind of the sequencing, which is something we also talked about the last time I was here. Right. Thus far, the sequencing has been kind of negative growth, kind of from Washington as opposed to that pro growth. So if we can kind of move through this piece and then kind of turn the page to some of those more pro-growth policies, that's where we can kind of start to move forward.
All right, Michael, always great to talk to you. Thanks so much.
Thanks for having me.
So time now for our chart of the day. Let's send it over to Madison Mills. She has a closer look at the moves lower that we've seen more recently in the Mag 7 names. Maddie.
That's exactly right, Sean. The Magnificent 7 ETF is at a 2-month low this morning. You can see here the Magnificent 7 names falling nearly 9% since their peak back in December. And you can see the last time that the Mag 7 ETF entered near correction territory, which would mean a decline of 10%, was back in August during that sell-off that hit below 15%. So we are inching towards that territory. When you look under the hood, it's really interesting to see which of these 7 names are the biggest movers here. Tesla is the biggest laggard of the group, falling since its December high, followed by Microsoft and Alphabet. As we've continued to mention, given that 20-session streak of Meta, they are the only member of the Mag 7 that's been in the green during this a little bit of a rout, you could say, that the Mag 7 names have entered here as they near towards that correction territory. But of course, the focus of the Mag 7 this week is NVIDIA, heading for those earnings on Wednesday. And I saw this stat this morning that really stood out to me. This idea of, pressures on NVIDIA with DeepSeek and cheaper AI has led to a little bit of a sell-off in that name to the tune of $600 billion in the month of January. But we're still seeing investors piling into the stock. $5.7 billion has gone into NVIDIA this year. That is more than double the amount of inflows NVIDIA saw year to date at this time last year. So we're still seeing some bullishness in the stock. The stock has 90% buy rating from Wall Street. If you take a look at the analyst recommendations on Bloomberg, of course, we will continue to monitor NVIDIA and the rest of the Mag 7 as we head into that key chip giant earnings tomorrow, guys.
Key, critical report. Can't wait. Maddie, thank you so much. Appreciate it. Coming up, everyone, a disappointing quarter for Krispy Kreme. The key crispy trade here, how the donut chain plans to turn it around this year. CEO Josh Charlesworth joins us next. You see him there, hear him in a moment. Next on the Morning Brief.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We're 30 minutes into the U.S. trading day. Let's get into 3 catalysts that we're watching this hour.
First up, a risk-off shift in the market as the 10-year yield hits a low for the year and the tech-heavy NASDAQ continues to fall.
Plus, the latest consumer confidence data crossing the wire, what the numbers tell us about inflation expectations.
And Bitcoin sinking to a 3-month low. We'll unpack what's driving those declines right here on Catalysts. We're getting a preliminary reading on consumer confidence in February, dropping sharply here. You've got the survey anticipating 102, but the number coming in stiffly below that at 98.3 and also below the prior reading of 104.1 here. So interesting to see that level of a decline here. Again, that consumer confidence number coming in below the survey number, which was 102. The actual number coming in at 98. Conference board expectations also falling, coming in at 72.9. So we're going to continue to break down those numbers as we get them here. Joining us now, we've got Yelena Shaletyeva, the Conference Board's senior U.S. economist. Yelena, I'm still waiting for all of the data to drop in, but what else can you tell us?
Well, I think it was a sharp drop, no doubt about that. And now the index is at the lowest level of the range it has been hovering over the last several years. Having said that, I think the index is still within the range, which is associated with healthy consumer spending, although the decline in expectations is definitely a concern and deserves a close watching.
When you say it's a concern, I guess at what point should we be a bit more worried? And what is that range that would then drop below that we would then, I guess, would raise some of those concerns?
I think this particular survey from the Conference Board is telling us a lot about the state of the labor market. Mm-hmm. And this particular decline in the confidence indicator was driven by consumers' expectations for business conditions and the labor market. Mm-hmm. So what is a concern is that consumers are not seeing great prospects in the labor market, and that is something to watch in the months ahead. If that continues to deteriorate, that's a big deal.
But it also looks like inflation expectations ticked up. Median inflation expectations coming in at 4.8%, following 4.2% the prior month. How concerning is that?
Consumers are worried about inflation. Inflation is sticky, and the latest developments in terms of, I would even say, some certain consumer goods such as eggs, that could be driving it, and also the talk about tariffs. So we know that next week the next round of tariffs is probably going into effect, and consumers hear this news and they are very concerned about this. So everybody is talking about inflation rising on the back of tariffs, and that is a great concern for the consumer.
Yeah, I'm taking a look at this release here. It looks like that the decline was across all age groups, also was pretty broad-based among income groups. What's your takeaway from that, just the fact that we are seeing some of that concern really just across the board?
That is a concern. We know that consumer spending has been in a large part driven by those at the top of the income spectrum. So those more affluent consumers who have assets on their hands, they are, they hold stocks, they have property, real estate property, they have been driving consumer spending. But the fact that it's a decline across the income spectrum and age groups is a concern, because that's our consumer spending, and if this is going to slow down significantly, that's a concern for the economy.
It's interesting, though, in this note, in the survey data here, looking at a 6-month average basis, purchasing plans for homes continued to recover. I wouldn't have expected that based on what you just said, that all income groups are feeling a little bit more negatively about the economy. Where is that recovery in housing coming from?
I don't expect the recovery in housing this year. Rates are still elevated. The affordability is still pretty low given where the prices are. We actually have a drawback from the residential investment sector in our projections for the economy for this year. So I think, until we see a more significant decline in long-term rates or, like deceleration in price increases for housing, we will probably not see a significant improvement in the sector.
What are you hearing just in terms of the fact that we could be in this high for longer environment and how much pressure that could potentially put not only on the sentiment side of things, but obviously that hard data too? So
I think, what we expect for the economy is deceleration this year. So we are coming from this high growth that we saw post-pandemic. So that process is continuing. So we saw some pickup in consumer spending over the turn of the year, and probably that was driven by consumers trying to stock up ahead of tariffs, and businesses too. Now that, that has already happened, I think we were going to continue to slow down towards the end of the year. My concern is the labor market. If it slows down significantly, that would pull things quite significantly below what we expect.
So how are you thinking about the divergent policy impact on the labor market? Obviously, we're seeing cost cutting leading to a lot of layoffs for federal workers, but then you have news like Apple adding 20,000 jobs to the U.S. Do you think that these U.S. companies adding jobs could offset some of those concerns?
For now, we're at a very happy equilibrium, right? So we're not adding too many jobs, but we're also not cutting. There are no layoffs. So it could go either way, right, depending on how businesses are feeling. So we had another survey earlier last week that showed business optimism was rising quite significantly. So which way will it go? We don't really know. And for now, businesses feel optimistic, and they are expected to hire people. But at the same time, if tariffs have a significant impact on economic growth and our expectations that it could potentially cut up to 1 percentage points from growth this year, if what has been announced is implemented, then, we're probably going to have a different story.
All right, Yelena, great to have you. Thanks so much for joining us.
My pleasure.
Let's take a look at a trending ticker here this morning, and that is Home Depot, the company issuing a conservative same-store sales forecast for the year as it expects consumers could potentially hold off on some of those larger purchases. But the focus on the street, the reason why we're seeing the stock up nearly 3% here in early trading, much of that has to do with the stronger than expected quarter, the fact that same-store sales did snap 8 consecutive quarters of declines, actually rising 0.8% from a year ago. Joining us now to discuss is Michael Baker. He's D.A. Davidson's senior research analyst. Michael, it looks like the street at least looking at the more optimistic side of this report. I think the big question is whether or not some of the improvement that we saw in same-store sales, whether or not there's enough momentum for that to continue. What do you think?
Yeah, I think the strength in the fourth quarter is really what is carrying the day here. The 2025 outlook was below consensus, particularly on the earnings side, a little bit more so than on the sales side. Both were below, but I think the real pressure point was the earnings. But it's pretty clear, I think, from the call and from what we know about retailers in general, that companies want to sort of set a lower bar. That doesn't mean they're sandbagging it. January was a softer month than December, so they did see a little bit of a slowdown. That plays into the guidance. But I think the bigger idea is, let's just set a low bar, something that we're comfortable with, given all the uncertainty in the environment, all the policy rifts, as we call them, our acronym, for rates, inflation, FX, and tariffs. It makes sense to set a low bar. But clearly the business seems to have bottomed, given what we saw in the fourth quarter in a number of metrics the company talked about on the call. Big ticket, spending, et cetera.
Well, it's interesting, though, because the CFO did mention that they're still facing pressure as customers adjust to high interest rates. How concerned are you about the headwind that could present, especially if the Fed does not continue to cut rates?
Sure, that's a pressure point, but it's a pressure point that's not getting any worse, right? We've been dealing with that for quite some time. In fact, rates don't seem to be going up anymore. They're down 30 basis points or so on the 10-year in the last month. Home Depot gives a metric on comp sales for tickets $1,000 or higher. That was positive this quarter. That's the first time that's been positive for more than 2 years. It had been down 5-6% every quarter. So there's still some pressure on these interest rate sensitive businesses, but again, no worse so than it has been, and maybe even getting a little bit less worse.
Michael, one of the questions going into this report was the impact of tariffs and the threat of tariffs, maybe what that could do ultimately to Home Depot's business in the longer term. Where do you stand on that, just the broader implications of it?
Yeah, to me, tariffs are a relative game, right? It's all a function on how much of your COGS come from overseas, and then your ability to push back on vendors or pass through to consumers. And we think within that sort of dynamic, Home Depot is pretty well positioned, particularly as it relates to pushing back on vendors. That's all about scale. Home Depot pushes a big pencil. Their vendors want to keep that Home Depot business. That doesn't mean the vendors will eat it all and Home Depot won't absorb any. But within that sort of negotiation dynamic, Home Depot is pretty well positioned in our mind.
So it doesn't sound like it's too big of a concern, but I guess how big of an impact is it going to have on their business?
Well, again, if anything, we think it'll tend to be maybe slightly positive because we do think they'll be able to pass some of it through to consumers. That's what we saw last time there were tariffs in 2018-19. So maybe even a little bit of a comp benefit. Now the offset could be, do you lose units? But that's not really what we saw last time. So listen, we don't want to dismiss it. We do think it could have some impact, but they will be, particularly on the margin side, but they will be impacted less than others. And again, it could actually be a helpful item to the comp line.
One of the concerns from a macro level is this idea of a K-shaped recovery and that lower income consumers will potentially be more negatively impacted by the policy shifts of things like tariffs versus higher income consumers that have a little bit more on their balance sheet to protect them from any inflationary pressures. How does a company like Home Depot potentially get impacted by a K-shaped recovery if we do start to see those middle and lower income consumers struggling even more?
Yeah, Home Depot does skew more towards higher household income customers just by virtue of the fact that you're a homeowner. So that kind of dynamic, while unfortunate for the lower end customers, it really does play well for Home Depot, which again, more of their customers are in that middle to higher income demographic.
Michael, who's best positioned within this coverage space right now to you here over the next couple of quarters?
Well, we like Walmart, particularly on the pullback after last week's report. We like other discounters like BJ's and Costco, but BJ's better just given the lower valuation. When I say other discounters, we don't love the dollar stores, but BJ's and Walmart within the discount space. And then I think there's an opportunity here at Home Depot. We upgraded it last year. We knew we'd be a little bit early as it relates to the housing recovery, but housing's not getting worse here. In fact, existing home sales have been up on a year-over-year basis 4 months in a row. So again, we think we're in front of the recovery, but that's really when you want to buy stocks in front of the recovery. So we think we're there now.
All right, Michael, always great to talk to you. Thanks so much for hopping on with us here today.
Sure.
Coming up, we're going to take a closer look at some of this morning's trending tickers, including why shares of Supermicro are off just about 8.
Okay, guys, news थी crude oil में regarding the Russia sanction through USA की ओर से जो सैंक्शन लगाए जाते हैं उसमें शायद थोड़ा सा ढील मिल सकती है या फिर यूएस सैंक्शन हटा सकता है, ऐसी एक न्यूज़ है। डोनाल्ड ट्रंप की ओर से स्टेटमेंट आया है, देखना पड़ेगा कितना रियल है कितना झूठ है, बट या दैट इज़ अ न्यूज़। कैंडल देखोगे ओपन इक्वल टू हाई बनी और डायरेक्टली फॉल कर गया। ठीक है, न्यूज़ नेगेटिव ही थी क्योंकि अगर सैंक्शन हटते हैं रसिया पर से, so in that case definitely it will be नेगेटिव न्यूज़ फॉर क्रूड ऑयल। कैंडल ओपन इक्वल टू हाई है, लेवल के ऊपर क्लोज करती है तो बाइंग कर लेंगे यहाँ पर, नहीं तो फिर और गिरना चाहिए प्राइस को। फिलहाल मुझे देखना पड़ेगा और क्या क्या स्टेटमेंट में इन्होंने बोला है, बट या दैट इज़ अ मेजर न्यूज़ राइट नाउ, द स्टेटमेंट फ्रॉम द यूनाइटेड स्टेट ऑफ प्रेसिडेंट ऑफ द यूनाइटेड स्टेट। डेटा भी दोनों आने थे, आ चुके हैं 7:30 और 8:30 वाला, अब कोई डेटा नहीं है। देखो कैंडल क्लोज हो गई है, करंट कैंडल फिर से ओपन इक्वल टू हाई बनी है, दिस कैंडल अगेन ओपन इक्वल टू हाई। बाकी जिन लोगों ने ऊपर से सेल किया हुआ है अगर एफईजी के अराउंड तो ट्रेल कर लेना, क्योंकि ओपन इक्वल टू हाई में डायरेक्टली बाई कर नहीं पाएंगे, यहाँ पर सपोर्ट है बट नहीं कर सकते। अगर ये गिरता रहा इस तरह से तो और नीचे जाएगा बिकॉज न्यूज ही नेगेटिव है प्राइस के लिए। नेचुरल गैस लगा रखा है सर सेलिंग का ट्रेड ऊपर से, अगर एफ ब्रेक हो गया तो फिर और गिरेगा, एफ होल्ड करता है तो वापस रिटर्न, और इस बार अगर यहाँ से सपोर्ट लिया तो फिर ये, हाँ अगर ये कैंडल अपना हाई ब्रेक कर दे तो भी एंट्री बन जाएगी, बाकी डायरेक्टली ओपन इक्वल टू हाई में मत लेना। बाकी देख लेते हैं अगर ये लेवल भी होल्ड नहीं करता है तो इसके नीचे और कहाँ तक जा सकता है प्राइस। वैसे ये होल्ड कर तो जाना चाहिए अगर न्यूज़ इतनी इंपॉर्टेंट नहीं है, लाइक क्योंकि यहाँ से गिरा तो फिर सीधा नीचे 6030 तक ही आएगा अगर ये सपोर्ट होल्ड नहीं होता है तो। दैट इज अनदर सपोर्ट। बाकी ऊपर का भी कोई बहुत बड़ा टारगेट नहीं है अगर मार्केट यहाँ से रिवर्स देता है क्रूड में। ऊपर 6130 140 तक का एक टारगेट रखेंगे। बाकी नेचुरल गैस को देखते हैं ये एफईजी होल्ड करता है या ब्रेक करता है, ये काफ़ी इंपॉर्टेंट लेवल है एफईजी का, ब्रेक कर दे तो बढ़िया हो जाएगा। लाइक भी करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम एंड सब्सक्राइब द चैनल। जिन लोगों ने सब्सक्राइब नहीं किया अभी तो चैनल को सब्सक्राइब भी कर देना, बहुत सारे लोग सब्सक्राइब ही नहीं करते हैं चैनल को। कल मार्केट ओपन है, कल बंद नहीं है, टुमारो मार्केट इज ओपन, नो क्लोजिंग। डायरेक्टली बाय मत करना क्रूड में, फिर रिपीट कर रहा हूँ कैंडल ओपन इक्वल टू हाई है। ओपन इक्वल टू हाई पे नहीं करते ना बाय, ओपन इक्वल टू हाई पे बाय नहीं कर सकते डायरेक्टली, और ओपन इक्वल टू लो पे सेल नहीं करते डायरेक्टली। ओके ग्रेट, आ जाओ नीचे। नेक्स्ट सपोर्ट अब यहाँ पर मिलेगा 6030 6040, यहाँ पर देखते हैं नॉर्मल कैंडल बनी तो बाइंग हो यहीं से होगी अब। ये लेवल भी वैसे टेस्ट तो हो चुका है। न्यूज़ काफ़ी इंपॉर्टेंट है, कह सकते हो न्यूज़, या फिर इंपॉर्टेंट कहना गलत होगा, काफ़ी ज़्यादा बेरिश न्यूज़ है। ओपन इक्वल टू हाई बना के नीचे आ गया। यहाँ पर देखो एक नेक्स्ट सपोर्ट है, इसको रिमूव कर देना। यहाँ से देखते हैं बाइंग, ये भी एक सपोर्ट है और लास्ट ही सपोर्ट है, इसके नीचे काफ़ी दूर है फिर नेक्स्ट सपोर्ट। आई होप फिर से ओपन इक्वल टू हाई ना बने, यहीं से रिवर्स आए। अब मार्केट इज क्लोज, एमसीएक्स ओपन इन इवनिंग। हाँ वही एमसीएक्स की बात करो, एमसीएक्स तो ओपन ही है ना, एमसीएक्स मार्केट ओपन ही है, कल बंद नहीं है। कल महाशिवरात्रि, उसकी वजह से इंडियन मार्केट तो मॉर्निंग पे बंद ही रहेगा, बट एमसीएक्स कमोडिटी मार्केट ओपन रहेगा। फॉरेक्स मार्केट चलता रहेगा, बाकी नॉर्मल ही है मार्केट में, कुछ चेंज नहीं है। होता रहता है, फॉरेक्स में कुछ नहीं है। कितने बजे ओपन होगा? 5 PM। तो यहाँ पर भी ये नेचुरल गैस में एफईजी है, ठीक है, ये अगर ब्रेक नहीं किया तो रिटर्न कर जाएगा यहीं से, और फिर इसको ऊपर जाना चाहिए। अगर यहीं से रिटर्न हुआ, ब्रेक कर देता है तो इजीली आ जाएगा नीचे यहाँ तक। नेक्स्ट सपोर्ट यही है हमारे पास। बाकी क्रूड में भी देखते हैं, यहाँ से एक बाइंग एक्सपेक्ट रहेगी। अगर इसमें बाइंग यहाँ से आती है तो टारगेट अप्रोक्सीमेटली यहाँ तक का रखा जाएगा। बीच में और कोई तो नहीं है ना रेजिस्टेंस। थर्टी सिक्स लाइक हो गए, लाइक करते रहो गाइस। 46 पीपल आर वॉचिंग, जिन लोगों ने लाइक नहीं किया अभी तक। देख लेते हैं कल कौन सा डेटा है। आज होम सेल्स और क्रूड ऑयल की इन्वेंट्री, न्यू होम सेल्स और क्रूड ऑयल की इन्वेंट्री। सिल्वर में फ्रेश ब्रेकडाउन हो रहा है, देख लेते हैं एक सेकेंड। अभी हुआ नहीं है, अभी भी सपोर्ट पर ही है। 31.57 के नीचे अगर ब्रेकडाउन हो जाता है तब ब्रेकडाउन कंसिडर किया जाएगा। कैंडल क्लोज होती है 15 मिनट की, अभी सपोर्ट पर ही है। इट इज स्टिल ऑन सपोर्ट। ठीक है, नीचे सपोर्ट है अभी भी उसके पास। 31.44 के अराउंड सपोर्ट बना हुआ है 15 मिनट में, ब्रेक डाउन करना जरूरी है, अभी किया नहीं है। मैं फॉरेक्स की बात कर रहा हूँ। Natural gas trying to take the support. 47 के नीचे क्लोजिंग आती तो 339 तक गिर सकता है और नीचे वाले सपोर्ट पे। नेचुरल गैस में यहाँ से सॉरी क्रूड ऑयल में एक बाइंग का प्लान रखेंगे। ऊपर टारगेट थोड़ा बड़ा है बट बीच में अभी जो सपोर्ट ब्रेक हुए हैं दोज आर द फर्स्ट रेजिस्टेंस, क्योंकि वो रीटेस्ट की तरह भी काम कर सकते हैं। तो यहाँ से अगर पुल बैक आया तो ऊपर 6078 एंड देन 6140। ठीक है, जो बीच में सपोर्ट था ये थोड़ा सा रोकेगा यहाँ पर रीटेस्ट की तरह। बाकी फाइनल टारगेट फिर हमारे पास 6135 36 इस एरिया के आसपास का रहेगा। इज अ फर्स्ट टारगेट एंड सेकंड थर्ड, ऐसा कुछ समझ लो। फोर्टी वन लाइक्स आर डन, करते रहो सभी लोग लाइक। 42 लाइक्स, वाओ, एक लाइक और बढ़ गया, थैंक यू सो मच। न्यूज़ हो गई सर, न्यूज़ का इतना ही इम्पैक्ट है। ठीक है, टारगेट पहला ऊपर का, ये आपका रीटेस्ट जोन हो गया पहला बीच में, और ये ऊपर फाइनल टारगेट अगर रीटेस्ट के ऊपर सस्टेन कर गया, इन केस बहुत ज़्यादा बेरिश न्यूज हुई तो नहीं कर पाएगा। मैं वही ढूंढ रहा हूँ, इसके नीचे सपोर्ट कहाँ पर है। अब पारिक जी, आपने 2 अकाउंट से लाइक किया, थैंक यू सो मच। सब 2 अकाउंट से अगर लाइक कर दें तो अभी 100 लाइक्स हो जाएं। कल मॉर्निंग मार्केट क्लोज है, एमसीएक्स का ध्यान रखना, तो क्वांटिटी उसी वाइज, बाकी आज फ्यूचर की एक्सपायरी भी है नेचुरल गैस में। कैरी फॉरवर्ड करते हैं, ध्यान रखना कौन सा करना है कैरी फॉरवर्ड, अगर कर रहे हो तो। यदि क्रूड ऑयल में इतना गिरा क्यों? स्टेटमेंट था एक्चुअली यूएस की ओर से. बिटकॉइन 5000 पॉइंट डाउन. 90,000 के नीचे तो वैसे ही मूव कर रहा है वो. एक बार देखें कहाँ रुकेगा या रुकेगा भी नहीं रुकेगा. वैसे इसमें मैंने देखा था वीकली टाइम फ्रेम पे एक सपोर्ट है नीचे. बिटकॉइन में डेली में भी था शायद. आई थिंक डेली में देख लो. %20 करेक्शन हो चुका है डे ऑल टाइम हाई के अराउंड. क्रूड में याद रखना टारगेट बीच वाला जो लेवल ड्रॉ किया है ये भी रहेगा पहला. ठीक है, बिकॉज सीधा ऊपर नहीं जाने वाला वो. बीच में वो एक छोटा सा सपोर्ट था जो ओपन इक्वल टू हाई में डायरेक्टली नीचे ब्रेक हुआ है. दैट एक्ट लाइक एज अ सपोर्ट. सपोर्ट ब्रेक हो गया है मतलब रेजिस्टेंस की तरह काम करेगा. देखो हायर टाइम फ्रेम पे सपोर्ट है. 15 मिनट पे उतना पीछे दिख ही नहीं रहा, वो काफ़ी नीचे आ गया है. हायर टाइम फ्रेम में देखोगे 4 आवर टाइम फ्रेम पे तो सपोर्ट पर ही है. बाकी वीकली टाइम फ्रेम का भी सपोर्ट है, बस थोड़ा सा और नीचे है. वहाँ तक आ जाए तो और बढ़िया, बट मुझे लगता नहीं इतनी इजीली आएगा. ये मिलेगा आपको नीचे 75,600 से लेकर 75,100 के आसपास. बट वो वीकली का है. अभी इतने इजीली और इतना गिर जाए 20% ऑल टाइम हाई से ब्रेक है. वहाँ तक आते आते 10% और गिर जाएगा. टोटल मिला के 33% डाउन होना चाहिए वीकली के लिए. तो फिलहाल के लिए ये एक सपोर्ट दिख रहा है. रहो गाइस, जिन लोगों ने लाइक नहीं किया. न्यूज़ थी क्रूड ऑयल में थोड़ी देर पहले, उस वजह से थोड़ा फॉल किया था. बीच में 2 सपोर्ट थे, दोनों के दोनों ब्रेक कर दिए कि फाइनल सपोर्ट ही है. 15 मिनट टाइम फ्रेम पे ओपन इक्वल टू हाई कैंडल नहीं है तो सपोर्ट माना जाएगा.
Coming up, Apple preparing for shareholder meeting showdown over its DEI policies. We'll have the details for you next.
Oh yeah, you're not gonna forget to cancel those free trials this time. right? Uh-oh. Free child alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free child alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free child alerts to the rescue, so you cancel on time from Yahoo Mail.
We are 2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. Stocks struggling to snap a losing streak here. The S&P 500 on track for its 4th straight day of declines. Home Depot narrowly beating expectations in the 4th quarter, boosted by positive same-store sales growth for the first time since 2022. Still, the home improvement retailer issuing cautious guidance for the full year. Hims & Hers plunging after the company confirmed it will stop selling compounded versions of weight loss drugs. This after the FDA declared weight loss drugs are no longer in shortage, removing a loophole that allowed the company to sell the products. And crypto stocks falling as Bitcoin hits its lowest level in 3 months, now below $90,000. That's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. Wealth is next.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we've got a little bit of a portfolio checkup for you. We discuss the dangers of trying to time the market and break down how investors can navigate short-term volatility. And state of the housing market. One expert tells us how improving inventory and easing price pressures should help potential buyers this spring. Plus, getting retirement ready. All week, we're taking a look at how to best invest for retirement at every age, from workers in their 20s maxing out their 401k match to those over 70 living off of those investments and sipping mojitos. Today, we focus on your 40s and 50s, your final push to save. All that and much more during today's show. But first, let's start, as we always do, taking a look at some of the market action. We are 90 minutes into the trading day. We're seeing declines across the board, fractionally for the Dow and the S&P 500, but the NASDAQ slippage is intensifying, down 1.7% right now. Let's make sense of this for you. Stocks struggling to snap a losing streak as investors navigate macro uncertainty. Joining me now on set, we've got Kevin Mon, who is the Hanian & Walsh CIO. Great to have you here in studio with us.
Great to be here, Brad.
An important day for you to be here in person as we're kind of tracking the slippage here. You're actually warning about the potential dangers of trying to time the market.
Yes.
Explain how you're viewing the recent volatility and what investors need to know.
Sure. To start, prior to yesterday, the VIX, which is a measure of volatility in the market, rose by 35%. And that caught some investors off guard. And you know why? Because last year there was little to no downside volatility, as there was less than 4% of the time the market closed 1.5% or more lower on a given trading day. That's a historically low level of volatility. But that type of volatility shouldn't cause investors to flee the markets or try and time the market. You know, Warren Buffett once said, and I agree, that the Hall of Fame of market timers is an empty room. Trying to time the market is an exercise in futility, because you got to get it right twice, Brad.
Right.
When to get out and when to get back in. It's when to get back in that is often more difficult and allows investors to fall short of their longer-term financial goals.
Right, and so that's where we hear this old adage, it's not timing the market, it's time in the market here. You know, how can you really make sure that you're allocating your assets for any market volatility that you have to weather?
Sure. I think you need to stay true to your risk tolerance. In other words, your risk tolerance shouldn't go up just because the market is moving higher, just as much as it shouldn't go down just because the market is moving lower. Build your asset allocation strategy consistent with your personal risk tolerance, your investment time frame, and ultimately what your growth and income goals are. There was a study done by a University of Michigan professor, and I recognize this study is somewhat dated, but he looked at 31 consecutive years of stock market returns. And what he found, Brad, was that 95% of the stock market returns come on just 1% of the trading days. Now, I don't have a crystal ball. I don't know when those 1% of the trading days are going to be, but rest assured, if you're not in the market on those 1% of the trading days, you're likely to miss out on the most significant returns the market has to offer, and they generally come after big down days.
With all of this in mind, for some of the slippage that we have been tracking here, a lot of investors trying to figure out where they should be reallocating.
Yes.
And you have, I think, trending on social here earlier this morning, I had seen even buy the dip.
Yes.
So if you're talking to investors right now who are trying to figure out what dips feel safe, or which dips actually might have a little bit more of a dippity dip coming later on here? It's a technical term.
Yes, absolutely.
Yes.
So I would look into those themes that are going to continue to resonate in the new year, or perhaps even over the next decade. I know the AI revolution is being called into question tomorrow. I think we'll find tomorrow afternoon, after NVIDIA reports, that the AI revolution is indeed alive and well, and CapEx spending will continue there. But don't just look at those semiconductors and chips, please. Recognize the other opportunities that exist around there. How about power solutions, utility companies, SMRs, nuclear capabilities, or even the data centers, the cooling solutions for the data centers? I could go on and on. There are growth opportunities ahead. However, we're starting to see changes in market leadership now. We're seeing value outperform growth, international outperform U.S. Maybe now's the time to take some chips off the table and move into other areas of the market that may provide the leadership going forward.
As we're thinking about some of those attractive areas of the market, what are you playing? What are you fading right now?
So where I really like right now, I still like the utility sectors, particularly multi-utilities that pay good dividends, have strong balance sheets, and supply electricity, natural gas, and even nuclear power capabilities. I think people are shorting defense right now. I don't think defense spending is going to decrease as much as many anticipate. If you look at companies such as L3 Harris or even Lockheed Martin, I anticipate more spending in those areas ahead. And then you go away from that. How about small cap biotech? If you're looking to be a little bit more aggressive and looking for growth opportunities, I bet you there's a pickup in M&A activity, and the small cap biotech companies will benefit from that.
Kevin, thanks so much for joining us here.
My
Critical
pleasure.
day to get some analysis here and get some insight. We appreciate it, Kevin.
Thank you.
Now time for some of today's trending tickers that we're tracking during the session. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got my morning brief co-anchor, Shauna Smith. She's been hanging around here. This is hour number 3 for you.
You guys can't get rid of me off set tonight.
We cannot, and we don't want to here. Why? Because we got to talk about Chegg. Of course, everybody's going to remember this one, especially if you went to college and purchased some books from there. All those things considered, shares of Chegg plunging after the company sued Alphabet, claiming the Google parent's AI overview feature has blocked traffic to its website. The company says it is now exploring strategic alternatives, and in its lawsuit, Chegg accused Google of unfair competition, calling it, quote, a once robust but now hollowed out information ecosystem of little use and unworthy of trust. My goodness, fighting words. Chegg, which offers homework help for students, has seen its value fall over 90% since ChatGPT launched in 2022 here. You got some real sparring words that are coming through in some of the legal filings here, Shauna.
You do. They need to do something because clearly they're having a tough time turning this around. You're taking a look at that 5-year chart. It clearly lays out just the pressure that AI and AI adoption, the Main Street adoption, has certainly put on its business. Chegg is very much trying to figure out what their place looks like here going forward, what exactly that business looks like going forward. Right now, we're right around the lows of the session with the shares off just about 31%. And I think the large takeaway here from so many of the analyst notes that I've been combing through here this morning is there's a lot of confusion and uncertainty just in terms of what that timeline looks like for Chegg in order to regain some of that lost momentum. JP Morgan coming out saying that the company continues to face secular and competitive headwinds driving to that lighter than expected Q1 outlook. Jefferies, Brent Thill over there, who comes on the show many times, saying that Chegg's business remains under major duress from AI. Piper Sandler also weighing in, pretty much affirming some of that sentiment, saying that subscribers are continuing to decline, a lot of that being pressured by AI adoption. So very much a clear takeaway from the street is there's a lot of concern, a lot of worry just about the continued pressure that AI adoption is going to put on Chegg's business. And there's a lot of questions as to whether or not the ability here to turn things around.
Yeah, down 30% on the day, now sitting just above $1 per share here. We'll continue to track that one. We're also keeping close tabs on Block this morning. Block getting a post-earnings upgrade to equal weight from underweight at Morgan Stanley. The analyst says that valuation is reflective of risks that they've outlined, including skepticism of Square seller growth acceleration. And Cash App valuation now matches the firm's expectation. Shares right now down by about 3.7% here. So a little bit of the evaluation that they have continued to run the calculus around here and kind of saying, yeah, this is exactly what we expected.
It very much is. When you take a look at, if we could pull up a 5-day chart, I don't know if we have that ready here, but a 5-day chart shows the decline that we have seen seen in block shares since we did see that release. You're looking at the stock still off just about 25%. So very much this is a valuation call. Morgan Stanley, the latest name to come in, saying that it's now the risk, the sentiment and positioning, I think, is a little bit more balanced. This also follows a call that we got from BMO earlier this week. They also upgraded the stock. They actually did to outperform from market performance, so a bit different than what we're hearing from Morgan Stanley this morning, who upgraded it to equal weight from underweight. But again, very much saying that they think the current valuation incorporates some of that increased skepticism. Block's ability to accelerate Square seller growth here is critical here to this upgrade. Their new price target of $65 a share, just about $1.50 higher than where we're trading today.
All right, Shauna, we finally release you from the set here today.
Thank you.
This morning,
For now.
right now.
I'll be back at noon.
Thanks so much for sticking around. Appreciate it. Also tracking consumer confidence, posting its biggest monthly decline in nearly 4 years, falling to 98.3. That is below the expectations for 102.5. The Conference Board says inflation expectations surged as investors digested an increase in prices for staples like eggs and the expected impact of tariffs. So we want to dig into some of this uncertainty and talk about how investors should be positioning themselves in the current environment. Joining me now in studio, finally live in living color, we've got Anthony Siccaro, president of Providence Financial Insurance and Services. Anthony, great to have you here with us this morning.
Thank you for having me. Great to be here.
Absolutely. So let's talk about this. You are calling for a measured approach for investors here. Walk us through that.
Sure. Well, the consumer confidence obviously has been down, and there's really nothing that's going to tell us that it's going to increase from here. It's all about inflation. It's all about tariffs. And as much as we would like President Trump to come out and say, look, guys, I'm just using tariffs as a political ploy. I'm really not going to impose them on anybody. We know that that's not going to happen. And we don't really know what's fact and what's fiction at this point. So the fact is that he is wielding them, but we don't know where that leads. If it's 10% or so, if they're real tariffs and 10%, companies can absorb that.
Sure.
And so I don't think that'd be a big deal. But if it gets higher than that, if it gets into some of the 25% range that he's talking about, now all of a sudden consumers are going to have a problem. But this is weighing on consumers' minds. So the sentiment is down because they believe that if he does wield them as a sword and if they do stick, then inflation's going to grow, and no one wants that. That's why consumer sentiment is down.
So what's the pass-through here for different generations of investors, say younger investors? Let's begin there. You say you should continue with the dollar cost averaging strategy. What does that look like in effect?
So dollar cost averaging is just buying the same thing over and over again. For those of you that have your 401ks that you're just having money taken out of your check, what you're doing is you're dollar cost averaging, and what it does, Brad, is it drives the average purchase price down, which is exactly what you want. You want to drive the average purchase price lower. The fact is that if you're doing that and you're in that younger generation, keep doing it. Volatility actually helps you, because if you're buying consistently and the price comes down, then what's going to happen is you get to buy more shares for the same dollar. It's not bad. If you're closer to retirement, though, or you're in retirement, now all of a sudden you have to worry about a major pullback at the wrong time. If you're going to retire in 2 or 3 years and that market crashes maybe 20, 30 or more % from that, now it could cost you your retirement. So if you're younger, keep dollar cost averaging. If you're a little older, might not be a bad time to reposition into something more conservative. And my preference is to focus on things that pay interest and dividends, because those are the eggs that you can count on.
Certainly. And so as we're thinking about that, let's delve a little bit further into those who are closer to retirement age. Where are the assets that you are seeing more people who are retirement ready and their savings feel like they're in a good spot to finally say, okay, maybe this year, maybe next year, 2 years from now, that we are retirement ready, but we still need a portfolio to kind of balance some of the opportunity that are still out there in the market?
Sure. Well, what you need to know is that almost any investment out there can be focused on either growth or income. Think about stocks. Yep. You have growth stocks out there that are, high multiples and with the idea that the company is going to grow into the price, but there's no income.
Yeah.
Or you can buy dividend producing stocks that are going to pay you income, and the income is like the bird in the hand. You can count on that income. And so stocks is one example. Same thing with bonds. You can buy zero coupon bonds that don't pay you any interest at all until you cash them in later. Or you can buy bonds that pay income. So the reality is there's a whole universe of investments out there that are dividend and interest focused. Stocks, bonds, preferred stocks, business development companies, REITs, flavors of annuities that are all income oriented, and the income is the bird in the hand. You know you can count on it. If the market stays choppy for the next decade or so, and that's happened many times where there's been a decade or even two where there's no growth at all in the market, choppiness, but at the end of the day, no growth for 2 decades. A lot of people don't know that. If you're focused on dividend investments, then the fact is you're getting paid to wait. And it's those dividends and interest that will come in and save the day.
What's the calculus that those who are closer to retirement should be running around corporate bonds versus treasury bonds, for instance?
So there's a spread, and it really depends on what that spread is as far as whether you should be doing corporates or treasuries. Usually it makes sense to invest in high investment grade corporates over treasuries. Right now the spread's probably 75 basis points and, very good. But as far as the calculus for you, for income, it really depends on how much income you need out of your portfolio. If you're retired and you're living off the income in your portfolio, you want to have a much higher degree so that you can live off that income, the interest and dividends. Whereas if you're retired and you don't need the income from your portfolio, then you can take that, put it back into more frothier, growthier stuff if you want, and you have time to ride it out. But if you need the income, the more income you need, the more you want to have in income producing investments.
Anthony, great to have you in studio with us today.
Thank you, Brad.
Appreciate it. Coming up, everyone, the state of the housing market. We discuss the latest trends in home prices and talk about the spring buying season. Stay tuned.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
ओके गाइस, ये नेचुरल गैस एफईजी पर ही रुक गया. देयर आर वेरी हाई चांसेस अब ये ऊपर 356 एंड देन 363 के आसपास जाने की कोशिश करेगा यहाँ. एफईजी ब्रेक करके सस्टेन करता तो और नीचे जाता, बट एफईजी होल्ड इट. फाइव लाइक्स और रह गए गाइस, लाइक करते रहो सभी लोग. अखिलेश सिंह जी, धन में लैपटॉप में, हाँ वो कुछ दिनों से नहीं चल रहा है लैपटॉप में. बिल्कुल लैपटॉप में क्या, मोबाइल में भी नहीं चल रहा है. अगर आप डेस्कटॉप ओपन करते हो मोबाइल में ही, सिर्फ एप्लीकेशन ही चल रहा है. शायद थोड़ा ग्लिच है उसमें. एप्लीकेशन यूज कर सकते हो, ज़्यादा बेटर रहेगा मेरे अकॉर्डिंग अभी।
Planet Money helps you understand the economy. We find the people at the center of the story.
Garbage in New York, that was like a controlled substance.
We show you how money influences everything.
Tell me what you like by telling me how you spend your money.
And we dig until we get answers.
I had a bad feeling you were going to bring that up.
Planet Money finds out. All you have to do is listen. The Planet Money Podcast from NPR.
News when you want it with Bloomberg News Now. I'm Nathan Hager. We'll start with the latest news on how people are feeling about the economy. It's not great. Bloomberg's Michael McKee has the latest consumer confidence index from the Conference Board.
We had a negative reaction to Friday's Michigan numbers. The Conference Board number comes in even worse. 98.3 from 104.1, a significant drop there. You can see how both of those have turned around lately, and that's starting to worry people about what we might see in the future.
Bloomberg's Mike McKee reports it's the biggest drop in the Conference Board's number since August 2021, and it's having an effect on stocks. Right now, the S&P 500 is down 0.9%. The Dow Jones Industrial Average is lower by 0.1%, and the Nasdaq Composite is sinking, down 1.8%. The Bloomberg Magnificent 7 Index of the biggest tech names is now in correction territory, down 10% from its December high. Tesla is the biggest laggard on the index, down 7% right now, followed by Microsoft and Alphabet. The one stock bucking the trend is Meta Platforms. It's gained in 20 straight sessions, but right now Meta shares are lower by nearly 3%. Mexican President Claudia Sheinbaum says she plans to close a tariff deal with President Trump by next Tuesday. Speaking at her daily news conference, Sheinbaum said she hasn't scheduled a call with the president, but says Mexico has a plan A, plan B, and plan C if tariffs are put into place. President Trump said yesterday that tariffs on Mexico and Canada are on time, but Bloomberg's Tyler Kendall reports he may have been talking about reciprocal tariffs on all countries, not the 25% tariff that's delayed till next week.
Those negotiations on Canada and Mexico, important for us to remember that those are tied directly to some tangible policy priorities for this White House when it comes to immigration and fentanyl. The latter, something that President Trump has tied directly to China. And I mention that because just this week, Bloomberg News reporting that U.S. officials have asked Mexican officials to hike their tariffs when it comes to China in this bid as these negotiations continue.
Bloomberg's Tyler Kendall reporting from Washington. Uncertainty around President Trump's government cost-cutting drive may be continuing. Elon Musk says federal workers will get a second chance to respond to his email on what they did last week or face firings if they ignore it. That might not clear things up, though, as we hear from Bloomberg's Bill Ferries.
You still have some government agencies pushing back on Elon Musk and the email that came from the Office of Personnel Management saying they have to list out what they accomplished last week. Elon Musk again saying that federal employees need to do this. They'll get a second chance or they will be terminated. You have other departments, Defense, State, Homeland Security, pushing back and telling their staff not to respond. That's not settled, and I think that's confusion that's going to continue for several days.
Bloomberg's Bill Ferries. Meantime, Treasury Secretary Scott Bessent is dismissing concerns over the cost-cutting efforts at an Australian embassy event in Washington. Bessent says the Department of Government Efficiency does not stand for Department of Government Elimination. President Trump's push for, quote, one big beautiful bill to pass his agenda faces a big test in the House today. Speaker Mike Johnson has set a floor vote this evening on a budget resolution that would extend tax cuts and boost spending on immigration, enforcement, and defense, though he could face a revolt from Republicans in swing states who are worried about benefit cuts, as well as fiscal conservatives who say the cuts don't go far enough. UK Prime Minister Keir Starmer says he's boosting defense spending to 2.5% of GDP by 2027, and he says he won't stop there.
Subject to economic and fiscal conditions and aligned with our strategic and operational needs, we will also set a clear ambition for defence spending to rise to 3% of GDP in the next Parliament.
Prime Minister Keir Starmer says the government would pay for that hike by cutting overseas development spending. Overregulation and not politics is the main reason why people get shut out of the banking system. That's what Bank of America CEO Brian Moynihan is saying.
We bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right. And I think it opens a dialogue about how to get these regulations correct.
Bank of America CEO Brian Moynihan spoke with Bloomberg host and Carlyle Group co-founder David Rubenstein at the Economic Club of Washington. Last month, President Trump accused Moynihan and other big bankers of limiting business with conservative clients during a speech at the World Economic Forum in Davos. And that's news when you want it with Bloomberg News Now. I'm Nathan Hager, and this is Bloomberg.
There are two kinds of people in the world. People who think about climate change and people who are doing.
How much of this can you tie back to some of what we were discussing in return to office mandates or just migration that now once again has to unwind because we can't be as hybrid as we were before, I guess?
Yeah, it's a combination of all of those things. And when you look at the Sun Belt, you start to look at new construction activity down there as well. There's a stat that, 3/4 of new home construction coming to market last year actually came in the Sun Belt. And so that helps for some of those existing homeowners that are still locked into their homes by low rates. You're seeing some of that new construction inventory help with the supply constraints down there. You're also seeing a number of other factors, rising property insurance in those particular areas, the migration inflow that's slowed down into those particular areas. Back to office in New York, right? So there's a number of different factors that are contributing to this, but really it's that inventory component. It's not so much affordability that's driving price right now or the lack thereof. It's inventory. And when inventory returns, you're seeing those prices soften up. In areas where you're not seeing that inventory return, the Northeast most notably, you're seeing still firm home prices.
With that in mind, as you're thinking through some of the policy implications that could have an impact on housing, whether that's the workforce and immigration policy impacting the number of available workers to build out homes, and then additionally on the materials itself, if we do see tariffs go into effect, how could that also have larger impact on the cost of new home build-outs?
Yeah, you're absolutely right. That new home construction is where that would come, both in terms of the lack of labor from that lack of immigration out there in the market, along with tariffs. If they're put specifically on lumber or construction materials, that can have an upward pressure on homes that would be coming to market over the next couple of years out there in the market. So something certainly housing market folks have a close eye on. What do we truly see in terms of these tariffs? You were having that conversation earlier in the show. What do we see in terms of immigration and the costs of this construction, and how does that play into the market as well?
As we're taking a look at some of the home builders here, home builders rallying on the day, at least during this activity. Andy, we're going to continue to track this very closely here. We appreciate you taking the time.
You bet. Thank you for having me.
Coming up, everyone, congressional Republicans are taking aim at 2 new rules from the CFPB. Find out what these rollbacks could mean for you and your finances next.
Oh yeah, you're not gonna
नहीं है क्रूड ऑयल इस लेवल को भी होल्ड कर पाएगा। कुछ ज़्यादा ही बेरिश न्यूज़ है। ऑयल ब्रेक 6000 तो देखना पड़ेगा 6000 ब्रेक कर सकता है नहीं कर सकता। फिलहाल तो न्यूज़ का मोमेंटम कंटिन्यू है, एक भी सपोर्ट होल्ड नहीं हो रहा है। ऊपर से दो तीन तीन सपोर्ट ब्रेक कर दिए, यहाँ पर भी था वो ब्रेक कर दिया, ये भी ब्रेक कर दिया और ये भी ब्रेक ही होने वाला है। चलो यहाँ पर तो ओपन इक्वल टू हाई बना के ब्रेक किया था, यहाँ पर भी ओपन इक्वल टू हाई बना के ब्रेक किया था। लेट्स सी यहाँ पर क्या ओपन इक्वल टू हाई बनाता है या फिर नहीं। फिलहाल के लिए अभी तक ओपन इक्वल टू हाई है नहीं।
in the final weeks of the Biden administration and potentially blocking them from ever taking effect. Here to break down the rollbacks, we've got Yahoo Finance's Jordan Weissman. Jordan, let's start with the cap.
Okay, look at this candle. This is the open equal to high now. This candle is open equal to high in crude 15 minute. Look at the open is equal to the same high in 15-minute time frame. 6013 and 6013. Let's see कंटिन्यू करता है या फिर अपना हाई ब्रेक कर देता है। अगर इसने अपना अपना हाई ब्रेक कर दिया इट मींस बाहर आ चुके हैं वापस। इफ दिस कैंडल ब्रेक द हाई ऑफ इटसेल्फ, खुद का अगर हाई ब्रेक कर देता है, ओपन इक्वल टू हाई को डिस्ट्रॉय कर देता है। के ब्रेक कर दिया है शायद इसने अपना हाई, ओपन इक्वल टू हाई था, ब्रेक कर दिया है 15 मिनट में। लेट्स सी, मुझे लग रहा है अब बाइंग आनी चाहिए। ओपन इक्वल टू हाई बनाया था, सेलिंग का प्रेशर क्रिएट किया था, बट बायर डिस्ट्रॉय देयर ओन ओपन इक्वल टू हाई, मतलब कहीं ना कहीं ट्रैप करने के लिए बनाई थी कैंडल। एम भी हो गया, देखते हैं अब कितना वॉल्यूम क्रिएट होता है। ये देखो अपना खुद का हाई ब्रेक किया है, ओपन इक्वल टू हाई, तो ये एरिया कहीं ना कहीं बायर्स की रेंज में आ चुका है टिल 5990 तक, सपोर्ट ही मानना। आगे देखो यहाँ से अगर सपोर्ट मिलता है ऊपर, तो फिर ऊपर आपका जो टारगेट रहेगा वो बीच का जो एक सपोर्ट था जो ब्रेक डाउन हो गया था, रीटेस्ट पेंडिंग है उसका 6100 के अराउंड, वही है 15 मिनट टाइम फ्रेम। थोड़ा सा प्राइस आप कह सकते हो बेरिश टेरिटरी में चला गया है। लास्ट सपोर्ट कह सकते हो इसको, दिस इज लास्ट सपोर्ट, इससे बड़ा सपोर्ट अब एक्सपेक्ट नहीं होगा जब तक प्राइस अब वापस 6150 के ऊपर ट्रेड नहीं करता, इट इज़ बेरिश। सपोर्ट से बाइंग जरूर आएगी बट ऊपर रेजिस्टेंस स्ट्रांग हो जाएंगे, फिर ऊपर देखते हैं 6100 6130 के बीच में वापस सेलिंग के लिए। नहीं पता, ऐसा लग रहा था बुलिश हो जाएगा कम्प्लीटली अगर ये 6220 के ऊपर सस्टेन करता, तो काफ़ी देर रुकने के बाद ब्रेकडाउन ही हो गया। तो 6000 के नीचे यहाँ तक ये लास्ट सपोर्ट मानना क्रूड में, 5990 इसके नीचे गया तब सुपर बेरिस, वैसे तो बेरिस हो गया बट सुपर बेरिस 6000 जब तक वापस सस्टेन नहीं करता 6160 के ऊपर।
you're not going to forget to cancel those free
अगर ये होल्ड नहीं करता है सपोर्ट तो फिर 5930 920 फिर तो नीचे के रास्ते सारे ओपन है अगर ये सपोर्ट होल्ड नहीं हुआ 5930 920 तक ही आ जाएगा बट मेरे अकॉर्डिंग अगर एक बार ऊपर चला जाए अगर इसको बेरिश ही होना है तो थोड़ा सा इस साइड जाके यहाँ से सेलिंग इस तरह से दे तो बढ़िया है कंफर्म हो जाएगा कि लोअर ट्रेंड कंटिन्यूसली लोअर लो फॉर्मेशन पे ऊपर जो एम पैटर्न बना है उसका ब्रेकडाउन तो हो ही गया था एक लोअर लो बचा है यहाँ पर फाइनली बनना 3 लाइक और रह गए गाइस लाइक कर दो सभी लोग कल इंडियन मार्केट बंद है एमसीएक्स मॉर्निंग क्लोज है इवनिंग ओपन है सो ओवरनाइट मत रखना बाकी आज क्लोजिंग भी है एक्सपायरी से हम कह सकते हैं नेचुरल गैस फ्यूचर फरवरी मंथ की any level in silver? हाँ सिल्वर में अभी बताया था ना, किसी ने पूछा था वो थोड़ी देर पहले, किसी ने पूछा था सिल्वर में। फॉरेक्स का देख रहा हूँ, ठीक है, एमसीएक्स नहीं देख रहा हूँ, फॉरेक्स का देख लेता हूँ। एक सेकेंड। थोड़ा सा इसमें डाउन ट्रेंड जैसा स्टार्ट हो रखा है, 15 मिनट में ऊपर से प्रॉफिट बुकिंग जैसी चल रही है। पोर्ट था 31 पॉइंट, करंट लेवल है ना 15 मिनट टाइम फ्रेम पे 31 पॉइंट, 31 पॉइंट कितना है ये, 31 पॉइंट, हाँ ये जो करंट लेवल है जहाँ पर भी प्राइस चल रहा है 15 मिनट में सपोर्ट है। ये थोड़ा सा बड़ा सपोर्ट है बट ये सपोर्ट है, $31 तक पूरा सपोर्ट है। $31 से लेकर 31.30, दिस होल एरिया इज सपोर्ट एरिया। यहाँ पे पहले भी सपोर्ट लिया है प्राइस ने, अगर देखोगे ना फॉरेक्स चार्ट में 11 को 6:30 के आसपास यहाँ से एक बार सपोर्ट ले चुका है, दूसरी बार आया है प्राइस। तो यहाँ पर ये स्ट्रॉन्ग रहना चाहिए जब तक $31 के ऊपर है, सपोर्ट ही है। ऊपर रेजिस्टेंस भी बता देता हूँ 15 मिनट टाइम फ्रेम पे, 15 मिनट टाइम फ्रेम पे रेजिस्टेंस रेजिस्टेंस कुछ मिल भी नहीं रहा यहाँ पर, रेजिस्टेंस कहीं तो होगा डेफिनेटली। रेजिस्टेंस ढूंढना पड़ेगा, सपोर्ट तो एक अभी करंट लेवल पे सपोर्ट पर ही है, रेजिस्टेंस मिल ही नहीं रहा इसमें कुछ प्रॉपर। ये तो करंट लेवल सपोर्ट का ही है, रेजिस्टेंस देखना पड़ेगा थोड़ा सा और डीपली, मिल नहीं रहा है फिलहाल फिलहाल 15 मिनट में। बना तो होगा जो डेफिनेटली यहाँ पर कहीं $32 के आसपास, जिस तरह का प्राइस एक्शन यहाँ पर बिल्डअप है। हाँ ये है, ठीक है। ऊपर 32.14 से आपका रेजिस्टेंस स्टार्ट हो जाएगा एंड यहाँ पर आज ही इसने रेजिस्टेंस लिया है। आई थिंक टाइमिंग देख लेता हूँ एक बार पहले मैं, बट ये यहाँ ऊपर काफ़ी स्ट्रॉन्ग है रेजिस्टेंस, ऐसा नहीं है कि वीक है, स्ट्रॉन्ग ही है। 32.15 से 32.30 तक। ये अभी 8 PM की कैंडल थी ना, डेटा भी आया था शायद उससे पहले, वहीं पर रेजिस्टेंस लिया है इसने, तो वो एक रेजिस्टेंस है। नीचे सपोर्ट, ऊपर रेजिस्टेंस। 15 मिनट टाइम फ्रेम की बात कर रहा हूँ प्रसाद जी, ठीक है। 2 लाइक और रह गए गाइस, लाइक करना ना भूलें एंड महाशिवरात्रि बनाएं कल, फिर इवनिंग पे मिलते हैं। लेट्स सी कोई न्यूज़ और आई है तो। मॉर्निंग क्लोज है कल, मॉर्निंग पे इंडियन मार्केट तो बंद है, एमसीएक्स भी क्लोज है, इवनिंग पे ओपन रहेगा। फॉरेक्स ओपन है, उसमें कोई प्रॉब्लम नहीं है अगर फॉरेक्स में ट्रेड करते हो। बाकी कल डेटा भी है, क्रूड ऑयल की इन्वेंट्री है, न्यू होम सेल्स का डेटा गोल्ड और सिल्वर के लिए। Gunjal ji, what is everything?
News when you want it with Bloomberg News Now. I'm Nathan Hager. President Trump's push for a, quote, one big, beautiful bill to pass his agenda is facing its first test today on Capitol Hill. House Speaker Mike Johnson has set a vote this evening on a budget resolution that would extend Trump's 2017 tax cuts and boost spending on immigration enforcement and the military. House Majority Leader Steve Scalise says the package delivers on a campaign promise.
Kamala Harris said she wants those tax cuts to expire, resulting in a multi-trillion-dollar tax increase on the American people. The voters decided very clearly with President Trump they don't want that tax increase to hit.
And Majority Leader Steve Scalise says Democrats will vote against this bill, but it could also face opposition from Republicans who are worried about benefit cuts and other GOP members who think the cuts don't go far enough. Senate Republicans are taking a two-step approach. Speaker Johnson sees that as a backup plan. Treasury Secretary Scott Bessent is trying to ease concerns about the Trump administration's government cost cuts. Speaking at an Australian embassy event, Bessent said DOGE does not stand for Department of Government elimination. He says the goal in reducing government's role is to reprivatize the economy. He says as President Trump's policies kick in, Treasury yields should naturally come down. Meantime, more than 20 civil service employees have reportedly resigned from Elon Musk's DOGE team. A joint resignation letter seen by the Associated Press says they are refusing to use their technical expertise to, quote, dismantle critical public services. Uncertainty around President Trump's policies may be driving a big drop in consumer confidence. The Conference Board's gauge for February dropped the most since August 2021. Stephanie Guichard is the Conference Board's senior economist.
Republicans are feeling much better than Democrats, but what we saw this month is a decline across the board. Strong decline for independent and Democrat consumers, and a slight decline also for Republicans.
Stephanie Guichard with the Conference Board, and those declines may be feeding into a drop in stocks. Right now, the S&P 500 is down 1.1%. The Dow Jones Industrial Average is lower by 0.2%, but the tech-heavy NASDAQ Composite is sinking by 2% right now, and the 10-year Treasury yield is down more than 10 basis points to 4.29%. Mexican President Claudia Sheinbaum says says she hopes to close a tariff deal with President Trump by next Tuesday. That's after the president said tariffs on Mexico and Canada are on track. But Bloomberg's Tyler Kendall reports it's not clear if he was talking about the 25% tariffs that are due to kick in on both countries next week.
Despite President Trump's comments, a U.S. official does tell Bloomberg News that that schedule is less than certain. And while President Trump was responding directly to a question about these pending Mexico and Canada tariffs that could take place in exactly 1 week from now, this U.S. official says that still a lot needs to be determined considering that negotiations are underway. And rather, President Trump's reciprocal tariff plan is still on track.
Bloomberg's Tyler Kendall says the report on those tariffs is expected by April 1st. The Trump administration is sketching out tougher versions of chip restrictions on China that were put in place during the Biden administration. We get more on that from Bloomberg's Bill Ferries in Singapore.
In the first month, we've mostly heard about the Trump administration's work to roll back legislation or regulations put in place during the Biden era. But this is one case where they seem to be taking what they inherited from the Biden administration and going further. Trump officials, administration officials have been meeting with Japanese and Dutch counterparts about restricting the ability of some of their companies who have sold semiconductor gear to China from taking, maintaining that gear that needs kind of regular maintenance.
Bloomberg's Bill Ferries reporting from Singapore. Bank of America CEO Brian Moynihan says it is overregulation that leads to people getting shut out of the banking system, not politics. Moynihan responded to criticism from President Trump in a conversation with Bloomberg host David Rubenstein at the Economic Club of Washington.
If we geared ourselves up for this president, not that president, we'd have to change 45 times or whatever it is. And if you think even in the foreign soil, think how many different prime ministers there's been in England, or so even in my tenure as CEO. So at the end of the day, you run the company the right way. And what we're trying to say is get us to rational regulatory structure.
Bank of America CEO Brian Moynihan. Last month, the president accused B of A and other Wall Street banks of limiting business with conservatives in a speech he gave to the World Economic Forum in Davos, Switzerland. And that's news when you want it with Bloomberg News Now. I'm Nathan Hager. This
Ever you get your podcasts.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
We are 2 hours into the trading day. It's time for Yahoo Finance's Market Minute. Stocks struggling so far today. The S&P 500 on track for its fourth down day in a row. The major average hitting its lowest level since mid-January. The Nasdaq is off just over 1%. The Dow, though, barely holding on to gains. Tesla leading the Mag 7 declines, its market cap falling below $1 trillion. New sales data out of Europe showing that sales there declined 45% in January. And Apple shareholders voting to keep the company's DEI programs, rejecting a proposal that would have scrapped those efforts. The company conducting the vote as part of its annual shareholder meeting. And crypto stocks falling as Bitcoin hits its lowest level in 3 months, now well below $90,000. Bitcoin is down roughly 7% in 2025 so far this year. You're looking at a huge decline today, as well as some of those crypto stocks. Well, that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Will the Social Security Fairness Act bankrupt the Social Security Administration Trust Fund? Well, that's one of the questions that we're going to answer today in this episode of Decoding Retirement. Hi, I'm your host, Bob Powell, and my guest today is Professor Olivia Mitchell. She's a professor at the Wharton School of the University of Pennsylvania. Professor Mitchell, welcome.
Thank you for having me. It's my pleasure.
It's my pleasure. For those of our listeners who are unfamiliar with you, you are, dare I say, the leading academic voice on the subject of retirement. So it's a pleasure to have you here. And it will be a pleasure to have you sort of at least tackle this first question about the Social Security Fairness Act, which will help many, I think, on the upwards of 4 million public employees receive their full Social Security benefit, but people are wondering what effect it will have on the trust fund.
Well, unfortunately, it's not going to be a good result when the Social Security Fairness Act is rolled out. I think there's been a little bit of a delay so far, but it's in progress. The reality is the U.S. Social Security system already is facing insolvency by 2023. After that, full benefits cannot be paid unless the system is reformed. And unfortunately, this act that was passed by the Biden administration is going to hasten the system's insolvency date by about half a year. Now, that's different than saying the system is insolvent. I'm sorry, let me correct that. That's different than saying the system is bankrupt. That is, it's still going to have enough revenue coming in to be able to pay about 75% of scheduled benefits. However, there will have to be benefit cuts around the realm of 25% for all current and future retirees, since there simply isn't enough revenue coming in to keep the benefits that have been scheduled.
Yeah.
So alternatively, payroll taxes will have to be increased by about 40% immediately and forever. And so the reality is that we're facing a big problem. The Social Security Fairness Act, which honestly raised benefits for a few public sector workers and their spouses, really didn't help the problem. It actually made it worse.
Yeah. So when you think about the policy reforms, increasing taxes is one lever. Reducing benefits is another, or a mixture of those and other things. Do you have your favorite reforms that would help us alleviate the trust fund depletion?
The reality is there's no single magic bullet, unfortunately. I think if it had been easy, it could have already happened. I actually served on President Bush the Younger's commission to strengthen Social Security back in 20 years ago. So that would have been 2001. And at that point, we still had a bit of a runway to do some reforms and avoid the big problems that we now confront. But right now, it's going to be very, very difficult and delicate. I mean, there are proposals to raise the full retirement age. That's the age where you get your full unreduced benefit from, say, 67, which is what it is now, up to age 70. And I do think that people should continue to work longer if they're able to, and that would provide some incentive to do that. The downside of raising the full retirement age is that people who claim as early as they're allowed to at 62, that's the early retirement age, would have their benefits decreased. And that is going to be very troublesome for people that are unable to be able to delay claiming.
Yeah.
Another proposal has been to boost the number of years. Right now, only 35 years of your highest earnings are included in that benefit calculation. The proposal is to raise it to 40 years. And if you haven't worked for 40 years and earned pay, then that would increase the number of zeros in the formula, and obviously your benefits would be reduced. So those are some of the proposals that have been made. Others have recommended taxing all of Social Security benefits subject once you receive a certain amount of adjusted gross income. Right now, only 85% of your Social Security benefits are subject to income tax. Each one of those changes that I've just enumerated solves a little bit of the problem, but it certainly doesn't correct the entire thing.
I want to turn my attention away from policy for a second to things that might affect people. You've done volumes and volumes of research. I had a tough time figuring out what to ask you about, given all the research that you've done. But there was a piece that was published, I believe, in the National Bureau of Economic Research recently, where you looked at what people regret when they retire. And I'm curious about what you found and what people can do to avoid this regret.
Well, we've done a fair amount of work trying to study what older people do regret. And we were surveying people over the age of 50. And we asked them questions like, we didn't use the word regret because that would have been too leading, but we said things like, looking back, if you had to do it over again, would you have liked to have saved more, about the same, or less? And a majority of the respondents said they wish they had saved more. Only 2% said they wish they had saved less. So definitely regret for not having saved more along the way was very salient. Another thing we found is people regretted not working longer and not deferring claiming their Social Security later. Both of those things would increase the amount of money they would get when they eventually did retire. And the final thing that I found very interesting was that older people regretted not having purchased lifetime income. Lifetime income streams would come from something like an annuity, where you purchase from an insurance company a lifetime income payout that will make it much easier for you to manage your expenses. Even in later life, many people become demented. Many people are financially not as literate as they were when they were younger. And having that steady income stream is and can be a real boon. People regretted not having done that as well.
And if memory serves, I think the regret differences between the races was notable, the difference between black and white regret. Is that fair to say?
And also for women tended to be more likely to regret depending on others, frequently their children, or wishing they could depend on others. So a related theme that we explored was that if we explain to people how long they might live, in other words, their risk of living a very long time, they were much more likely to regret not saving and not buying lifelong income payments. The reality is that when you ask people about how long do you think you're going to live, they're pretty on target, because that's an average. The life expectancy numbers are relatively well known. But if you ask people, what's the chance that you might live to be 75, 85, and 90 years old? People definitely underestimate that. And therefore, they don't save enough. They don't buy lifetime income, which continues as long as they are going to live. They also tend to underbuy long-term care insurance because they just don't understand how long they might live and the potential frailties they might face in later life.
So you teach a course at Penn called, I think, Consumer Financial Decision Making. And one of the goals of the course is to help people take charge of their financial futures. What can people do to do that?
Well, this is a course that's offered through the Wharton School to all undergraduates with no prerequisites, you don't have to know economics, statistics, or finance. So we spend the first couple of weeks teaching them that. And then our approach, these are kids, young people who are, say, 18 to 22. These are people who early in life, may have confronted problems with student loans or credit cards. So we take a life cycle approach. So early in life, we focus on those decisions that young people are making right away. And then we more or less go through the life cycle. So at some point, maybe the student or the former student would think about trying to buy a car, buy versus lease the car. What do you have to do to buy a house? How do you establish a credit record? And then when I come in, because we split the course, two of us, when I come in, I start talking about saving for retirement, investments, obviously annuities, Social Security claiming, and last but not least, estate planning and wills and trusts and things like that. So I've had the kids go home during Thanksgiving and they come back right afterwards and say, oh, I talked to my parents and my grandparents and they find this so useful. This is the most useful course I've ever taken. So I feel good about that.
That's great. So what advice do you give these folks in terms of taking charge of their financial futures? Is it to just be mindful of these topics and to incorporate these actions into their life?
Well, you have to start simply. You have to understand and you have to teach people early in life about the dangers of compound interest. If you don't pay your credit cards on time, then you're going to end up building a bigger and bigger overhang of debt, and that's going to be very problematic to you in later life. We also talked to them about the benefits of diversification. Don't put all your eggs in one basket. It's hard to explain to an employee at Apple that may have invested his or her entire 401k plan in Apple stock that actually that's not a very good idea ex ante. It's hard to convince them after the fact that they should diversify. But then you can point to examples where companies went bankrupt, like Enron, and people lost not only their jobs, but their entire retirement nest egg. So, and then, of course, inflation has been a topic much in the news of late. Back 10, 15 years ago, people didn't really ever think much about inflation. And now it's more salient, especially with food prices and housing prices and everything going up so rapidly. So all in all, those are the places that we start and we build from there.
Yeah. Olivia, we're going to take a quick break, and when we come back, we've got a whole bunch of things to cover, 529 plans, defined contribution plans, so don't go away. We'll be right back.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
It's time for Yahoo Finance's Market Minute. U.S. stocks mixed amid revived tariff threats and as consumer confidence sees its biggest monthly decline in more than 4 years. Li Auto shares pop as the company announces its first full electric SUV model. This marks the Chinese automaker's second move into full electric vehicles, the first being the Mega model launched last year. And taking a look at PayPal, that company introducing its outlook for growth at its Investor Day. By 2027, PayPal expects adjusted earnings per share to increase by a percentage in the low teens, while transaction margin dollars are expected to climb by high single-digit percentages over the next 2 years. And lastly, Intuitive Surgical shares remain under pressure, extending its losses, declining for a fourth day. Investor concerns over the impact from tariffs in part weighing on the stock. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We're 30 minutes into the U.S. trading day. Let's get into 3 catalysts that we're watching this hour.
First up, a risk-off shift in the market as the 10-year yield hits a low for the year and the tech-heavy NASDAQ continues to fall.
Plus, the latest consumer confidence data crossing the wire, what the numbers tell us about inflation expectations.
And Bitcoin sinking to a 3-month low. We will unpack what's driving those declines right here on Catalysts. We're getting a preliminary reading on consumer confidence in February, dropping sharply here. You've got the survey anticipating 102, but the number coming in stiffly below that at 98.3 and also below the prior reading of 104.1 here. So interesting to see that level of a decline here. Again, that consumer confidence number coming in below the survey number, which was 102. The actual number coming in at 98. Conference board expectations also falling, coming in at 72.9. So we're going to continue to break down those numbers as we get them here. Joining us now, we've got Yelena Shaletyeva, the Conference Board's senior U.S. economist. Yelena, I'm still waiting for all of the data to drop in, but what else can you tell us?
Well, I think it was a sharp drop, no doubt about that. And now the index is at the lowest level of the range it has been hovering over the last several years. Having said that, I think the index is still within the range, which is associated with healthy consumer spending, although the decline in expectations is definitely a concern and deserves close watching.
When you say it's a concern, I guess at what point should we be a bit more worried? And what is that range that would then drop below that we would then, I guess, would raise some of those concerns?
I think this particular survey from the Conference Board is telling us a lot about the state of the labor market. Mm-hmm. And this particular decline in the confidence indicator was driven by consumers' expectations for business conditions and the labor market. Mm-hmm. So what is a concern is that consumers are not seeing great prospects in the labor market, and that is something to watch in the months ahead. If that continues to deteriorate, that's a big deal.
But it also looks like inflation expectations ticked up. Median inflation expectations coming in at 4.8%, following 4.2% the prior month. How concerning is that?
Consumers are worried about inflation. Inflation is sticky, and the latest developments in terms of, I would even say, some certain consumer goods such as eggs, that could be driving it, and also the talk about tariffs. So we know that next week the next round of tariffs is probably going into effect, and consumers hear this news and they are very concerned about this. So everybody is talking about inflation rising on the back of tariffs, and that is a great concern for the consumer.
Yeah, I'm taking a look at this release here. It looks like that the decline was across all age groups, also was pretty broad-based among income groups. What's your takeaway from that, just the fact that we are seeing some of that concern really just across the board?
That is a concern. We know that consumer spending has been in a large part driven by those at the top of the income spectrum. So those more affluent consumers who have assets on their hands, they are, they hold stocks, they have property, real estate property. They have been driving consumer spending. But the fact that it's a decline across the income spectrum and age groups is a concern, because that's our consumer spending, and if this is going to slow down significantly, that's a concern for the economy.
It's interesting, though, in this note, in the survey data here, looking at a 6-month average basis, purchasing plans for homes continued to recover. I wouldn't have expected that based on what you just said, that all income groups are feeling a little bit more negatively about the economy. Where is that recovery in housing coming from?
I don't expect the recovery in housing this year. Rates are still elevated. The affordability is still pretty low given where the prices are. We actually have a drawback from the residential investment sector in our projections for the economy for this year. So I think, until we see a more significant decline in long-term rates or, like deceleration in price increases for housing, we will probably not see a significant improvement in the sector.
What are you hearing just in terms of the fact that we could be in this high for longer environment and how much pressure that could potentially put not only on the sentiment side of things, but obviously that hard data too?
So I think, what we expect for the economy is deceleration this year. So we are coming from this high growth that we saw post-pandemic. So that process is continuing. So we saw some pickup in consumer spending over the turn of the year, and probably that was driven by consumers trying to stock up ahead of tariffs, and businesses too. Now that that has already happened, I think we were going to continue to slow down towards the end of the year. My concern is the labor market. If it slows down significantly, that would pull things quite significantly below what we expect.
So how are you thinking about the divergent policy impact on the labor market? Obviously, we're seeing cost cutting leading to a lot of layoffs for federal workers, but then you have news like Apple adding 20,000 jobs to the U.S. Do you think that these U.S. companies adding jobs could offset some of those concerns?
For now, we're at a very happy equilibrium, right? So we're not adding too many jobs, but we're also not cutting. There are no layoffs. So it could go either way, right, depending on how businesses are feeling. So we had another survey earlier last week that showed business optimism was rising quite significantly. So which way will it go? We don't really know. And for now, businesses feel optimistic, and they are expected to hire people. But at the same time, if tariffs have a significant impact on economic growth, and our expectations that it could potentially cut up to 1 percentage points from growth this year, if what has been announced is implemented, then, we're probably going to have a different story.
All right, Yelena, great to have you. Thanks so much for joining us.
My pleasure.
Let's take a look at a trending ticker here this morning, and that is Home Depot, the company issuing a conservative same-store sales forecast for the year as it expects consumers could potentially hold off on some of those larger purchases. But the focus on the street, the reason why we're seeing the stock up nearly 3% here in early trading, much of that has to do with the stronger than expected quarter, the fact that same-store sales did snap 8 consecutive quarters of declines, actually rising 0.8% from a year ago. Joining us now to discuss is Michael Baker. He's D.A. Davidson's senior research analyst. Michael, it looks like the street, at least looking at the more optimistic side of this report. I think the big question is whether or not some of the improvement that we saw in same-store sales, whether or not there's enough momentum for that to continue. What do you think?
Yeah, I think the strength in the fourth quarter is really what is carrying the day here. The 2025 outlook was below consensus, particularly on the earnings side, a little bit more so than on the sales side. Both were below, but I think the real pressure point was the earnings. But it's pretty clear, I think, from the call and from what we know about retailers in general, that companies want to sort of set a lower bar. That doesn't mean they're sandbagging it. January was a softer month than December, so they did see a little bit of a slowdown. That plays into the guidance. But I think the bigger idea is let's just set a low bar, something that we're comfortable with, given all the uncertainty in the environment, all the policy rifts, as we call them, our acronym, for rates, inflation, FX, and tariffs. It makes sense to set a low bar. But clearly the business seems to have bottomed, given what we saw in the fourth quarter in a number of metrics the company talked about on the call. Big ticket spending, et cetera.
Well, it's interesting, though, because the CFO did mention that they're still facing pressure as customers adjust to high interest rates. How concerned are you about the headwind that could present, especially if the Fed does not continue to cut rates?
Sure, that's a pressure point, but it's a pressure point that's not getting any worse, right? We've been dealing with that for quite some time. In fact, rates don't seem to be going up anymore. They're down 30 basis points or so on the 10-year in the last month. Home Depot gives a metric on comp sales for tickets $1,000 or higher. That was positive this quarter. That's the first time that's been positive for more than 2 years. It had been down 5-6% every quarter. So there's still some pressure on these interest rate sensitive businesses, but again, no worse so than it has been, and maybe even getting a little bit less worse.
Michael, one of the questions going into this report was the impact of tariffs and the threat of tariffs, maybe what that could do ultimately to Home Depot's business in the longer term. Where do you stand on that, just the broader implications of it?
Yeah, to me, tariffs are a relative game, right? It's all a function on how much of your COGS come from overseas, and then your ability to push back on vendors or pass through to consumers. And we think within that sort of dynamic, Home Depot is pretty well positioned, particularly as it relates to pushing back on vendors. That's all about scale. Home Depot pushes a big pencil. Their vendors want to keep that Home Depot business. That doesn't mean the vendors will eat it all and Home Depot won't absorb any. But within that sort of negotiation dynamic, Home Depot is pretty well positioned in our minds.
So it doesn't sound like it's too big of a concern, but I guess how big of an impact is it going to have on their business?
Well, again, if anything, we think it'll tend to be maybe slightly positive, because we do think they'll be able to pass some of it through to consumers. That's what we saw last time there were tariffs in 2018-19. So maybe even a little bit of a comp benefit. Now, the offset could be, do you lose units? But that's not really what we saw last time. So listen, we don't want to dismiss it. We do think it could have some impact, but they will be, particularly on the margin side, but they will be impacted less than others. And again, it could actually be a helpful item to the comp line.
One of the concerns from a macro level is this idea of a K-shaped recovery, and that lower income consumers will potentially be more negatively impacted by the policy shifts of things like tariffs versus higher income consumers that have a little bit more on their balance sheet to protect them from any inflationary pressures. How does a company like Home Depot potentially get impacted by a K-shaped recovery if we do start to see those middle and lower income consumers struggling even more?
Yeah, Home Depot does skew more towards higher household income customers, just by virtue of the fact that you're a homeowner. So that kind of dynamic, while unfortunate for the lower end customers, it really does play well for Home Depot, which again, more of their customers are in that middle to higher income demographic.
Michael, who's best positioned within this coverage space right now to you here over the next couple of quarters?
Well, we like Walmart, particularly on the pullback after last week's report. We like other discounters like BJ's and Costco, but BJ's better just given the lower valuation. When I say other discounters, we don't love the dollar stores, but BJ's and Walmart within the discount space. And then I think there's an opportunity here at Home Depot. We upgraded it last year. We knew we'd be a little bit early as it relates to the housing recovery, but housing's not getting worse here. In fact, existing home sales have been up on a year-over-year basis 4 months in a row. So again, we think we're in front of the recovery, but that's really when you want to buy stocks in front of the recovery. So we think we're there now.
All right, Michael, always great to talk to you. Thanks so much for hopping on with us here today.
Sure.
Coming up, we're going to take a closer look at some of this morning's trending tickers, including why shares of Supermicro are off just about 8% right now. We'll be right back.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue so you cancel on time from Yahoo Mail.
Bitcoin falling below $90,000, hitting its lowest level since November. This comes after hackers drained $1.5 billion in digital assets from the exchange Bybit, and what researchers are dubbing the largest crypto hack of all time. Joining us now to discuss, Noel Aitchison, Crypto is Macro Now founder and author. Noel, thank you for being here. So how much of this is about the Bybit hack versus general macro concerns driving the sell-off?
It's easy to guess, it's easy to assume that this is the delayed reaction to the Bybit hack, but I don't think so. The Bybit hack was awful, but it was handled really well, and what's more, by Monday morning, the hole had been filled. Over the weekend, the industry showed that it is maturing, that it is transparent, and that it can come together in times of crisis. Not to belittle what happened, it was awful, but I think it was very much isolated to the crypto community, and it was digested. I think what we're seeing now in the crypto markets is an extension of what we're seeing in macro markets. We're heading into risk-off territory, and crypto, being high beta assets, are reflecting that and then some.
So, Noel, what does that then tell us just about some of that downside maybe that we could still see here in the move with crypto?
Crypto is going to be slightly more volatile than traditional assets, but it could go lower. To be honest, this is something we've sort of been expecting. Crypto, I'll take Bitcoin as the bellwether here. It has been trading more or less sideways since the November rally. And so we've all been waiting. Is it going to break up or is it going to break down? It has to break in some direction at some time. And given the clouds gathering on the macro horizon, growing consensus was it was going to break down at some stage. When? We didn't know. Maybe that's what we're seeing now. But what we're seeing is not just growing concern about U.S. economic growth. I mean, that's pushing bond yields down. That's pushing the DXY down. That should be good for risk assets, all else equal. But we're also seeing concerns about geopolitical fractures. And let's face it, the Trump rally could be just getting exhausted here. It could be some fatigue we're seeing setting in. I mean, let's face it, the past few weeks have been exhausting. Add to that, throw in some skepticism that the Doge cuts will actually make a dent in the deficit, and things feel particularly fragile now. So when you are talking about assets that can behave either as risk assets or safe havens, depending on the mood, then everything that can be sold will be sold.
So, Noel, I guess that begs the question, is there anything on the horizon that's going to change then this downward momentum?
Yes, then I would say that's simply price. We know that, and this is one of the advantages that an asset such as Bitcoin, again, to pick the bellwether crypto asset, is one of the advantages of its multi-narrative characteristics. It is a risk asset, and so we'll head down with other risk assets when that's the mood, but it is also a safe haven. It is very much like digital gold. This is a narrative that BlackRock and many others have been pushing out there, and many investors do see it as that. So when it gets to a lower price, those that have been sitting on the sidelines waiting for opportunity will step in. Its floor is going to be higher than other assets that didn't have that diversity of narratives. And let's face it, if ever a safe haven was needed in diversified portfolios, arguably it would be now.
So basically, an unknown low level is going to be the next catalyst for upside momentum in digital assets?
True. And when I say unknown, I'm not a technical analyst, but many of my colleagues in the industry are. And because it is a sentiment-based move generally, they do tend to hold some weight. And 80 is the next number that people are talking about. It could go that low. But again, we don't really know, because all it would take is for the selling to get exhausted. I'm often asked, Maddie, whether, what's the catalyst? What are we waiting for to get the bull market going again? And the answer is always when the sellers get exhausted. And often what it takes for that to happen is a short, sharp correction like this. It's a thin market. When things are moving fast, people do tend to, step back and let the liquidity providers do what they're going to do and let the short-term traders do what they're going to do. But this will find a floor eventually. I have no idea how low it'll go, but I would bet not as low as many would fear.
And it's interesting in the context of this administration, which of course has been viewed as very pro-crypto, and we've seen the SEC dropping their lawsuits against Coinbase and Robinhood in recent weeks. I was a little bit surprised that those events weren't a bigger catalyst for Bitcoin to the upside. Can you walk me through that?
Absolutely. You raise a really good point. The tailwinds for crypto markets have been building. So many of its obstacles have been being removed. So everything has been setting up the crypto asset, especially the prices of the bellwethers, for a very positive run that hasn't been happening, which has led many to say, is this over? The mood has been bleak in the crypto market recently, and partly it's because we haven't been getting the rally that we expected with the regulatory thaw. But I do believe that is because we're not yet seeing the new money come in. And we all know that bull runs are always driven by new money coming in. The new money we're waiting for is from the large institutions who are having the path cleared for them to do so, with the large custodians gearing up to offer services, with the ETFs already on board. However, they take their time. They're not necessarily going to be moved by short-term considerations. They have a lot of boxes to check, a lot of people to convince. And a drop like this could incentivize them to start to come in, but they were always going to be slow but methodical and careful. When we do see them come in, then we will see the move. Until then, the headlines that we're getting, the positive move, the positive noise from Washington, D.C., that is just building the tailwinds. It's not necessarily going to move the price until the new money does start to step in.
Yeah, that makes a lot of sense. So I hear you noting that it's this digital safe haven, but also a risky asset. Help our investors understand how they should be strategically thinking about portfolio allocation when it comes to crypto, given that it holds both those titles, a safe haven and a risk asset.
That is such an excellent question, and it also highlights how confusing this asset group can be to many people. I often get asked, what is Bitcoin? And my answer is it's what you want it to be. If you want it to be a risk asset, then it's a risk asset for you, and you will trade it as such. If you want it to be a long-term holding, a safe haven, a diversifier, much like digital gold, then that's what it will be for your portfolio as well. In the end, it comes down to time frames. If you're thinking short-term, crypto is volatile. How can such a volatile asset be a safe haven? Long term, it is, because it resists the dilution that we're seeing in most others. So that's the easy answer. It can be both according to different time frames, and that adds a certain fascinating complexity to the narrative behind it. It gives it a higher floor than other assets, and it also leads to some very interesting philosophical questions. How can an asset be so many different things at the same time?
All right, Noelle, always great to talk to you. Thanks so much for making the time to join us.
Thank you so much.
Well, the selling continuing today in the broader market. You've got the S&P extending its decline, hitting the lowest level that we've seen since January 15th. Now, despite the drop and the recent move to the downside that we've seen, some on Wall Street seeing a few catalysts on the horizon. Here with more is Yahoo Finance's Alexandra Canal. Ali, give us some reasons to be optimistic.
Yeah, it's a lot of pessimism on Wall Street right now after this consumer confidence reading. We had the sentiment reading on Friday, but there are some catalysts, especially in the near term, that could drive stocks higher. And if we think about the sell-off that we saw last week, there was a confluence of different factors there. We saw Walmart's soft guidance that led to some concerns about the state of the U.S. consumer. We had Microsoft's decision to cancel some leases for data center capacity. But as we look in the week ahead, NVIDIA earnings on Wednesday, that's something to look forward to, especially since a lot of those big tech names, in particular the Mag 7 names, they've underperformed the broader market here. Now, most on Wall Street do expect NVIDIA to outperform this earnings. The options market, it's implying a 7% gain or loss. That's significantly less than what we've seen over the past 2 years, but it remains to be seen. If we get solid results from NVIDIA, that's likely to make the Mag 7 enjoy some gains. So perhaps the Lag 7 can now be the Mag 7 once again. There's also the fact that we have this expectation that inflation is going to continue this deceleration. We did have that hot CPI print, but there were components within that consumer price index that feed into the PCE inflation data. That's the Fed's preferred inflation measure. And that actually showed some softness there. So, and if we get that better than expected inflation report on Friday, another potential boon to stocks. And then finally, the Fed outlook. Yes, we have these risk factors that have been wandering around the market, and perhaps that convinces the Fed to cut rates sooner rather than later. We see that the odds for a May cut, that's actually doubled over the past few weeks. We're still at a pretty low level, just around 20-25%. But if we get a further deterioration of the labor market, if we see that GDP data that's due on Thursday come in a little softer than expected, perhaps the Fed can recalibrate its rate cut thinking. And obviously markets would love to see some rate cuts at some point this year. We did hear from Bank of America earlier today saying that they don't anticipate any rate cuts in 2025 or into early next year, but we just don't know. And all of that could be a
potential tailwind for some of these market moves.
And it's really interesting given there was so much optimism about the incoming administration and the market rally that would come off the back of that. And then you had Michael Hartnett from Bank of America this morning saying that the market still is a red light for the Trump administration. I wonder, Ali, when you think about the conversations you have with sources and just your outlook for the market this year, how much momentum and optimism do we have? How much potential do we have to move to the upside given all the question marks about policy right now?
Well, look, markets don't like uncertainty. And I think in particular, when we think about the tariff conversation, we just don't know. I mean, Trump has gone back and forth when it comes to those tariffs on Canada and Mexico. He revived those threats the other day, which is part of the reason why we're seeing some markets sell off. But by and large, Wall Street analysts do see upside ahead. Citi sees the S&P ending the year at 6,500. That implies upside of about 10% based on current levels. So they have warned that between now and then, there's going to be some choppiness. There's going to be some volatility. You have to be patient within this market, especially since we do have valuations that are so high. And Hartnett was also talking about the fact that we're seeing a lot of inflows into overseas markets and how that could potentially signal some trouble ahead in the U.S. But it seems like by and large, Wall Street is still bullish on the long-term outlook for stocks. You just have to be able to weather some of that volatility in the interim, which we know investors don't always like it, especially when we've been used to such massive gains the past 2 years of this bull market.
Yeah, exactly. Those double-digit gains getting us very spoiled, Ali. Thank you so much for joining us and breaking that down. We appreciate it. Coming up, Apple preparing for shareholder meeting showdown over its DEI policies. We'll have the details for you next.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Shares of Amer Sports, parent company of Arc'teryx and Wilson, are under some pressure this morning after the company reported its latest results. The company expecting unfavorable exchange rates to weigh on sales growth in 2025. Joining us now, Andrew Page, Amer Sports Chief Financial Officer. Andrew, great to have you on here. So lower sales growth and the revenue growth outlook for 2025 are weaker than expected. What do you think is driving that pressure?
As you talk about 2025, I think about 2024. We had an amazing year. We exited 2024 with really, really strong sales growth, up 18%, paid off about $2.5 billion of revenue, strengthened our balance sheet, reduced our effective tax rate, reduced our leverage ratio, and then exited 2024 with momentum. As you think about the underlying business next year, our guide, which speaks to reported currency on a constant currency basis, would reflect about a 15 to 19% growth on a constant currency base. So exiting 2024, the business is strong. Entering 2025, it's healthy, and our constant currency growth rate is in line with 2024.
Andrew, you're starting to see any sort of weakening trends, though, within the U.S., and I just bring that up because the growth numbers that you posted in the Greater China region were staggering, just across Asia Pacific in general, and then you compare it to what we saw in the Americas, where it did grow 15%, but that pales in comparison to some of those growth rates that you're seeing overseas. I guess, what do you attribute that to?
I attribute it to the maturity of the market. So we have been, Wilson, which is a predominantly U.S.-based business, has been doing business for 114 years. Arc'teryx, Solomon, they are just entering in the last 5 years some of those markets where you see the outstanding growth rates. And so as those markets mature, they started from a much smaller base, and we're excited about the growth across all of our markets. You mentioned the growth in APAC and Greater China approaching 50%, and in the Americas and EMEA, really strong growth as well. And so as our markets mature, we like the fact that we have a very global distribution of revenue. We operate across all four of those major markets, and we're excited about where the business is growing and the even distribution of our revenue.
I hear you saying you're excited about the globalization of the business, and I think that's interesting in the context of tariff policies that a lot of the executives we speak with are concerned about for 2025. How are you positioning and strategically thinking about the potential impact of tariffs on your business?
Well, I think about the fact that because of the global nature of our business, we are about a third from a revenue distribution between North America, EMEA, and Asia. And that is a benefit to us. We benefit from having a distributed revenue base. As a result of that, we also have a number of levers that we can pull because of our premium positioning of our products. We obviously have pricing power. We have a diversified sourcing base, which we can pull from and re-resource if necessary. And we have strong relationships with our sourcing partners that will allow us to do some cost sharing should tariffs arise. So we have a number of levers that we can pull.
So, Andrew, do you see any sort of impact potentially to your bottom line because of that?
Well, obviously our 2025 guidance contemplates what we can control, and that is producing great product, continuing to delight our consumer, and continuing to innovate. Obviously, we balance it with the known risks of the macro, of which I called out a couple of things on our call with regard to FX headwinds as we head into 2025 with regard to the reported growth rate. But the underlying business is really strong. The consumer continues to reflect resilient. Like I said, from a tariff perspective, should they arise, we have a number of levers that we can pull.
So, Andrew, I guess given the fact that the consumer is so resilient, do you not see then the need to rely maybe on discounting so much then this year?
Yeah, I think that the strategy of discounting as a strategy for us, we are premium product company, and we do stay away from discounting. Obviously, we'll continue to price our products in the market, and they will reflect the value to the consumer. We don't see discounting as a primary lever that we intend to use.
And I heard you mentioning pricing power. Do you anticipate, and have you already started conversations around raising prices on any items?
Well, pricing power is one of the levers, one of the three levers I talked about. We have pricing power. We also have the ability to re-resource as necessary, and we have strong relationships with our vendors whereby if tariffs do arise, the opportunity to share some of their costs with our suppliers is one. And so what we're doing is we're controlling the things that we can control, making great products, delighting our consumers, continuing to put innovation in our products, and we are well positioned should tariffs arise to be able to navigate what comes.
Andrew, have you seen any change just in terms of consumer behavior? And I understand that the consumer remains very resilient, but just in terms of what they are buying, what they're not buying, and maybe what you're seeing just across differences here across your various brands.
Yeah, we obviously participate in the consumer discretionary sector, and as a consumer, they will continue to vote with their wallet. And one of the things that we benefit from is we are in a space, the outdoor space, where consumers have continued to prioritize their health, their welfare, their both mental and physical health, and we provide products that sit square in the center of the bullseye of what consumers are actually desiring.
All right, Andrew Page, always great to get some insight from you. Thanks so much for taking the time to join us, CFO of Amherst Sports.
It's a pleasure. Thank you very much.
Let's do a quick check of the markets here. Just about 90 minutes into the trading day. You're looking at right around the lows of the session. You now have the S&P off, just off the lows of the session, actually. You got the S&P off about 0.9%. The NASDAQ off about 1.5%. We did see the lowest level for the S&P since mid-January. You do have the Dow barely holding on to gains up just about 0.2%. That does it for Catalyst. But coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance.
It's time for Yahoo Finance's Market Minute. The fall in consumer confidence weighing on U.S. stocks as the S&P 500 heads for its fourth consecutive losing session. The tech-heavy NASDAQ dropping as the mega-cap Magnificent Seven extend declines. Meta, Amazon, Nvidia, Alphabet, and Microsoft all under pressure. That big tech group entering correction as it sheds $1.6 trillion in market value since its peak. Sticking with big tech, Apple shareholders rejecting a request to abolish its inclusion and diversity program. Apple CEO Tim Cook saying during the company's shareholder meeting that Apple's strength has, quote, always come from hiring the very best people and then providing a culture of collaboration. Lastly, oil prices declining amid worries about U.S. tariffs. WTI crude on track for the lowest close since December of 2024. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we've got a little bit of a portfolio checkup for you. We discuss the dangers of trying to time the market and break down how investors can navigate short-term volatility. And state of the housing market. One expert tells us how improving inventory and easing price pressures should help potential buyers this spring. Plus, getting retirement ready. All week, we're taking a look at how to best invest for retirement at every age, from workers in their 20s maxing out their 401k match to those over 70 living off of those investments and sipping mojitos. Today, we focus on your 40s and 50s, your final push to save. All that and much more during today's show. But first, let's start, as we always do, taking a look at some of the market action. We are 90 minutes into the trading day. We're seeing declines across the board, fractionally for the Dow and the S&P 500, but the NASDAQ slippage is intensifying, down 1.7% right now. Let's make sense of this for you. Stocks struggling to snap a losing streak as investors navigate macro uncertainty. Joining me now on set, we've got Kevin Mon, who is the Hanian & Walsh CIO. Great to have you here in studio with us.
Good to be here, Brad.
An important day for you to be here in person as we're kind of tracking the slippage here. You're actually warning about the potential dangers of trying to time the market.
Yes.
Explain how you're viewing the recent volatility and what investors need to know.
Sure. To start, prior to yesterday, the VIX, which is a measure of volatility in the market, rose by 35%. And that caught some investors off guard. And you know why? Because last year there was little to no downside volatility, as there was less than 4% of the time the market closed 1.5% or more lower on a given trading day. That's a historically low level of volatility. But that type of volatility shouldn't cause investors to flee the markets or try and time the market. You know, Warren Buffett once said, and I agree, that the Hall of Fame of market timers is an empty room. Trying to time the market is an exercise in futility, because you got to get it right twice, Brad.
Right.
When to get out and when to get back in. It's when to get back in that is often more difficult and allows investors to fall short of their longer term financial goals.
Right, and so that's where we hear this old adage, it's not timing the market, it's time in the market here. You know, how can you really make sure that you're allocating your assets for any market volatility that you have to weather?
Sure. I think you need to stay true to your risk tolerance. In other words, your risk tolerance shouldn't go up just because the market is moving higher, just as much as it shouldn't go down just because the market is moving lower. Build your asset allocation strategy consistent with your personal risk tolerance, your investment time frame, and ultimately what your growth and income goals are. There was a study done by a University of Michigan professor, and I recognize this study is somewhat dated, but he looked at 31 consecutive years of stock market returns. And what he found, Brad, was that 95% of the stock market returns come on just 1% of the trading days. Now, I don't have a crystal ball. I don't know when those 1% of the trading days are going to be, but rest assured, if you're not in the market on those 1% of the trading days, you're likely to miss out on the most significant returns the market has to offer, and they generally come after big down days.
With all of this in mind, for some of the slippage that we have been tracking here, a lot of investors trying to figure out where they should be reallocating.
Yes.
And you have, I think, trending on social here earlier this morning, I had seen even buy the dip.
Yes.
So if you're talking to investors right now who are trying to figure out what dips feel safe or which dips actually might have a little bit more of a dippity dip coming later on here. It's a technical term.
Yes, absolutely.
Yes.
So I would look into those themes that are going to continue to resonate in the new year or perhaps even over the next decade. I know the AI revolution is being called into question tomorrow. I think we'll find tomorrow afternoon after NVIDIA reports that the AI revolution is indeed alive and well and CapEx spending will continue there. But don't just look at those semiconductors and chip displays. Recognize the other opportunities that exist around there. How about power solutions, utility companies, SMRs, nuclear capabilities, or even the data centers, the cooling solutions for the data centers? I could go on and on. There are growth opportunities ahead. However, we're starting to see changes in market leadership now. We're seeing value outperform growth, international outperform U.S. Maybe now's the time to take some chips off the table and move into other areas of the market that may provide the leadership going forward.
As we're thinking about some of those attractive areas of the market, what are you playing? What are you fading right now?
So where I really like right now, I still like the utility sectors, particularly multi-utilities that pay good dividends, have strong balance sheets, and supply electricity, natural gas, and even nuclear power capabilities. I think people are shorting defense right now. I don't think defense spending is going to decrease as much as many anticipate. If you look at companies such as L3 Harris or even Lockheed Martin, I anticipate more spending in those areas ahead. And then you go away from that. How about small cap biotech? If you're looking to be a little bit more aggressive and looking for growth opportunities, I bet you there's a pickup in M&A activity, and the small cap biotech companies will benefit from that.
Kevin, thanks so much for joining us here.
My
Critical
pleasure.
day to get some analysis here and get some insight. We appreciate it, Kevin.
Thank you.
Now time for some of today's trending tickers that we're tracking during the session. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got my morning brief co-anchor, Shauna Smith. She's been hanging around here. This is hour number 3 for you.
It is. You guys can't get rid of me off set today.
We cannot, and we don't want to here. Why? Because we got to talk about Chegg.
Mm-hmm.
Of course, everybody's going to remember this one, especially if you went to college and purchased some books from there. All those things considered, shares of Chegg plunging after the company sued Alphabet, claiming the Google parent's AI overview feature has blocked traffic to its website. The company says it is now exploring strategic alternatives, and in its lawsuit, Chegg accused Google of unfair competition, calling it, quote, a once robust but now hollowed out information ecosystem of little use and unworthy of trust. My goodness, fighting words. Chegg, which offers homework help for students, has seen its value fall over 90% since ChatGPT launched in 2022 here. You got some real sparring words that are coming through in some of the legal filings here, Shauna.
You do. They need to do something because clearly they're having a tough time turning this around. You're taking a look at that 5-year chart. It clearly lays out just the pressure that AI and AI adoption, the Main Street adoption, has certainly put on its business. Chegg is very much trying to figure out what their place looks like here going forward, what exactly that business looks like going forward. Right now, we're right around the lows of the session with the shares off just about 31%. And I think the large takeaway here from so many of the analyst notes that I've been combing through here this morning is there's a lot of confusion and uncertainty just in terms of what that timeline looks like for Chegg in order to regain some of that lost momentum. JP Morgan coming out saying that the company continues to face secular and competitive headwinds driving to that lighter than expected Q1 outlook. Jefferies, Brent Thill over there, who comes on the show many times, saying that Chegg's business remains under major duress from AI. Piper Sandler also weighing in, pretty much affirming some of that sentiment, saying that subscribers are continuing to decline, a lot of that being pressured by AI adoption. So very much a clear takeaway from the street is there's a lot of concern, a lot of worry just about the continued pressure that AI adoption is going to put on Chegg's business. And there's a lot of questions as to whether or not the ability here to turn things around.
Yeah, down 30% on the day, now sitting just above $1 per share here. We'll continue to track that one. We're also keeping close tabs on Block this morning. Block getting a post-earnings upgrade to equal weight from underweight at Morgan Stanley. The analyst says that valuation is reflective of risks that they've outlined, including skepticism of Square seller growth acceleration. And Cash App valuation now matches the firm's expectation. Shares right now down by about 3.7% here. So a little bit of the valuation evaluation that they have continued to run the calculus around here and kind of saying, yeah, this is exactly what we expected.
It very much is. When you take a look at, if we could pull up a 5-day chart, I don't know if we have that ready here, but a 5-day chart shows the decline that we have seen in Block shares since we did see that release. You're looking at the stock still off just about 25%. So very much this is a valuation call. Morgan Stanley, the latest name to come in, saying that it's now the risk, the sentiment and positioning, I think, is a little bit more balanced. This also follows a call that we got from BMO earlier this week. They also upgraded the stock. They actually did to outperform from market performance, so a bit different than what we're hearing from Morgan Stanley this morning, who upgraded it to equal weight from underweight. But again, very much saying that they think the current valuation incorporates some of that increased skepticism. Block's ability to accelerate Square seller growth here is critical here to this upgrade. Their new price target of $65 a share, just about $1.50 higher than where we're trading today.
All right, Shauna, we finally release you from the set here today.
Thank you.
This morning,
For now.
right now.
I'll be back at noon.
Thanks so much for sticking around. Appreciate it. Also tracking consumer confidence, posting its biggest monthly decline in nearly 4 years, falling to 98.3. That's below the expectations for 102.5. The Conference Board says inflation expectations surged as investors digested an increase in prices for staples like eggs and the expected impact of tariffs. So we want to dig into some of this uncertainty and talk about how investors should be positioning themselves in the current environment. Joining me now in studio, finally live in living color, we've got Anthony Siccaro, president of Providence Financial Insurance and Services. Anthony, great to have you here with us this morning.
Thank you for having me. Great to be here.
Absolutely. So let's talk about this. You are calling for a measured approach for investors here. Walk us through that.
Sure. Well, the consumer confidence obviously has been down, and there's really nothing that's going to tell us that it's going to increase from here. It's all about inflation. It's all about tariffs. And as much as we would like President Trump to come out and say, look, guys, I'm just using tariffs as a political ploy. I'm really not going to impose them on anybody. We know that that's not going to happen. And we don't really know what's fact and what's fiction at this point. So the fact is that he is wielding them, but we don't know where that leads. If it's 10% or so, if they're real tariffs and 10%, companies can absorb that.
Sure.
And so I don't think that'd be a big deal. But if it gets higher than that, if it gets into some of the 25% range that he's talking about, now all of a sudden consumers are going to have a problem. But this is weighing on consumers' minds. So the sentiment is down because they believe that if he does wield them as a sword and if they do stick, then inflation's going to grow, and no one wants that. That's why consumer sentiment is down.
So what's the pass-through here for different generations of investors, say younger investors? Let's begin there. You say you should continue with the dollar cost averaging strategy. What does that look like in effect?
So dollar cost averaging is just buying the same thing over and over again. For those of you that have your 401ks that you're just having money taken out of your check, what you're doing is you're dollar cost averaging. And what it does, Brad, is it drives the average purchase price down, which is exactly what you want. You want to drive the average purchase price lower. The fact is that if you're doing that and you're in that younger generation, keep doing it. Volatility actually helps you, because if you're buying consistently and the price comes down, then what's going to happen is you get to buy more shares for the same dollar. It's not bad. If you're closer to retirement, though, or you're in retirement, now all of a sudden you have to worry about a major pullback at the wrong time. If you're going to retire in 2 or 3 years and that market crashes maybe 20, 30 or more % from that, now it could cost you your retirement. So if you're younger, keep dollar cost averaging. If you're a little older, might not be a bad time to reposition into something more conservative. And my preference is to focus on things that pay interest and dividends, because those are the eggs that you can count on.
Certainly. And so as we're thinking about that, let's delve a little bit further into those who are closer to retirement age. Where are the assets that you are seeing more people who are retirement ready and their savings feel like they're in a good spot to finally say, okay, maybe this year, maybe next year, 2 years from now, that we are retirement ready, but we still need a portfolio to kind of balance some of the opportunity that are still out there in the market?
Sure. Well, what you need to know is that almost any investment out there can be focused on either growth or income. Think about